and that acquisition took place on 1st of July 2022. Automatically, that means that 𝐉𝐎 Limited would be the parent, whereas now 𝐓𝐍 Limited will be the subsidiary. You can also see we are given the date of acquisition there, 1st July of 2022. And also in that point, we are given the purchase consideration. Let's go to point number 2. Okay, so let's first of all we go to point number 3. We skip point number 2. In point number 3, we are told on 1st of January 2023, 𝐉𝐎 Limited acquired that 40% ordinary shareholding in Tutu for a cash consideration of 500 million. So this company, we are told, acquired 40% shareholding in Tutu Limited, basically for 500 million, and the acquisition took place on 1st of January 2023. So basically that is our group structure. This group structure is very, very important when it comes to the preparation of the group account, because we know from this group structure, this is the parent, that is the company which has the responsibility to prepare the group account. This is the subsidiary, this is what? Associate. Now, if you check on what we are required to prepare, we are required, number 1, to prepare the consolidated statement of profit or loss. Now, when preparing this one, we know that we should combine the revenue and expenses, that of the parent and that of the subsidiary. The same case, expenses of the parent and those of the subsidiary. Do we take into account or do we combine the revenue and expenses of the parent with those of the associate? With those of the associate? No. We said as far as the associate is concerned, what do we include here? We include something called the parent company share of the associate profit after tax. That's basically what you need to remember. What about preparation of the consolidated statement of financial position? This one is prepared by combining similar items of assets and liabilities, those of the parent, those of the subsidiary. In this case, do we combine the assets and liabilities of the parent with those of the associate? No. What do we include here as far as the associate is concerned? We include something called the investment in associate. Investment in what? In associate. So having that group structure, you can see it guides you in terms of how to prepare the group account. Even before you proceed now to prepare this, or basically to have a sketch of this, it is also important to determine the date these companies were acquired. Was there a company which was acquired during the current year? That is something we need to determine. If you go to the requirements, when are we required to prepare the group account? We are required to prepare the group account for the year which ended 31st of March 2023. It basically means that this year started on 1st of April, because the next day will start 1st of April. It started 1st of April 2022. That is the start of the year. Remember this date when we are required to prepare the what? We are required to prepare the group account, the consolidated financial statement. That is known as what? Is known as the date of consolidation, DOC. So can we check whether there was a company which was acquired during the current year? This subsidiary, you can see when it was acquired, 1st July. 1st July 2022 is automatically within this year. 1st July 2022. So it was acquired during the current year. We need to determine it was acquired how many months to the end of the year, because when preparing this one, consolidated statement of profit or loss, we said in case a subsidiary is acquired during the current year, we only take into account its results from the date it was acquired. We combine its revenue and expenses with those of the parent from the date it was acquired. This is the date of acquisition, the DOA. How many months do we have here? We have basically 6 months within 2022. From July to December of 2022, those are 6 months. What about 2023? 3 months, January, February, and March. So therefore, this subsidiary was acquired 9 months, to the end of the year. We will only take into account the revenue and expenses of 𝐓𝐍 just for 9 months. We combine with that of the parent. What about this associate? The associate, you can see it was acquired still in course of the current year, 1st January of 2023. It was acquired 3 months to the end of the year. So what basically that means is that when computing the parent company share of the associate profit after tax, we will compute the profit after tax of the associate just for 3 months, and then we get the parent company share of that. The parent company share of that. Now, having such group structure, then we can proceed, and basically we have what? We have the sketches. Remember, I've said never start with the workings, because those workings have said that they are not marked. They will just be consuming a lot of your time. They are not what? Marked. So I want us we start by having a sketch, not a sketch, rather we can just refer to it as a skeleton of what is required in Roman 1, the consolidated statement of profit or loss, which is for the year which ended 31st of March 2023, 31st of March 2023. So how do we prepare this one? I've said to prepare this one is quite simple. We are combining the revenue and expenses, that of the parent and that of the subsidiary. But the revenue and expenses of this company, we only take them for 9 months. We will take the revenue and expenses for the subsidiary for 9 months. Do we include the revenue and expenses of the associate here? No. We will compute something called the parent company share of the associate profit after tax. So therefore, I want us to come up with a sketch, or basically in other terms, a skeleton. So here we need to have just a single column. Our figures are in what? Are in million of shillings. So remember, when preparing this, we use the statement of profit or loss for individual companies, which is given below paragraph 1. So below paragraph 1, we take the revenue of the parent. For the parent, we are taking for the whole year. For this company, we are taking revenue and expenses just for 9 months. For 9 months, yes. So what we can do, instead of having the working here, okay, let's just have it here. So we will have 26. But in this case, remember, we are taking the revenue for this company for how many months? Just for 9 months. So that's why you're multiplying that with 9 all over 12. And then in this case, we will not cross the bracket here. So as we go through the additional information, we say that there is only one item which is adjusted to the group revenue. Who can be able to remember that item? Which item which affect the group revenue? After adding the revenue of the parent and that of the subsidiary, what do we adjust here? I think we said one item. One item. Who can be able to remember that? That one item which affects the group revenue. Who can be able to remember that item? Reporter, Virginia, Martha, Aaron. Which is that item? We adjust here. Which is that item? Which is that item? We adjust to the group revenue. Which is that item we adjust to the group revenue? Yes? Which is that item we adjust to the group revenue? Yes? Okay, so let's move then to the other item as you remember what we said here. So then from there, we take into account the cost of sales. The cost of sales, we do the same. The cost of sales, we do the same. Yes, I'm told by Aaron is the sales between the parent and the subsidiary. That is what we will be looking for in the additional information. So we do the same to the cost of sales. But remember, in our case, this is purely a skeleton. This is what? Purely a skeleton. A skeleton means that we can't be able to come up with the final figures, because first of all, we need to go through the additional information. We see whether there is any adjustment to be made here. So we will do the same for the other what? Items. So the cost of sales, we take that of the parent plus that of 𝐻𝐶, which is basically 14. But in this case, we multiply that with 9 all over 12. Don't cross the bracket here. Don't cross the bracket. As we go through the additional information, we will see whether there is any adjustment. So then from there, we will get the gross profit, the gross profit, the gross profit. And then to this, before we proceed to less now the expenses, before we proceed to less the expenses, we need to remember that we have an associate here. So what we need to include here is the group share of associate profit after tax. So we will go to the income statement of this associate. We take into account its profit after tax. So can we go to the income statement? Can we go to the income statement of We go to the income statement of the associate. Let's go to the income statement of the associate. How much is the profit after tax? questions from this topic. I want us to start with a question which was tested in the meeting of April 2023. April 2023. April of 2023. Specifically, question number 2. Question number 2, that is the question I want us to start with. That is the question I want us to start with. So once you get that question, please confirm. Mercy, I think I've already shared the past papers with you. So just go to this paper, to this question here, or to that paper for April 2023. So once you get the question, please confirm so that we go through it. We see what was required as far as that question is concerned there. Yes, so are you there? Are you there? Do you have the question with you? If yes, please confirm. I want us to do 2 questions on this. 2 questions on this topic of group accounts. Are you there? Are you there? Are you there? Yes or no? April of 2023. I'm waiting your confirmation. I'm waiting your confirmation. I'm waiting for your confirmation whether you have that particular question with you. The paper for April 2023. April 2023. Yes, the question for 𝐕, 𝐶𝐈, and 𝐻𝐻. That is the question I want us to do. That is the question I want us to do. That is the question I want us to do there. Okay, so what are we told? What are we told as far as that question is concerned? So the question reads, 𝐕 Limited operate in fast-moving goods subsector. During the year which ended 31st of March 2023, 𝐕 Limited expanded its operations by acquiring a controlling interest in 𝐶𝐈 Limited and a significant influence over the activities of 𝐻𝐻 Limited. The following draft financial statements for the year basically for the year which ended 31st of March 2023 relate to 3 companies. Which are those companies? We have 𝐕, 𝐶𝐈, and 𝐻𝐻. And first of all, you're given the statement of profit or loss there. Then from there, we have the statement of financial position equally for the 3 companies, 𝐕, 𝐶𝐈, 𝐻𝐻 Limited. And then we have some additional information, number 1 all the way to note number 8. So what are we required here? Part A, we are required to prepare the consolidated statement of profit or loss. Roman 2, we are required to prepare the consolidated statement of financial position, basically as at 31st of March 2023. Now, this is basically a question for group account. If you happen to come across this particular question in an exam setup, basically we said never try to start with the workings, because if you check on the approach we're using in class, 1, we were coming up with a group structure, and then from there we were proceeding and doing some workings, and then finally we were preparing what was required by the examiner. In an examination setup, remember, you don't have the time to do that. You start with the workings, or basically you don't have the time to do the workings, and then you prepare, you proceed, or actually you proceed and prepare what is required. So it is always advisable that once you come across this particular question, first of all, come up with the group structure, because automatically you can't be able to prepare those group accounts without knowing which company is the parent, which company is the subsidiary, which company is the associate. So first of all, come up with a group structure, and then from there you will come up now with a sketch of basically what you are required to prepare. Sketch is, in other terms, is like a skeleton. So like in our case, you can see first of all, we are required to prepare the statement of a consolidated statement of profit or loss. We need to come up with a skeleton and be able to explain what is a skeleton, You also come up with a skeleton of the consolidated statement of financial position. Then from there, you'll go through the additional information, basically as you make the necessary consolidation adjustment. But it's not advisable that you start with the workings, because those workings, we say, number one, they are not marked. They will also be consuming a lot of your time. Remember, we said once you come across this question for group account, you have to do it within 40 minutes. You have to do it within 40 minutes. So therefore, the first thing we need to do here is basically we come up with a group structure. So that we know which company is the parent, which company is the subsidiary, which company is the associate. But if you can remember from the information which you're given in paragraph 1, there is some information which you're given to guide us to know which company is the parent, which company is the subsidiary, and which company is is the associate. So from the information we have in paragraph 1, from the information we have in paragraph 1, maybe we can go back to that paragraph 1 of our question, and you are told 𝐕 Limited operates in fast moving goods subsector, and then you're told during the year which ended 31st of March 2023, 𝐕 Limited expanded its operations by acquiring a controlling interest in what? In 𝐍. So this company, which is called 𝐕 Limited, we are told it expanded its operations by acquiring a controlling interest over 𝐍. So basically what that means is that this company here is the subsidiary, and basically this one would be the parent. And then you're told and a significant influence over activities of 𝐶2. So this company here acquired something called the significant influence over the activities of the company, which is called what? 𝐶2. Remember, you say that if the parent company has acquired a significant influence over the operations or basically the activities of the other, then this company here is automatically what? The associate. So therefore, this will be the parent, this will be the associate, and also that would be the subsidiary. But we need to go through the additional information. We have the specific details about the shares acquired by the parent company in 𝐍, and also in 𝐶2, and the date of acquisition. Can we go to the additional information? In the additional information number 1, you're told on 1st of July 2022, 𝐕 Limited acquired 80% ordinary shareholding in 𝐍 for a cash consideration of 1,100 million. The fair value of the asset and liabilities of 𝐍 Limited were equal to their carrying amount at the date of acquisition. So we are told this company, 𝐕, acquired 80% of the controlling interest, or basically of the ordinary shares in 𝐍, and that acquisition took place on 1st of July 2022. Automatically, that means that 𝐕 Limited would be the parent, whereas now 𝐍 Limited will be the subsidiary. You can also see we are given the date of acquisition there, 1st July of 2022. And also in that point, we are given the purchase consideration. Let's go to point number 2. Okay, so let's first of all go to point number 3. We skip point number 2. In point number 3, we are told on 1st of January 2023, 𝐕 Limited acquired that 40% ordinary shareholding in 𝐶2 for a cash consideration of 500 million. So this company, we are told, acquired 40% shareholding in 𝐶2 Limited, basically for 500 million, and the acquisition took place on 1st of January 2023. So basically that is our group structure. This group structure is very, very important when it comes to the preparation of the group account, because we know from this group structure, this is the parent, that is the company which has the responsibility to prepare the group account. This is the subsidiary, this is what? Associate. Now, if you check on what we are required to prepare, we are required, number 1, to prepare the consolidated statement of profit or loss. Now, when preparing this one, we know that we should combine the revenue and expenses, that of the parent and that of the subsidiary. The same case, expenses of the parent and those of the subsidiary. Do we take into account, or do we combine the revenue and expenses of the parent with those of the associate? With those of the associate? No. We said as far as the associate is concerned, what do we include here? We include something called the parent company share of the associate profit after tax. That's basically what you need to remember. What about preparation of the consolidated statement of financial position? This one is prepared by combining similar items of assets and liabilities, those of the parent, those of the subsidiary. In this case, do we combine the assets and liabilities of the parent with those of the associate? No. What do we include here as far as the associate is concerned? We include something called the investment in associate. Investment in what? In associate. So having that group structure, you can see it guides you in terms of how to prepare the group account. Even before you proceed now to prepare this, or basically to have a sketch of this, it is also important to determine the date these companies were acquired. Was there a company which was acquired during the current year? That is something we need to determine. If you go to the requirements, when are we required to prepare the group account? We are required to prepare the group account for the year which ended 31st of March, 2023. It basically means that this year started on 1st of April, because the next day will start 1st of April. It started 1st of April, 2022. That is the start of the year. Remember this date when we are required to prepare the what? We are required to prepare the group account, the consolidated financial statement, that is known as what? Is known as the date of consolidation, DOC. So can we check whether there was a company which was acquired during the current year? This subsidiary, you can see when it was acquired, 1st July. 1st July 2022 is automatically within this year. 1st July 2022. So it was acquired during the current year. We need to determine it was acquired how many months to the end of the year, because when preparing this one, consolidated statement of profit or loss, we said in case a subsidiary is acquired during the current year, we only take into account its results from the date it was acquired. We combine its revenue and expenses with those of the parent from the date it was acquired. This is the date of acquisition, the DOA. How many months do we have here? We have basically 6 months within 2022. From July to December of 2022, those are 6 months. What about 2023? 3 months, January, February, and March. So therefore, this subsidiary was acquired 9 months, to the end of the year. We will only take into account the revenue and expenses of SAI just for 9 months. We combine with that of the parent. What about this associate? The associate, you can see it was acquired still in course of the current year, 1st January of 2023. It was acquired 3 months to the end of the year. So what basically that means is that when computing the parent company share of the associate profit after tax, we will compute the profit after tax of the associate just for 3 months, and then we get the parent company share of that. The parent company share of that. Now, having such group structure, then we can proceed, and basically we have what? We have the sketch. Remember, I've said never start with the workings, because those workings have said that they are not marked. They will just be consuming a lot of your time. They are not what? Marked. So I want us, we start by having a sketch, not a sketch, rather we can just refer to it as a skeleton of what is required in Roman 1, the consolidated statement of profit or loss, which is for the year which ended 31st of March 2023, 31st of March 2023. So how do we prepare this one? I've said to prepare this one is quite simple. We are combining the revenue and expenses, that of the parent and that of the subsidiary. But the revenue and expenses of this company, we only take them for 9 months. We will take the revenue and expenses for the subsidiary for 9 months. Do we include the revenue and expenses of the associate here? No. We will compute something called the parent company share of the associate profit after tax. So therefore, I want us to come up with a sketch, or basically in other terms, a skeleton. So here we need to have just a single column. Our figures are in what? Are in million of shillings. So remember, when preparing this, we use the statement of profit or loss for individual companies, which is given below paragraph 1. So below paragraph 1, we take the revenue of the parent. For the parent, we are taking for the whole year. For this company, we are taking revenue and expenses just for 9 months. For 9 months, Yes. So what we can do instead of having the working here, okay, let's just have it here. So we will have 26. But in this case, remember, we are taking the revenue for this company for how many months? Just for 9 months. Who can be able to remember that? That one item which affects the group revenue. Who can be able to remember that item? Reporter, Virginia, Martha, Aaron. Which is that item? We are just here. Which is that item? Which is that item? We adjust to the group revenue. Which is that item we adjust to the group revenue? Yes? Which is that item we adjust to the group revenue? Yes? Okay, so let's move then to the other item as you remember what we said here. So then from there we take into account the cost of sales. The cost of sales we do the same. The cost of sales we do the same. Yes, I'm told by Aaron is the sales between the parent and the subsidiary. That is what we will be looking for in the additional information. So we do the same to the cost of sales. But remember, in our case, this is purely a skeleton. This is what? Purely a skeleton. A skeleton means that we can't be able to come up with the final figures because, first of all, we need to go through the additional information. We see whether there is any adjustment to be made here. So we will do the same for the other what? Items. So the cost of sales, we take that of the parent plus that of 𝐻𝐶, which is basically 14. But in this case, we multiply that with 9 all over 12. Don't cross the bracket here. Don't cross the bracket. As we go through the additional information, we will see whether there is any adjustment. So then from there, we will get the gross profit, the gross profit, the gross profit. And then to this, before we proceed to less now the expenses, before we proceed to less the expenses, we need to remember that we have an associate here. So what we need to include here is the group share of associate profit after tax. So we will go to the income statement of this associate. We take into account its profit after tax. So can we go to the income statement? Can we go to the income statement of, we go to the income statement of the associate. Let's go to the income statement of the associate. How much is the profit after tax? From the income statement of the associate, profit after tax, how much is that? Yes, so basically that is an amount of 200. Is an amount of 200. 200. So what we do, we know that this company was acquired it was acquired 3 months to the end of the year. So the parent company will only be entitled to share profit of 3 months. Is that the position? It will only be entitled to share profit of 3 months. First of all, compute profit for the associate for 3 months, and then you get the parent company share of this. The parent company share of this will be equal to 40%. 40%. And usually this is one of the items which you get free mark. This is a low-hanging fruit. So you get free mark here without any what adjustment. Mostly these do not have any adjustment. So we get the final figure here. This basically will be a quarter. A quarter will be 50, and then we get 40%. 40%. That will give us a final figure of what? We try to hurry up. I want us to do at least 2 questions on this. We get what? We get 20. Are we getting 20 here? Helen, are we getting 20? Yes. That is basically one of the 3 mark you get there. Then from there, we can proceed and we less the expenses. The first expense we will less is the distribution cost. Distribution cost. So for the distribution cost, basically, we say that this is one of the 3 marks you get in any question for group account. Anytime you come across a question for group account, we say distribution cost do not have any adjustment. So this one, we will basically get the final figure. So we take that of the parent, 300 plus that of the subsidiary, which is 200, But now what we will only do is to adjust this on, or basically to apportion that on time basis, because we are taking the revenue and expenses of the subsidiary just for 9 months, just for 9 months. And actually this is the same with the requota. The requota, that will give us what? The requota is it 150? 150 plus this, which will give us what? Which will give us 450. Anytime you come across a question for group account, remember these are all hanging fruit. These are free mark. Sasa? Yes. So then from there we proceed, we consider the administrative expenses. So for the administrative expenses, we take 500 plus now 400. But basically this one we apportion it on time basis. Recall, we say that usually this one is adjusted with the impairment loss. Was the goodwill on acquisition impaired? So in case it was impaired, we consider that here. Okay, so then from there we will get the profit from operation. The profit from operations. So that is something we will be able to compute there. And then from there we proceed and we take into account a number of items. There we have investment income. Investment income. So for the investment income, we have that of the parent, which is 40, plus that of the subsidiary, which is 20. Automatically for the subsidiary, we are not taking for the whole year. We will apportion that on time basis. Then from there, we will check whether we have any adjustment affecting this. We say what you need to check here, what you need to be very keen on here is whether any of these company, any of the investee company that is either this one or this one paid some dividends. If the subsidiary paid some dividends or the associate paid some dividends, so some of the dividends paid or some of the dividends were automatically paid to the parent. For example, the dividends paid by this, 80% were paid to the parent. If this company paid dividends, 40% of the dividends were paid to the parent. The parent company go ahead and account for that as an investment income. But we say, as far as the group is concerned, that is a fake income because that is an income within the group. We say such dividends the parent company received from the subsidiary or associate and which the parent company accounted for as an investment income, we don't include it here. So that is something we will be checking for. Were there some dividends paid by the subsidiary or the associate? Yes. And then from there, we have the finance cost. The finance cost. The finance cost, we do the same. We take that of the parent plus that of the subsidiary, which is 60. But this one, we apportion it on time basis. We will see whether we have any adjustments. And then from there, we will proceed and we get the profit before what? Before tax. So, and then to this, we less the income tax expense. Now, the income tax expense, this is also another free mark. This is also another free what? Mark. Another free mark. Sasa? Yes. So, how do we compute this one? We will take the tax of the parent, which is 180, plus that of who? Of 𝐻𝐍, which is basically 160, but basically we apportion this on time what? Basis. This one do not have any adjustment. Is a raw hanging fruit. Raw hanging fruit. So this one will be 3/4. The 3/4, which will basically be 4120. And that is how much? That is 300. 300. And basically we will get the profit after what? After tax. The profit after a tax. So basically this particular question, even without having gone to the additional information, is a question you should be able to get some free marks here. Some free marks. Remember, in most of these particular questions for group accounts, how are they marked? You can see like the marks are allocated, there were 8. Mostly this is how the questions are marked. For any correct entry which you get here, mostly will be allocated 2 marks. For any correct entry which you have here, you are allocated how many marks? 2 marks. So it basically means that you need 4 ticks here, 4 correct items. So if you get 4 correct items, you get all the marks. So having now assuming this, or basically assuming this how the question was marked, it basically means that we already have how many marks? We already have 6 marks out of 8. We have not done any working. So those are basically some free marks. There is something we said you should always, or this particular item here that is revenue, you should also get that free mark because this one is only affected or adjusted with the sales between who? The parent and the subsidiary. That is the scale. Now, before we go to the additional information to check whether we have some adjustment to some of these items, we need also to come up with a skeleton of what is required in part B. So let's go to part B. We come up with what? We come up with a skeleton for that. So that is basically part B of the question, the consolidated statement of financial position. Consolidated statement of financial position as at 31st of March 2023, 31st of March 2023, 31st of March 2023. So here we start with the non-current assets. Non-current assets. So for the non-current assets, I think we have a number of themes there. And basically here we just need to have a single column. So remember here we want to come up with a sketch. And basically from the group structure which we have here, we know that we are combining similar items of assets and liabilities, both of the parent and those of who? Of the subsidiary. We are not including the asset and liabilities of who? Of the associate. That is 2-2. So let's go to the statement of financial position which is given for the individual company. So we have the PP. Basically, we will add the PP of the parent, 2070, and then 12.90. Now, there are two important points I want to mention here. Two important points, and basically those are some of the areas majority of the students get it wrong. One, when preparing this consolidated statement of financial position, even if the subsidiary was acquired in course of the current year, we don't apportion the assets and liabilities of the subsidiary on time basis, because I've seen in the past, when the students are preparing this, they will take the asset, for example, of the subsidiary, that is high, they apportion that on time basis. That is very wrong, because a statement of financial position is always prepared as at the end of the year. Never apportion the assets and liabilities on time basis. Number two, when taking into account the assets and liabilities of the subsidiary, we take the full amount. I've seen in the past whereby whenever the students are taking the assets and liabilities of SAI, for example, this one, the PP of SAI, they multiply that with 80%. That is also a very big mistake you can make. So never make those two mistakes. Never apportion the assets and liabilities of the subsidiary on time basis. Even if the subsidiary is acquired 2 months or even 1 month to the end of the year, take the full amount. Number two, never multiply the assets and liabilities of the subsidiary with the parent company shareholding in what? In the subsidiary. Take the full amount of what? Assets and liabilities of the subsidiary, and then you combine with those of who? Of the subsidiary, with those of the parent. So we leave the bracket open because we need to go through the additional information. We see whether there is any adjustment which is required here. Then from there, we have the investment. Investment, we will do the same. We will take 16 plus a 0, which is basically that of the subsidiary. And then in this case, remember, we may be required to compute the goodwill on acquisition of our subsidiary, and we recognize it here as an asset. In relation to this company that is 2-2, we compute something called the investment in associate. The investment in associate, that is what we recognize there. So, yes. So then from there, we will go to where we have current assets. Current asset, we take the inventory. We will take the inventory of the parent, 530, plus the inventory of who? Of SAI, which is basically 390. And then from there, you have to remember which adjustment is made to the inventory. Usually the adjustment affecting this is the unrealized profit or maybe the goods in transit. Those are the two items you'll be looking for in the additional information. Then from there, we have the trade receivables. Trade receivables, we take that of the parent, 640 plus 470. And then to this, we will check in the additional information whether we have any amount of intercompany debt. So below that, we have something called the financial asset. at fair value through profit and loss. This is basically abbreviated as FVTPL. So this one is a short-term investment. In mostly these one do not have any adjustment. Once you come across this, in the question for group account, these do not have any adjustment. So we just get the final figure here, which basically will be what? Will be 450. So then below that, we have the cash and bank balance. Cash and bank balance. So for the cash and bank balance, usually this one is adjusted with something called the cash in transit. Cash in what? Transit. So, but first of all, we add the cash and bank balance of the parent plus that of the subsidiary. We will see whether we have any cash in what? In transit. Then from there, we proceed and record equity. Equity. So for the equity, we start with what? We start with ordinary share capital. And remember, in this case, for the ordinary share capital, we only record the ordinary share capital of the parent. The ordinary share capital of the parent. And actually, we say that the ordinary share capital of the parent remain the same unless the parent company acquired the subsidiary and paid the purchase consideration through issue of shares or through something called the share exchange consideration. So we will take the ordinary share capital of the parent, which is basically 25. But if you can be able to remember in the additional information number one, when the parent company acquired 80% shareholding in 𝐍, the parent company paid the purchase consideration in cash. So we don't have share exchange consideration. If we don't have share exchange consideration, this share capital of the parent company will not be having any adjustment. So below the share capital, what do we have? We have the share premium. The share premium here, we only include that of the parent company. So the share premium of the parent is what? Is 500. So then below that, we have what? We have the retained profit. So basically retained profit, this is basically we said is one of the items I will not advise you to compute. I will not advise you to compute this one in an exam. So therefore, this one, don't bother yourself computing that. Just leave it as blank. Just leave it as blank. And then below that, we will get the total, or basically we will get the total equity. The total equity here. And basically, after getting the total equity, we will proceed. And basically, we compute something called the non-controlling interest. Then the non-controlling interest, we will be able to see whether we can be able to compute that. And then from there, we proceed and we compute what? Or actually, we record the non-current liabilities. So for the non-current liabilities, basically we have two there. So one, we have the 12%, that is 12.5. Okay, so let's continue. I don't know what happened with my Zoom. It just went off, but I hope now you can hear me. Okay, so let's proceed. So basically, yes, Aaron Molimu is back. I'm back now. I hope you can hear me, Aaron. Is that the position? Can you hear me, Martha, Helen? Okay, yes. So in this case, I've said for the non-current liabilities, we will take the 12.5% raw notes of the parent. Remember, this is an item of liability. So being an item of liability, we will combine that of the parent and that of the subsidiary. So we have 640, and then we have what? 480. So in most of these particular items, we said they will not have an adjustment, but maybe we leave the bracket open, we will see. Then from there, I want us to proceed. We record the other item. So I need to create some space up here. So I'll do away with this. One so that I create space. So Mother is asking about equity. So basically, I've said for equity, that is the share capital. The share capital, we only record that of the parent. That of the parent company only. So, and this one will remain the same unless there was something called a share exchange consideration. Share exchange consideration is whereby the parent company acquires a subsidiary and basically pay the purchase consideration through issuing its own shares. So if you check on the information you have in note 1, so the purchase consideration here was in cash. So if it was in cash, the share capital and also the share premium remain the same. But I think there are some questions we did in class, Mother, check on those videos, whereby the parent company acquired the subsidiary and paid the purchase consideration by issue of shares. If the purchase consideration, we don't have share exchange consideration, then these ordinary share capital, share premium, those are free marks. Those are free what? Free marks. Sasa? Yes. So the other item of non-current liability, I hope that is clear. The other item of non-current liability is deferred tax. Remember, we said in this question for group account, this is very, very important. In this question for group account, anytime you come across a component for tax, be it in the income statement, be it in the statement of financial position, that is a free mark. That is a free mark. Like this one, deferred tax, we will take the deferred tax of the parent, which is 260, plus that of the subsidiary, 100. You can proceed, you record the final figure. No single question for group account you will come across and tax is to be adjusted. Be it the tax in the income statement, be it the tax in the statement of financial position. Finally, we record the current liabilities. For the current liabilities, we have the trade payables. The trade payables, we take that of the parent for 20, plus that of the subsidiary 330. So this one may be adjusted with the goods in transit, the intercompany debt. Then I can see another component of tax. Once I see any component of tax, these are free mark. 160 plus what? Plus 90. So this basically will give us what? That will give us 250. And basically, in our case, we are done with coming up with a skeleton. And basically, you can see in our skeleton here, we already have some final figures here. We already have some final figures here. Equally, what I've said is that if you check how these questions for group accounts are marked, even here, you'll be given 2 marks for any correct entry. Like the marks allocated here were 12. It basically means that you need to get like 6 correct entries. Any correct entry, you are given 2 marks. So mean that if this is how the question is marked, that for every correct entry, you're given 2 marks. How many correct entries do we have here? 1, 2, 3, 4, 5. So it basically means that even without having gone to the additional information, that is a question you already have. How many marks? 10 marks. How many marks do you have here? 6. It basically means that even if you decide to leave that question at that point, you already have your 16 marks. You already have your 16 marks. So therefore, can you identify those areas whereby you get low-hanging fruit? Those areas whereby you get 3 marks. This is now what will save you. This is what will save you in this particular question for group account. Now, having come up with this particular skeleton, and basically you should do this in an exam, you should not, basically to come up with this skeleton, it should not take more than 15 minutes. Make sure you leave the remaining, much of the time, around 25 minutes to deal with the additional information. To deal with the additional what? Information. Once you see such a question for group account, the first thing you need to do very fast, come up with this group structure. So once you have that group structure, this is basically what is to guide you in terms of how to prepare this. How do you prepare the consolidated statement of profit or loss? You already know these are parent, these are subsidiary. It was acquired 9 months. You will come here and you combine the revenue of the parent, the revenue of the subsidiary, but for this one, take into account it was acquired 6 months. Sorry, 9 months to the end of the year, you will only take into account its revenue and expenses for how many months? 9. Because we also have an associate, you will include the parent company share of its profit after tax. And then you do the same here. So let's go through the additional information. We see which items need to be adjusted. Number 1, we are given information about the acquisition of 𝐎𝐍 Limited, where we are told it was acquired 1st July, the parent company acquired 80%, and there was a cash consideration of 1,100. Now, this cash consideration, which was paid by the parent company, this one is accounted for by the parent company by debiting the investment, crediting bank. And therefore, if you can be able to recall, in the balance sheet of the parent, we had this investment. You see this investment include that purchase consideration, that amount of money which was invested in the subsidiary. Should we include that amount here? No. So that 11, which is basically part of this, we need to rest it here because this one we use it in the computation of this goodwill. So the amount of money which the parent company invested in the subsidiary should not be included here. So we rest it there. We will use that amount in computation of goodwill. Number 2, we are told the group policy is to measure and controlling interest at their proportionate share of the net asset of the subsidiary at the date of acquisition. So this is to help you to know the method to be used in the computation of goodwill. So if you come across that information, which method are we supposed to use in computing the goodwill on acquisition of the subsidiary? Are we supposed to use the full or the partial? The full or the partial? Yes, in this case, we will use the partial goodwill method. In the computation of goodwill, we will use the partial goodwill method. So let's move to point number 3. And in that point, you're given information about the acquisition of Tutu. Sasa, yes. So, and equally in that case, we are told on 1st January 2023, 𝐕 Limited acquired 40% ordinary shareholding in Tutu for a cash consideration of 500. Now, this cash consideration, which was paid by the parent in acquiring 40% shareholding in Tutu, is also part of this. Do we include that amount here? No. So we also need to less that 500 here. This 500, we are going to use it in computing this investment in associate. We are going to use that 500. And therefore, if you work out this 16 minus 11 minus this, you can see that by the end of the day, it will give us 0. It will give us what? 0. So therefore, that 1600 included or accounted for by the parent company as an investment. This is the amount the parent company invested in both the subsidiary and also associate. So let's move to point number 4. And you're told during the post-acquisition period, 𝐕 Limited, which basically is our parent, sold goods to 𝐓𝐍 for 300 million, for shillings 300 million. Now, this is what we refer as intra-group trading. Intra-group trading, that one is adjusted here from the group revenue and also from the group cost of sales. So we left that amount here. We left that amount here from the group revenue and the group cost of sales. So we left it here from the group revenue and the group cost of sales. And actually, we say that is the only adjustment which affects the group revenue. So mean that for the group revenue, we can close the bracket and we get the final figure. Can you give me the final figure for the group revenue? Because we say that's the only adjustment which affects the group revenue. So what do we get here? We first of all work out this one, which will give us 1950 plus 4190 minus 300. And I'm getting 58 what? 40. 5840. I hope that is the figure you're getting. We try to arrange so that we look on a different one, a different question. Is that what you're getting? Yes, yes. So then from there we move back to point number 4, and we are told 𝐕 Limited reported a 20% profit margin on these sales, and then you're told half of these goods remained in the ending inventory of 𝐕 Limited at the end of the year. So we are told this company, 𝐕, sold some goods to 𝐓𝐍, but basically some of the goods were not yet sold at the end of the year. So if that is the position, remember we say that what we need to do is to compute something called the unrealized profit on inventory. The unrealized profit on inventory. How do we compute this unrealized profit? We said we take the gross profit margin, gross profit margin, and then we multiply that with the unsold goods. The unsold goods are the goods which remained in the ending inventory, the goods which were not yet sold at the end of the of the year. So in our case, we are given the gross profit margin, which is basically 20%. And then you're told the goods which were not yet sold were half. Half of what? Should be half of these goods which were sold by refer to sign, half of 300 million. So this now will give us the realized profit. So 20% of 150, and this will give us what? Is it 30? Is it 30? Is that 30? 0.2 times what? Times 150? Yes. So that will give us 30. So which items are adjusted with this? So one, we said this and this profit, we less it from the group inventory. So this one, we less it from the group inventory, this one, 30. And number two, we add it to the group cost of sales. So we add it here to the group cost of sales. We add it to the group cost of sales. So these are some of the key consolidation adjustments we said you should be able to deal with. You should be able to deal with. So then we move to point number 5. Let's move to point number 5. And we are told, included in the trade receivables of 𝐕𝐻, was an amount of 80 million due from 𝐓𝐶. And then you're told in the books of 𝐓𝐶, the amount due to 𝐕𝐻 was shown as 60 million because 𝐓𝐶 Limited had remitted 20 million. But 𝐕𝐻 Limited had not recorded the remittance. So basically, this amount of intercompany debt, which is not the same. And we said if the amount of intercompany debt is not the same, then we have something called the cash in transit. Maybe you can just come here and you summarize that. So we are told included in the receivables of this is an amount of 80 million. That's what we are told. We are told included in the receivables of 𝐕𝐻 is 80. The receivables of this included 80, the amount it was expecting to receive from 𝐓𝐶. But now, in the trade payables or in the books of 𝐓𝐶, the amount included there was 60 million. So automatically that is included within the payables of this. And we are told, you can see the amount of intercompany debt is not the same. The difference is 20 million. So this 20 million is known as cash in transit. Now we said once you come across that amount of intercompany debt which is not the same, don't even, here we say don't even bother cramming anything. We said always the amount which is more. Like in our case, 80 million, this one will be deducted from the group receivables. From the receivables, we less 80, and then this cash in transit, 20, this one should be added to the group bank and cash balance, or to the group cash and bank balance. So here we add the cash in transit of 20, and then from the group payables, we less the amount which is this amount of 60. From the yes. Okay, I don't know what is happening with my video. It keep on going on and off, on and off, on and off. I don't know what is the issue from my side. Yes. But basically that is the treatment, that 80 we raised it from the receivables, 60 we raised it from the payables here. And then these 20 I've said that we added to the group cash and bank balance. That is the adjustment which we make for such amount of intercompany debt, which is not the same. So then from there we have the other point, number 6. And I think point number 6 was the one which was just tricky one, because you can see all the others are quite simple. Quite what? Simple. Quite simple. Quite simple. So that is the adjustment, Juliet. So you just need to understand what is included within the receivables of this. It is 80. What is included within the payables of that? It is 60. So the amount of intercompany debt is not the same. The difference, which is basically 20, is the cash in transit. Cash in transit added to the group cash and bank balance. This 80, which is included within the payables, you less it from the which is included within the receivables, you deduct it from the receivables, and the amount of 60, which is included within the payables, less it from the payables, because that amount of intercompany debt we said is a fake debt. It should always be deducted from the group receivables and the group what? Payable. So we are done with that one. So number 6, we are told on 1st of October 2022, 𝐉𝐎𝐈𝐍 Limited sold an assembly plant to 𝐓𝐶 for 400 million, reporting 25% profit margin on the selling price and netted off the profit against the cost of sales. Now, this is what we refer as intra-group sale of assets. Intra-group sale of assets. Now, we said as far as the sale of assets between the parent and the subsidiary is concerned, we make 2 adjustments. One, compute the amount of unreleased profit. How much was the amount of unreleased profit? That unreleased profit, we less it from the group in the group PP. Number 2, you compute something called the depreciation overcharge. That depreciation overcharge, number 1, we said you add it to the group PP, and number 2, you deduct it from the group cost of sales. From the group cost of sales. So before we do that, let's go back to that information specifically. What we see what you're told in the last sentence. We are told the group charges depreciation on plant at the rate of 20% per annum on cost on full year basis in the year of asset purchase and none in the year of disposal. And none in the year of what? Of disposal. So what we need to do, as far as that point is concerned, we need to compute 2 items. We need to compute 2 items. We need to compute 2 items. 2 items. 1, we need to compute the amount of unreleased profit. So because we said anytime that, for example, the parent company sell an asset to the subsidiary, the parent company make a profit. But basically that asset which is sold to the subsidiary, will it be sold to third parties? No. So therefore, the profit which was made by the parent will be unreleased. So compute how much profit was made by the selling company, and that profit will automatically be unreleased. So how do we compute this one? We take the gross profit margin times the selling price, times the selling price of the asset. So in our case, we are given the gross profit margin, which you are told is 25% of the selling price. The asset was sold at how much? The asset was sold at 400 million. So this will give us 100 million. So this 100 million one, we said we less it from the group PP. We less it from the group PP. Number 2, we compute something called the depreciation overcharge. The depreciation overcharge. So this depreciation overcharge is computed based on this unrealized profit. We take the unrealized profit, you multiply that with the depreciation rate. This asset is depreciated at which rate? The unrealized profit is 100 times the depreciation rate, which in note number 6, we are told is 20%. And this will give us 20 million. So this 20 million, which is a depreciation overcharge for the current year, 2 adjustments. 1, we add it here. We add it back here because the depreciation which was deducted in arriving at this value was more. So add it to the group PP. Number 2, that depreciation overcharge, we also deducted from the group cost of sales. From the group cost of what? Of sales. So that is the adjustment which is made as far as the intra-group sale of assets is what is concerned. And I think there is another question which we did similar to this one. There is another question which we did where there was a transaction for the sale of asset. For the sale of what? Asset. For the sale of asset. So you need to remember those 2 adjustments. Compute the unreleased profit, which you left from the group PP, then compute the unreleased profit, which you add here, and also you less it from the group cost of sales. So we are done with that particular point. Number 7, you're told the impairment test carried out on 31st of March 2023, that is at the end of the year, revealed that neither the goodwill on acquisition nor the investment in associate had been impaired. It basically means that during the current year, there was no any impairment loss. So if there was not any impairment loss, it basically means that this value here will not be having any adjustment, because the only adjustment which we make to the administrative expense is that we add the impairment loss on goodwill. The impairment loss on goodwill. And basically we are told that one is 0. So no adjustment. In fact, this one, we can just get the final value. The final value, this will be 300 plus this, and that will give us what? That will give us 800. That will give us 800. Then, also in point number 8, we are told none of the group companies paid dividends during the current year. So this company did not pay dividends. This company equally did not pay dividends. Why are you given that information in note number 8? The reason why you're given that information in note number 8 is basically for you to know that this investment income by the parent company is an investment income received outside the group. Received outside the group. Because I say, if, for example, this company paid some dividends, some of the dividends were paid to the parent company account for that as an investment income. So therefore, this investment income by the parent is basically received outside the group. So we need to cross the bracket, and basically we get the final value for this. So this will give us what? These are the 3/4. Basically, this will give us 15, and that will give us 55. 55. So it basically means that also for the finance cost, we don't have any adjustments. We can get the final value. The final value, this will be what? This will be 45 plus this one, which will give us 125. Remember, finance cost is basically an expense. Investment income is an income recorded here as a positive. This one recorded as a negative. Yes. And I think in our case, we are done. 2 items are remaining to be computed: the goodwill and basically what? The investment in associates. So mean that we can be able to come back here and we get now the final values. Can we do that? Can we do that? Can we do that? Yes. So I want us to get the final value for the cost of sales here. For the cost of sales, so I will take 14 times 9 all over 12, which will give us then 20 plus 2730 minus 300 plus 30 minus 20. And in this case, I'm getting a final figure here of 3490. 3490. I hope that is the figure you're getting. Please confirm whether you're getting that value. So, and then we compute the cost, the gross profit. The gross profit, though, even in an examination setup, I will not even advise you to compute some of these items. You see, the gross profit is not basically marked. What will be marked here is this one. You see, if that figure is correct and this one is correct, so this is not marked because you get this after taking this minus that. Any figure which you get after adding or after deducting, the same case here with the total assets, these figures are not marked. Sasa, yes, what will be marked is that and that. So in an exam, we not even advise you to bother yourself computing some of these items. They are not marked. So what will be marked is that and that. This, and this, and that. You can, in fact, decide to leave your question at that point. Don't bother yourself computing akina gross profit, akina profit from operation, akina profit before tax, profit after tax. Don't bother yourself computing that. So what would basically be marked are those particular what? Entries there. That's huh? Yes. Now we do the same. We do the same. We come back here, but there are 2 items we will come and compute there: the goodwill and also the investment in associate. So can we get the final figure for the PPE? Let's get the final figure for the PPE. So we have 2070 plus 1290 minus 100 plus 20. So that will give us 3280. So those 2 items, goodwill and also investment in associate, we will compute those. So we get the final figure for these items of current assets. So we have 530 plus 390 minus 30. So this will give us 890, and I hope you are getting the same values. I hope you're getting the same values as mine there. Are you getting the same values? Are you getting the same values? Are you getting the same values? Yes. So what about the receivables? The receivables, we have 640 plus 470 minus 80. Basically, this will give us 1030. We already have the final figure for financial asset at fair value through profit and loss. What about the cash and bank balance? This is the 560, 580. Don't bother yourself adding the total asset. Nobody will come and mark for you the total asset. That is basically, if you decide to compute that, you'll be wasting your time there. So there are some items we said here, don't bother yourself computing, like the group retained earnings. Even this one ends here, just ignore that. No adjustment for this. We can get the final figure here as 640 plus 480, which will give us 1120. 1120. Deferred tax, that one we said is a free mark. I think what is remaining to be computed there is what? Is trade payables. 420 plus 330 minus 60. Minus 60. Minus 60. So we have what? We have 690. Now, if that question you decide to leave it at that point, you will be having all the marks. You'll be having 20 out of 20. And you can see there are a number of items which you have not managed to compute here. But basically, because if you can be able to remember most of the questions we did, the examiner was requiring the computation of goodwill and also investment in associate. So I want to show you how we compute these two items, goodwill on acquisition of 𝐍 and also the investment in associate. So let's start by computing the goodwill on acquisition of the subsidiary. Because we say that is a key item, you should be in a position to compute that. You may be required to compute that in a question, and maybe you're given like 4 marks or even 6 marks. So let's compute the goodwill. The goodwill on acquisition of who? The goodwill on acquisition of 𝐍 Limited. Now remember, as per the information which are given in note number 2, this goodwill will be computed using the partial goodwill method. So this one will be computed using the partial goodwill what? The partial goodwill method. The partial goodwill method. So under the partial goodwill method, we compute this by taking the purchase consideration. The purchase consideration which was paid by the parent company. And the purchase consideration paid by the parent company, this one we have it in note number 1. Note 1. So in note number 1, when the parent company, that is 𝐷IFA, acquired 80% ordinary shareholding in 𝐍, the parent company paid a cash consideration of 1,100 million. So that is the purchase consideration paid by who? By the parent. So in this case, we proceed and we less the fair value of net assets which were acquired. The fair value of the net assets which were acquired. Fair value of the net assets which were acquired. So how do we compute this? Because this is something which the examiner will not have given you. We say to compute the fair value of the subsidiary company net asset on the date of acquisition, on DOA, date of acquisition. We take the ordinary share capital of the subsidiary plus the pre-acquisition reserves. Plus the pre-acquisition what? Reserves. So therefore, the first thing we consider here, we will go to the balance sheet of this company, the statement of financial position of 𝐍, specifically under equity. So can we go there? And we take into account the ordinary share capital. The ordinary share capital. What is the ordinary share capital of 𝐍? The ordinary share capital of 𝐍. The ordinary share capital of 𝐍 is basically an amount of what? Is an amount of 500. And then below that, even before we move away from equity, I can see we have share premium. So in this case, I said that anytime you're given share premium in the balance sheet of the subsidiary, if the question is hidden, that one is always treated as pre-acquisition. So that share premium, because there is no any information which are given, That one is always taken to be pre-acquisition. Then from there, we also need to take into account the retained earnings. And basically the retained earnings which we take here, which we take into account here, is not the retained earnings we have in the statement of financial position and equity, but we take the retained earnings of 𝐍 on the date of acquisition. On the date of acquisition. And there is something I said, in case a subsidiary was acquired during the current year, the examiner basically will not give you its retained earnings on the date of acquisition. You have to compute that. Remember, this company here that is 𝐍, when was it acquired? I hope you can remember, it was acquired 9 months to the end of the year. So if it was acquired 9 months to the end of the year, in other terms, you can say it was acquired 3 months from the start of the current year. So what we need to do is basically to compute its retained earnings here. Its retained earnings on the date of acquisition, which you are not given. How do we compute the retained earnings of 𝐍 on the date of acquisition? So we go to the balance sheet of 𝐍 specifically under equity. Can we go back to the balance sheet of this company under equity? So we are given the retained earnings of 𝐍 at the end of the year. So the retained earnings we have in the balance sheet of 𝐍, which is basically 800. That is the retained earnings at the end of the year. Yes. How do we get these retained earnings at the end of the year? We take the retained earnings at the start, which we don't have, and basically we add the profit for this year, the profit after tax. So the profit after tax for 𝐍, that is something we have in the income statement of 𝐍. Can we go to the income statement of 𝐍? Income statement of 𝐍. How much is the profit for the year for 𝐍? The profit for the year for 𝐍 is how much? Profit for the year for 𝐍. Can you see that from the income statement? From the income statement, what is the profit for the year for 𝐍? Give me the answer. Give me the answer there. Give me the answer. Yes, that one is 400. That one is 400. That one is 400. So in arriving at this, we take the retained earnings at the start plus this, we get this. So remember, in our case, we don't have the retained earnings at the start. Can we be able to get this one? Yes, because we know in getting this, we take this plus this, we get that. So we can be able to get this. We will take this minus this, we get this as what? As 400. So therefore, what we are interested with is the retained earnings on the date of acquisition, this date here. How do we compute that one? Very simple. We take the retained earnings at the start, which is 400. And then we know that this is the profit for the whole year, 400. So, but in our case, we need to compute how much profit was made for these 3 months. So that once we take this plus the profit for these 3 months, that will give us the retained earnings on that what date. So we will take the profit for the whole year, which is 400. We first of all divide that with 12 to get the profit per month, and then we multiply that with 3 months. 3 months from this date to that date. So that is basically how we compute the retained earnings of a subsidiary which has been acquired during the current year. That is something which the examiner will not have given you. If you check on the other question we did in class, that's how we were able to compute that. So this will give us a quarter, which will give us 500. 500. 500. So the retained earnings of 𝐍 on the date of acquisition was 500. Was 500. So there is something we also said we need to check here, whether on the date of acquisition, the subsidiary company revalued the assets. If it revalued the asset, was there a revaluation gain? I hope you can be able to remember what you were told in note number 1. Note number 1, the last sentence. Note number 1, the last sentence. We are told the fair value of assets and liabilities of 𝐍 were equal to the carrying amount at the date of acquisition. So 𝐍 Limited, the subsidiary, revalued the asset, but you're told the fair value and the carrying amount of its asset were equal. So it means that there was no revaluation gain, no revaluation loss. So there was no any revaluation gain on the date of acquisition. So then we get this total, which will give us an amount of 1,200. And because in our case we are using the partial goodwill method, we're interested with the net asset acquired by the parent. The net asset acquired by the parent will be equal to 80%. 80% of this, and basically that will give us what? That will give us 960. 960. So we left that from the figure we have up there, and basically we get the difference now, which will be the goodwill. So how much will be our goodwill here? The difference between 960 and 1100. The goodwill is it 140? Yes, 140. 140. And then remember, we are told that this particular goodwill, as per note number 7, that goodwill is not impaired. The goodwill is not what? Impaired. So that is the final figure we record here, 140. The goodwill is not what? Impaired. The goodwill is not impaired. Then finally, we compute this one. And the basically computation of investment in associate, this one is quite simple, especially whereby an associate was acquired during the current year. How do we compute this one? How do we compute this one? One, we said we take the cost of investment. How much purchase consideration was paid by the parent company in acquiring 40% shares in Tutu? That is something we have in note number 3. And the purchase consideration which was paid was 500. Note number 3. Note number 3. And then now to this we add the group share or the parent company share of Tutu Limited profit after tax. That is something we have computed here. You see this one? This is the parent company share of Tutu Limited profit after tax. So we add it here. And then to that, we less any impairment loss. So this investment in associates, was it impaired? If you go to note number 7, we are told impairment is carried out at the end of the year revealed that neither the goodwill on acquisition nor the investment in associate had been impaired. So this investment in associate had not impaired. So there is no any impairment loss. So that will give us what? That will give us 520. So these are two items you must be in a position to compute, because once you come across a question for group account, if you check on some of the questions we did in class, specifically the examiner may require to compute the goodwill on acquisition, the investment in associate, you are given like 4 marks, 3 marks, or even 6 marks for computing that. Those are two items you should be in a position to do what? To compute. You should be in a position to compute. And basically that is it. That what was required in that question for 𝐉𝐎, 𝐍, and Tutu. A very good question on group account. Very good question on group account. So basically what we said is that as far as this question for group accounts are concerned, there are those key consolidation adjustments you must be in a position to deal with. Like one, you should be in a position to compute the goodwill using the full goodwill method and the partial goodwill method. Then from there, we said you must be in a position to compute the unleased profit on unsold inventory. Number 2, you should be able to compute the depreciation under charge in case of fair value adjustment. You should also be in a position to compute depreciation overcharge in case of sale of assets between the parent and who? The subsidiary, and also how to deal with the amount of intercompany debt, which is the same and also which is not the same. And I think the other key consolidation adjustment was on what? Because I think we talked about 5. So I think the last one is goods in transit, which you say is not that common, but basically make sure you can be able to deal with the goods in what? In transit, the goods in transit. So if you're able to do that and also you're able to use this particular approach, then this will save you a lot. This will save you a lot. And also to know, where do you get 3 marks? Where do you get 3 marks? I've said, for example, once you come across this question you come across a question for group accounts and you're required to prepare this, provided you're able to come up with a group structure, then we have said that these, like 3 items here, you should be able to get 3 marks. 3 marks. the group revenue, because this one is only adjusted with the sales between the parent and who? The subsidiary. Make sure you get that correct. Distribution cost, no adjustment. That is also a free mark. And also the income tax. Those three items, those are free hanging fruits. Those are free marks. Those are free what? Marks. Then when it comes to preparation of this, can you also be able to know where to get some free marks? Other than being able to deal with those key consolidation adjustments, also be in a position to know where to get some free marks, because that will save you a lot. Will save you a lot. We have said, especially once you see something like the deferred tax, the current tax, just know that those are free marks. Those are free what? Free marks. Those are the marks basically which by the end of the day will be able to save you in this particular what? Question. So know those areas whereby you get those free marks. Also, this approach which I've showed you is what you need to use, because having marked this paper for a number of sittings, I know some of the common mistakes majority of the students make and which makes them to fail. You'll see some students doing such a question for group accountants. They'll start by doing workings, 2 pages, just working. Page 1, page 2, they are doing workings. The person who is marking your paper will not be interested with those workings. Once you start with the workings, you just be putting one cross line. He's interested with this. Were you able to prepare the consolidated statement of profit or loss? If yes, have you gotten any correct entry here? He will not even be interested with where you got those workings, how you computed those values. He'll just be checking this. He'll just be checking these final values. The same case here. The person who is marking your paper will just be interested with those particular what? Those final figures. Not how you arrived at that figure, not the working, but the final figure. Just like what I said in relation to ratios. These are the final figures these are the figures which will earn you the marks, not the workings, not these workings. Sasa, the final figure there. Sasa, yes, if you're able to know that, and if you perfect, you are able to deal with those key consolidation adjustments as far as this topic for group account is concerned, then be assured that this is a question which should be able to give you more than 15 marks. Yes, so those are basically the points you need to note down. Those are the points you need to do what? Are to note down. As you revise, or actually as we revise here, those points are very, very what? Very, very important. Very, very what? Important. Yes. Basically, you can see we can't be able to do another question, but I want us still in our next class. In our next class, we still revise another question for group accounts. So therefore, you can still go back to that topic, the topic of group accounts. You still revise on it. I think once we meet in our next class, we will still do another question on this, or maybe two, if time will be on our side. So because remember, I say that this topic is a sure bet. We are 100% it will be there. It will be there. In the exam we'll be sitting for, in 3 weeks' time, you will come across a question for group account. And therefore, you need to prepare well. You need to perfect on that topic, such that once you come across a question from this topic, make sure you get more than 15 marks. Make sure you get more than 15 marks, or even 20 out of 20. Because if, for example, you're able to get like 18 marks in just one question, 18 marks, then you just need to get 32 marks for you to pass that paper. So out of the remaining 4 questions, you need how many marks? 32 marks for you to pass what? That paper. So this topic is very important. Very, very important. Take into account is a topic we are 100% sure it will be tested. Yes, yes. So for today, I think we're going to stop at that point. We can't be able to do another question. I can see we have like 10 minutes because we usually end our classes at 3:40 or maybe 3:45. So let's just stop at that point for today. Make sure you also try to look on the topic again. Once we meet in our next class, that is on Tuesday, we will do another question on maybe 2 on this topic, and then we proceed to revising other topics. So I don't know whether there is any question, and equally I hope you have learned a lot as far as today's class is concerned. Any question? Any question before we wind up? Aaron, is there any question, Helen? we have any question, John? Do we have any question, Juliet? Virginia, Zipporah, Martha, any question? Hidden reserves. Reserves is basically general. Retained earnings is a reserve. Share premium is a reserve. Revaluation gain is a reserve. Which reserve specifically are you asking? Reserves is a general term. Which reserves? Yes, which reserve? Okay, sawa. So we stop at that point for today. We continue from there next week on Tuesday. So have a nice afternoon. See you next week. Yes, so today I want us to continue with our discussion still at the management accounting by looking on how we prepare budget. And we're going to start by looking on how we prepare the first budget, which is a cash budget. Cash budget is very, very simple because we know that a cash budget is basically prepared to show the expected receipt of money, to show the money which is expected to be received by the company, and also to show the expected expenses to be paid. In other terms, we prepare a cash budget to show the cash inflows, the amount of cash which will flow into the business, and also the cash outflow, the cash which will flow out of what? Of the business. So, and I think I'll be able to remind you in terms of the format for doing that. But equally, I hope you can be able to recall something you did in relation to the cash word budget. So therefore, I want us to just go straight to a question, but maybe I'll be able to share something more, something small in relation to this, maybe just to remind you what is a cash budget and maybe how do we prepare the same. But let's just go straight to the question because I think by preparing, doing a question on cash budget, basically we'll be able to recall how do we prepare these cash budget. Now we have this question which was examined in December of 2024. It was basically question number 23. Remember, section 2, we said it has 3 questions. Question 21 coming from FR, question 22 coming from FM, and question 23 coming from me. So this was the question number 23, and basically it was a question on what? On the cash budget. Now, before we prepare this cash budget, I want us to go through this information which we have here, and we see what we are told. We see what we are told. So we are told that Elimu Busara Foundation runs a group of secondary schools in the country. Among their schools is Masomo Bora High School. The schools are funded by the school fees and partially sponsored by capitation from the government and donation from alumni and well-wishers. So Masomo Bora High School is preparing the budget for the year 2025 with the 3 terms commencing January, May, and September. So it is important for you to note those dates when each of the term is commencing. The first term commencing in January, the other one in May, the other one in what? September. And then you're told the following details related to the budget preparation. Number one, you're told the school estimate it will have 120 students in Form 1, 110 students in Form 2, 100 students in Form 3, and 100 students in Form 4. The Form 1 will report in February of 2025. So Form 1 will not report at the start of first term. I hope you can recall first term start on January. So Form 1 will report in Feb. And then you're told the following is the fees structure that is payable by the parent per term. So you're given the fees which is payable by the parent or having student in Form 1. Form 1, there are some details I'll be able to do away with here. Basically, these are details which I added. They should not be part of the question. So the fees payable per term by Form 1 parent is 33,500, Form 2 36,500, Form 3 43,500, and Form 4 45,000. It is also important to note that those are fees per term, fees per term and also per parent. Number 2, we are told parents are usually required to pay 60% of the fees when the school open and the balance at the beginning of the next month. We are told Form 1 pay 60% when they report in Feb and 40% in March. Number 3, we are told the school receive capitation of shilling 16,000 per student per term, which is received at the beginning of the term. So basically, capitation is the funding received from the high school or received from the schools from the government. So and then number 4, we are told on average the school receives donation of 2.5 million per month, but this reduces to 60% when the school is closed. Number 5, we are told the school has a small farm which it generates harvested produce. And then you're told it is estimated that the produce generates shillings 200,000 per month. Number 6, in addition, the school hires out the bus every weekend for events earning shillings 60,000 per month, except in December when the bus driver is on leave. Number 7, you're told the school pays an average salary and wages of 6.2 million per month, even when the students have closed. Number 8, we are told the school is paid on average 550,000 on general consumables, which reduces to 60% when the school is closed. Number 9, the school buy new textbook and also replaces the old ones at the beginning of every term for shillings 650,000. Number 10, you're told the school provide meals to staff and students at an average cost of 1.5 million per month. And then you're told this is catered for in the school fees and capitation. The amount reduces to 40% when the school is closed. And then you're told number 11, electricity and water bills averages 150,000 per month and 50,000 when the school is closed. Repair and maintenance also amount to 250,000 per month and the reduces to 40% when the school is closed. Number 12, we are told the school plan to buy an additional learning and staff equipment worth shillings 1.5 million in January and replace the old furniture at a cost of 2 million in May. The old furniture will be scrapped for shillings 200,000. So being scrapped means that the old furniture will be sold for an amount of how much? For an amount of 200,000. Number 13, you're told the school has a loan for which it will pay the annual installment of 2 million and the interest of 200,000 in what? In December. So, and then you're told number 14, the school estimates it will have a cash balance of 5.5 million on 1st January 2025. What are we required to do here? We are required to prepare a cash budget for the year which ended 31st of December 2025 on monthly basis and also for the whole year. So let me copy this one. Remember, you said once you come across this question, you do this question, you have your solution within the same Excel worksheet. That's why you can see in my case, I've already splitted this Excel worksheet into two. So here we'll have the question. On this side, I'll have what? The solution. So up here, I'll basically have what? I'll have the solution. I'll have the solution. And basically what we are required to prepare here is what is a cash budget. But I think even before you move to prepare that particular cash budget, I think there are a number of items which you must compute. For example, in this case, you can see the fees to be corrected by this pool. We have not been given the actual figures. So we have to compute that. So therefore, the first thing we need to do here is basically to have some fee workings to compute a number of items, especially the fees which is to be corrected. The fees to be corrected both from the parent and also the fees to be received in form of government capitation. So therefore, I will start with the workings here. And I think the first working will be on what? The first working will be on the fees, school fees to be corrected. Let's start by computing the school fees. The school fees to be corrected, or actually to be received from the parent. Remember, in this case, we have the government capitation and the fees which is paid by the parent. I want us first of all to start by computing the school fees which will be corrected, which will be received from who? From the parents. And basically in this case, we're going to compute these school fees to be received from the parent in months, or basically in each month, because I hope you can be able to record here in note 1, we are told the school estimate it will have 120 students in Form 1, 110 students in Form 2, 100 students in Form 3, 100 students in Form 4, and then you're told Form 1 report in Feb. And then you're told the fees is basically the fees which is payable per term. And then you're told the parents usually are required to pay 60% of the fees when the school open. That is basically in January, and then the other one in Feb. So therefore, we're going to compute these particular fees to be corrected or to be received from the parent per month basis, or on monthly what? On monthly basis. So in this case, I'll start from January. And then I'll have Feb here, all the way up to December. Do I have to repeat all this? Do I have to type all this up to December? No. Once I type the first 2 months, so basically we can highlight the 2 months, and basically we do what? We drag like this. We don't have to type all that. So that will take us up to December like that. Okay. So then in this case, I can also bold this one. I can bold this. Yes. So we need to compute the fees which is to be received from the parent, and we are going to start by computing the fees to be received from the parents, or basically the fees to be corrected from Form 1, and then we do the same. We compute the fees to be corrected from Form 2 up to Form 4, Basically, I don't have to keep on typing this. Yes, like that. Form 1 all the way to Form 4. So we need to go back to the information which are given here. The information which are given here. And I think to make our work easier, I think we can summarize these students here, because we are told now, note 1, the school estimate to have 120 students in Form 1. So the student here expected to be 120. The student expected in Form 2 are 110. The student expected in Form 3 are basically 100. The student expected in Form 4, 120 Form 1, 120, 110 Form 2, 100 in Form 3, and also 100 in Form 4, like that. So having those numbers will make our work a little bit easier. Including these school fees, I think we can just have them here. This is the 33,500. This one is 36,500, and then this one is 43,500, and then this one is 45,000, like that. 45,000, like that. 45,000, like that. Okay. So we need now to correct the fees, which is to be corrected per month. Remember, we are going to start, in this case, we start with Form 1. Form 1, we report in which month? Form 1, we report in Feb. So no fees to be corrected from Form 1 in January. So the fees to be corrected here will be equal to the student to be enrolled in Form 1. That is 120. I'll basically multiply this with the fees which is payable per student. That is 33,500. And then I hope you can be able to recall the information which are given in note number 2. Parents are usually required to pay 60% of the fees when the school open, and the balance in the next month. And then you're told Form 1 will pay 60% when they report in Feb. So meaning that whatever you get here is basically the total fees to be corrected from Form 1 in what? In term 1. In term what? In term 1. But in this case, we are told the amount to be paid in Feb when they report will be 60%. So what I need to do, I need to get 60% of this. 60% of this. So that is basically the amount to be corrected from Form 1. So I hope you can see how we have computed that. Maybe you can just come up here. We have taken the fees which is payable per term, that is 35 times the student to be enrolled times 60%. That is the amount they will pay once they report in Feb. Once they report in Feb. That is basically what we have there. Then, in this case, we are told 60% when they report in Feb and 40% in March. So the amount to be corrected here in March will be the same. This one times the student to be enrolled 120 times 40%, which is basically 0.4. 0.4, like that. So that will give us that amount. Then, in this case, we know that in April, what will be here? What will happen in April here? I hope you can remember when the terms start. The first term start in Feb. The other term start in what? In May. So in April, do we have a holiday? Is that the case? And I hope we must be given some information in relation to that. Were we given the date for the holidays? Are we given the date for the holidays here? Are we given the date for the holidays? Are we given the date for the holidays? Or the month when the school closes? We must be having, yes. So we are told there are 3 terms. There are 3 terms. Are we given the date when the school will be closing here? I don't think we have that, but it is obvious. That the school closes, because we know a term run for how many months? 3: January, Feb, and March. We have a holiday here. The school closes there. Then the other term run in from May, June, July, and then they close here. And then the other term commences on when? September, October, November. They close in what? They close in December. They close in December. I think that is correct. Is that correct? Is that the position? Is that the position? Before you move, you need to agree on that. Josephine, is that the position? Kezia, is that the position? So we have a holiday, or the school will be crossing in April here, and also in August, and also in what? In December. Is that correct? Is that correct? Is that correct? Yes, that is basically correct. So having that, then we need to then compute. First of all, we deal with Form 1. So remember now, term 2 will start in May. So term 2, how much amount will be paid here? The amount to be paid in May will basically be 60%, because we are told the parent pays 60% when the school open, and the balance of 40%, the balance at the beginning of the next month. So in this case, the amount now to be corrected here in May, we don't have to compute that, but now automatically it will be equal to this. It will be equal to that. It will be equal to that. Let's just confirm. So we will take the student in Form 1 who are 120 times the fees per term times 60%. Remember, what will be paid in the first month is 60%. So you can see what we are getting there. So the amount now to be corrected in the other month will be 40%, which is basically equal to that. So we don't have to keep on computing that. And then no amount to be corrected in July. So the school closes in August and then open in September. The amount to be corrected in September will be equal to this. And the amount to be corrected in October would be 40%, which is equal to this. No fees to be corrected in November and also December. So we are done with Form 1. I want us to go to Form 2. In Form 2, basically they will report in the first month, that is January. So how much amount will be corrected, which will be equal to the number of students expected in Form 2, 110, times the fees payable per term, which is this one, times 60%. And then now in Feb, the fees to be corrected from Form 2 will be this, fees payable per term times the number of students times 40%, like that. Yes, so that's basically what you're going to have. No fees to be corrected in March. So basically, in April, the school will be closed. The fees to be corrected in May will be equal to this. The fees to be corrected in June will be equal to this one. And then no fees to be corrected in July and also August. The fees to be corrected in September will be equal to this. And basically, the fees to be corrected in October will be equal to that. No fees to be corrected in November and also December. So we go to Form what? To Form 3. We go to Form 3. Kezia is asking, is it 60 or 80? Why do we have 80? Should be 60. Should be 60. Do we have 80% anywhere? Is this one 60? The amount here 60. So I don't think we have 80 anywhere. So yes. So let's move now to Form 3. Form 3, we do the same. Now, instead of keeping on repeating this, so we may apply this formula. We may decide to apply this formula. By default, Excel will be able to compute for us these values here. Because there is a formula we have already developed here, so we can apply that formula down here, like that. So by default, Excel will be able to use these particular figures here to compute for us these values. We can just confirm. For example, is this figure correct? So we can just confirm it down here. This is Form 3. So the fees which is payable per term is this one, times the number of students here, times 60%. We confirm whether whatever you're going to get here should be equal to this. You can see it's the same. So this one is basically this times this, which will give us 4.5 million. 60% of that should be this one. Maybe you can just confirm. So this times 100 students times 60%, like that. So you can see basically the same. So we don't have to keep on repeating this. Once we have developed a formula, we can just apply our formula. So the same case here. Here we don't have to, we already have a formula here. So we just apply that. Should give us the same value. So the same case here. Like that. Like that. Yes. So in this case now, what you have been able to do is basically to compute the fees to be corrected from who? The parents. And actually, in this case, we can compute this. We can compute the total fees to be corrected by the parent from all parents, not parents of Form 1, Form 2, Form 3, or Form 4, from parents, all parents. So let's just get the summation. And this is basically the total fees from who? From parents. Total fees from parents. Remember, this total fees from the parent, when preparing our statement of, when preparing our cash budget, basically, this will be a cash inflow. This will be a cash what? A cash inflow. Let me bold this one. Control B. And equally, I can just work with these figures to the nearest whole number. I need to reduce the decimals up here. I'm increasing. So I need to reduce that. Yes, I work with my figures here to the nearest whole word number. I also need to underline this, Control U, like that. Yes, so that is basically the fees to be corrected from the parent. Then from there, I need to compute the amount of government capitation, the funding from the government capitation, the government capitation, and actually we're given some information in relation to this. In which note? In note number 3. So we are told the school received a capitation of 16,000 per student per term, which is received at the beginning of the term. So let's compute the government capitation. And this government capitation, basically this one equally is received per term. So what I need to do here, I also need to have my months here. Okay, let me just work with those months instead of repeating them again. So the first thing maybe I need to get here is the total number of students, because this one would be the same per student, irrespective of the level of the class, whether in Form 1, Form 2, the government capitation is the same, 16,000 per term. 16,000 per term, that's basically what you're told. That's basically what we are told. Maybe you can just take that point again so that you understand what you're told. Point number 3, the school receives 16,000 shillings per student per term, which is received at the beginning of the term. So the government capitation to be received here in what? In January will be equal to the total number of students, total number of students who are 430. And basically in this case, we multiply that with the amount of government capitation, which is basically 16,000. So that is the amount to be received at the start of term 1. So basically that will be the same, the amount to be received at the start of term 2. Term 2 starts in May. So the same amount will be received. And also the other term, which starts in September, the same amount will be received. The same amount of government capitation will be received. So therefore, this one will be received at the start of each term, at the start of each what? A term. So basically that is the amount of government capitation, the amount of government capitation. And I think this what basically had some workings. So I think having this now, we can proceed and prepare our cash budget, our cash budget. Let me just copy what we have down here. I copy what we have down here. Control C to copy. And then I need to paste that here. Control V. And then I can do some small editing up here. Whatever you're preparing here is a cash budget for the year which ended 31st December 2025 on monthly basis, and also for the whole year. So maybe I can bold this one. It's already bolded, and then maybe I can shade it like this to be more clear, So for us to be able to prepare this cash budget, basically we need to have this month from January up to December. So let me just copy this, Control C, and then Control V like that. Okay, yes. Now when preparing the cash budget, always here we start with what? Who can remind us? What do we start with here when preparing a cash budget? What do we start with? Who can be able to remember? What do we start with here? What do we start with? What do we start with? We always start with the opening cash balance. That's basically what we start with. Opening a cash balance. Opening cash balance. And then below this, we will record what? We will record something called the cash receipt. The cash receipt. The cash receipts, or in other terms, we refer to that as what? The cash inflows. The cash what? Inflows. So basically the cash which is flowing into the business. The cash flowing into the business. So we will basically record various cash inflows, and then down here we will record the cash what? The cash outflows. The cash outflows through the cash payments. It's also important for you to be able to remember when preparing the cash budget, we only use those items of incomes or expenses which involve cash inflow or cash outflow. So here we don't use the non-cash items like depreciation, things like the budget written off, and so on and so on. So here we start with the opening cash balance. So and I think this there is somewhere we're given this information. Okay, so let's go to that note. There is a note which you're given here, which is that note. That is the note number 14. We are told the school estimates that it will have a cash balance of 5.5 million on 1st of January 2025. So this is the expected cash balance at the start of the first month. Yeah. So the school expects to have a cash balance of 5.5 million. 5.5 what? Million like that. So then from there, what we need to do is basically to record the cash receipt. So the money which is expected to be received. So I will start by recording this one, the fees which is expected to be collected from the parents. So I'll have that here. I paste, and maybe I can unbold this one. Unbold. So the cash to be received, or the fees to be collected from the parent, is basically what you have computed there. And basically be able to transfer that down here. And then I'll pick this and I'll do what? I'll apply my formula here. I'll be able to drag that. By default, the figures we have up here, they'll come down here. So we have this basically what we have here. This is what we have here. This, what we have there. Basically, those are the fees to be collected from who? The parent. Then the other cash to be received by this school is this government capitation. So let me copy this. I have it down here. Government capitation. So the government capitation is this one. I enter, and then basically I'll be able to apply that up to December. So the figures we have computed up there, they will come down here. So you can see this, what we have here, this and that, basically what you have there. Yes. So basically, I'm done with this in note number 1 about the fees to be corrected from the parent, and also the what, and also the government capitation. Actually, I'm done with note 1, note 2, note 3. Yes, I can share those one in lead to know that I've done with those 3 notes. So then from there, what I want us to do is basically we move to note number 4. In note number 4, what are we told? In note number 4, what are we told there? In note number 4, we are told that on average, the school received donation of 2.5 million per month, but this reduces to 60% when the school closes. Donation received, basically, this will be a cash inflow. Donation received. Remember, we were told that this donation is received from alumni of this school. They donate, they come and donate some money. So donation from alumni. I hope you can remember that information. Where did we have that information? We have it here. Partially sponsored by capitation from the government, donation from who? Alumni and well wishers. And well wishers there. So we are told this one will be 2.5 million per month. 2.5 million per month. And actually, it reduces to 60% when the school closes. That's basically what you're told. So the amount to be received here will be 2.5. Okay. I just need to type that 2.5 like that. 2.5. I hope that is 2.5. Yes, 2.5. So that will also be the same in Feb and also in March. But now when the school closes here, this one reduces to 60%. So this one reduces to 60%. So the donation to be received here will be equal to 6%, 0.6 times this amount here. It will basically reduce to 1.5. And then now here, the amount to be received will basically be equal to this. So that is the amount to be received in May, June, and July. And then now in August, it reduces to 1.5 like that. Then in September, the amount to be received will be 2.5. The same case in October, November, but now it reduces to 1.5 in December when the school closes like that. So those are the donations to be received like that. Okay. So then we are basically done with this particular point here. Let's move to the other one. So we are told the school has a small farm from which it generates harvested produce. It is estimated that the produce generates Kenya shillings 200,000, Kenya shillings or shillings 200,000 per month. So basically, this one is also an income, is a cash to be received. And actually, you can refer to this as what? As the revenue to be generated from what? Let's just refer to this as farming income. The farming what? Income, or basically the income from the farm. I just refer to it as the farming income. The farming income. And actually this farming income we are told is how much? Is basically 200,000 per month. This one will be 200,000 per month. 200,000 per month. This one will not change. This one will not change. It will be the same in all months up to December like that. Okay, I need to introduce commas here. Then I work with my figures to the nearest whole number like that. Okay. So we are basically done with that point regarding the income to be generated from the small farm, which is operated by this school. We move to note number 6. We are told, in addition, the school hires out bus every weekend for events, earning 60,000 per month, except in December when the school when the bus driver is on leave. So basically, we can refer to this as what? We can refer to this as the income from the bus. Income from the bus, from the school bus, from the school bus, from the school bus. And basically, this one we are told is how much? We are told is 60,000 per month. 60,000 per month, except in December. Except now in December here. No income which will be generated in December. Okay. So then from there, we move to the other point. In the other point, we are told note number 7. We are done with that. Note number 7, you are told the school pays on average salaries and wages of 6.2 per month, even when the school have closed. Now, this is basically a cash payment. So that is salaries and what? Salaries and wages. Salaries and wages. So the salaries and wages in this case will be 6.2 million every month, even when the school have closed. Even when the school is closed, this one should be 6.2 million like that. 6.2 from January up to December, like that. Okay, so we are done with point number 7. So we move to point number 8. We are told the school spent on average 550,000 on general consumables, which reduces to 60% when the school closes. So this is still a cash payment of general consumables. General consumables. So this one will be 550,000. 550,000 basically a month, but reduces to 60% when the school what closes. So the first term is for the month of January, Feb, and March. But basically, this one we are told when the school closes, it reduces to 60%. Reduces to 60%. So here it will be equal to 0.6 times whatever you have here. Yes. So then here it will be equal to 550. This one. Yes. So this will be the amount for the next 3 months. Okay. And then here it will be 330. And then now from September, the amount will be 550. 550. 550 also in October and also in November. But now in December, it reduces to 330. This one. 60%. General consumables. So we are done with that point number 8. So we move to the other one, which is the note number 9, and we are told the school buys new textbooks and also replaces the old ones at the beginning of every term for shillings 50,000. So in this case, we have a purchase of what? Purchase of textbooks. Purchase of textbooks. Purchase of textbooks. And basically, in this case, we are told that the amount which is spent at the start of each term, at the beginning of each term, is 650,000. 650,000. So remember, this amount will be spent at the start of each term. So the first term starts in what? In January. The other term starts in May here. The other amount will be spent in May. The other amount will be spent in September. September here. That is when the other textbooks will be what? Will be purchased. Yes. So we are done with that. So let's move to point number 10. To point number 10 here. Point number 10. And basically, in this case, we are told that the school provide meals to staff and students at an average cost of 1.5 million per month. This is catered for in the school fees and the capitation. The amount reduces to 40% when the school is closed. So in this case, we have the expenditure for what? For the staff and students. That is the staff and the students meals, or basically we can refer to that as food. Yes. Or let's just put it like this: food for staff and basically who are students. So this one we are told will be 1.5 million per month. And basically we are told this will reduce to 40% when the school closes. So this will be 1.5. 1, 2, 1, 2, 3, like that. So this will be per month. That remains the same in the first 3 months of first term. And then once the school closes, that is in April, this one reduces to 40%. So this one will be equal to 0.4 times this amount here. Yes. And then here it go back to 1.5 for the next 3 months. It will be what? It will be 1.5 for the next 3 months. Then here it reduces to 40%, 600. And then in September, it go back to 1.5 for the next 3 months. For the next 3 months here. And then in December, when the school closes, basically it reduces by 40%. By 40, it reduces to 40, not by. It reduces to 40%. To 40%. So we are done with that item there. So we move to the other one, and we are told electricity and water bills. These are also items to be paid for. Electricity and the water bills. And the water bills. We are told that this averages to 150,000 per month and 50,000 when the school is closed. And then we have, okay, so before you go to repair maintenance, so this one we are told is 150,000 per month, 150,000 per month. But when the school closes, it reduces basically to 50,000. So this will remain the same for the next for the next 2 months. Here the school closes, it basically reduces to 50,000. And then here it go back to 150,000, the start of term 2. It remains the same in the next 2 months of term 2. Then here it reduces to 50,000. And then in September, here it goes back to 150. It remains the same in the next 2 months. And then in December now it reduces to 50,000, like that. So those are the electricity and water bills. Still in the same point, we are told there are some repair and maintenance. Repair and maintenance also amount to 250,000 per month and reduces to 40% when the school is closed. So we have repair and maintenance, maintenance here. Repair and maintenance. Repair and maintenance. And basically this one we are told will be how much? Will be 250,000 per month. And this will remain the same in Feb and also in March. When the school closes, we are told that this one reduces to 40%. So it reduces to 40%. So this one will be equal to 0.4 times whatever you have here, which will come to 100. And then once the school closes in term 2, it go back to 250. And basically this remain the same in the next 2 months. The school closes here, and that got to 100. It reduces to 40%. The school open for third term here. the amount go back to 250. The same case in October and November, but now in December, it basically reduces to 100,000 like that. It reduces to 100,000. So we are done with this one. Then from there, we move to the other item, which is note number 12. We are told the school plan to buy additional running and staff equipment worth 1.5 million in January and replace the old furnitures at a cost of 2 million in May. So basically, those are two items which are to be purchased, and then you're told the old furniture will be scrapped. They will be sold for 200,000. So we will start with the running and staff equipment. So let me just copy this: running and staff equipment. Basically, paste that here. Running and staff equipment. So we are told the school plan to buy additional running and staff equipment at worth 1.5 in January. In January here, 1.5, like that, and replace the old furniture at a cost of 2 million. So in other terms here, there will be purchase of furnitures. There will be purchase of furnitures. And in this case, we are told the furnitures will be bought at a cost of 2 million in which month? In the month of May. So this is basically January, February, March, April, May. 2 million is the amount to be spent there. Like that, 2 million. And then in this case, we are told because these old furnitures are being replaced, the company will, the school will sell the old furnitures. So here we are going to have the sale of old furnitures. And basically, once the school sell the old furnitures, that basically will be money to be received. So here, under the cash received, we will have the sale of old what? Old furnitures. Old furnitures. And automatically they will be sold in May. When they are replaced, they will be sold in May. So in this case, we are told they will be sold at 200,000. But maybe you can just confirm that. We are told they will be sold or they will be scrapped at 200,000 automatically in May when they are replaced. When they are replaced. So we are done with that point. So we move to the last one. We are told the school has a loan, which it will pay an annual installment of 2 million, and an interest of 200,000 in December. So basically, these are payment. We have two items which are to be paid for. We have the loan installment and the interest. So we have under the payment, we will have loan repayment. And this loan repayment, basically, we are told will be done in December. Will be done in December. That is basically what you're told, including interest on the loan. Interest on the loan. Also, this one will be paid in which month? Will be paid in December. Interest on the loan. So we are told the installment will be 2 million. The interest is 200,000, and both of them will be paid in which month? Will be paid in Feb. So you will be paid in December. Will be paid in December. In December here, the loan 2 million. The installment, not the installment, rather the interest 200,000. 200,000 like that. And I think in our case, basically we are done. We are done because we have recorded all these items within our cash what? Within our cash budget. Now, after doing this, You can see this was a very good question, a very, very good question. So I think the only part which was tricky is this one, computation of the fees to be corrected. But once we are able to do that, the question becomes very what? Very simple. So what we need to do is now to finalize. So here what we will do, we need to get the total receipt, the total receipt, the total receipt. So the total receipt, we will basically add all this. We will add all this, and basically we will have to bold all this. Bold this one, and also we must underline it. We will basically underline this. Control U like that. After getting the total receipts, we will also need to get the total payments. The total payments for each month. Total payment for each month. This one we need to bold it. This one will be bolded, and then also this one will be, we will underline these values here. Control U, Control U. And then down here, we will also get something called the closing cash balance. The closing cash what? Balance. So this is basically the cash balance at the end of each month. At the end of each what? At the end of each month. And also this is something we need to underline. Basically we say control, Control U, Control U. So basically I want us to develop a formula for computing those balances. Those balances. So the first thing we need to get is basically the total receipt for the first month here. I'll do auto sum, and I hope you can see I'm including even the opening cash balance there. I'll get the total payments, the total cash payments. I will basically add all this. I will add all this like that. I get the total payment, and then I'll get the closing cash balance. So how do I get the closing cash balance? To get the closing cash balance, I'll basically take what I have here, the total receipt A minus this one, minus total payments. So I will take this minus this. And because you are developing a formula, we say never type these figures here within your formula. So basically take whatever you have here minus this, because that is a formula we are developing. So that now will be the closing cash balance. Now this closing cash balance will be the opening cash balance in the month of Feb. So the opening cash balance here will be this one, will be this one. So don't type, you enter. So by the end of the day now, Excel will be able to appreciate, or basically will be able to know that the closing balance, for example, in Feb will be the opening balance in what? In March, and so on and so on. So, and I think having that, what I think I need to do is now to get the totals here, the total receipt. Let me get the total receipt by basically applying this formula across. By applying that formula across, I'll be able to get those totals. So you can be able to confirm here. So these are the actual totals. Like this one is 2.5, 2.7, 2.76. That is correct there. Yes. So then from there, I need to get the total payment. So the total payment, I already have a formula here. I'll be able to apply that. And once I do this, the other item Excel will be able to compute for me is this balance, this one. You'll be able to see by default, Excel will be able to compute for us this balance, including the opening balance. Let's do that because we already have a formula here. Okay, so there is something I think which has not been computed for us. Let me see whether, I don't know whether I captured this balance. This 12 is around 19. Okay, this is basically correct. Okay, so there is something I need to, okay, yes. So I think then what I need to do, for this one, Excel can't compute for us. We just need to apply this formula here. This formula, how do we compute this one? So we have said we take this minus this. So this minus this. So basically we get, we apply that formula across like that. So those will be basically the crossing balances, and those figures must also be reflected up there. For example, this one, remember the closing cash balance in Feb, this one, we have said should be the opening cash balance in which month? In Feb here. Yes, I think this is wrong because the opening balances are not coming here. They should. So otherwise, whatever we are doing is wrong. Whatever we are doing is wrong. So this balance, we said this one. I think we picked whatever he had here. Then for the second month, that is Feb, we have gotten this total, which is actually this one, minus what we have here. This is basically this is the figure here. Okay, I don't know why it is not picking that formula. It should. So in this case, we will take this one, minus basically what we have here. Okay. And then this one, the opening cash balance here. The opening cash balance here should be this one. Should be this one. Should be this one. Should be this one. So basically, this is a formula we should be able to apply. Yes, I think what we did here, we didn't apply that formula across because this we are saying should be the opening cash balance here. So what we should do is basically to apply that formula across like this, such that once we have these closing cash balances, they'll be picked up there. So can we have now this? They should be reflected up there. Let's see. These balances should be up there. Yes, like maybe you can just confirm the closing cash balance here for Feb, for the month of Feb, which is 13, it should be the opening cash balance in March. In March here. Is that the case? The opening cash balance in April, this one, should be the closing cash balance in which month? In the month of March, this one. Yes, that is basically correct. And this one should be the closing cash balance in August. Is that what we have there? Yes, that's basically what we have there. Yes, I think that is okay now. But equally, if you check on this particular question here, we were required to prepare the cash budget on a monthly basis and also for the whole year. For the whole year. So how do we prepare this one for the whole year? Who can tell us how are we going to prepare this cash budget for the whole year? Because what you have done here is basically you have prepared this on monthly basis. How do we prepare this one on for the whole year? Yes, how do we prepare this one for the whole year? Who can tell us? Who can tell us how do we prepare this one for the whole year? Yes, I'm told we do what? We do what? Yes, we basically do a summation. We do a summation here. We do a summation. We do a summation for individual item. This basically will be cash budget. Where do we have the equal sign here? Okay. Okay. So in this case, we are saying to prepare the cash budget for the whole year. Basically, we need to do a summation. We need to do a summation here. So we do a summation for all these items. I'll start with this one. Automatically for the opening cash balance, I can't do a summation for the opening cash balance. So, but I'll do summation for the other items here. So that summation, that is basically the total, and maybe I can shade this one like this, maybe to be different like that. So for the whole year, I'll basically get the summation for all these items like that, and then I'll also do the same for the items of expenditures here, the items which were paid for. I'll get the summation like that, and basically I'll also be able to apply that. Then for the opening cash balance here, I'll automatically start with the opening cash balance at the start of the year. The opening cash balance at the start of the year is this one. But this one, I can't do the summation. So I enter like that. And then I'll get the summation here. I'll get the summation. So by taking the opening cash balance plus now the cash which were received, we have gotten that total. We have gotten this total. So then to this, what do we need to do? We need now to less, before we less, I think we can get the total payments. The total payments would be all these. I get a summation here. Yes, which basically is coming to 110,340,000. So how do I get the closing cash balance? This one. And basically, this one, the closing cash balance I should get here should be the same with this. Should be the same with this. So let's see whether we're going to get the same. So we'll take this minus this amount here. We enter. You can see basically we are getting the same what? We are getting the same amount. The same what? Amount. So what we have done here, for this cash budget for the whole year, we have taken the opening cash balance, which is this one, and then we have added all the cash received during that year, and basically we have added all the cash payment during that year, and basically I've said that should give us the same amount of the closing cash balance. Yes, cash balance. So this basically what is required as far as this particular question is concerned. A very good question on preparation of the cash budget. A very good question on the preparation of the cash budget. So there was no fees correction for the month of December. We have some fees correction in the month of December here. Oh. What is this? Okay, let me confirm. So fees corrected from the parent. Hey, that is wrong. That is wrong. How do we get that figure? Thank you, Judith, for noting that. Okay, I think this was supposed to be here. Is it supposed to be here for November? Is this supposed to be for November? Yes, I think this one should be for November. This one should be for November. This one should be for November. Okay, thank you, Judith, for noticing that. So basically, we need to cut these figures. We cut them, Control X. We paste them here. Okay. Oh, sorry. We should not have any fees corrected there because fees is only corrected in the first month and the second month of the term. So no fees to be corrected here. No fees to be corrected there. No fees to be corrected there. No fees to be corrected there. And automatically that should be reflected in our cash budget. In our cash budget. I think now the figures are okay. Are the figures okay now? They should be okay. They should be okay now. Oh, that was auto summation. Auto summation. Yes, but I hope now it is okay. Is it okay now? I think we have done away with those particular fees, which we had in Feb. I think now it is okay. Is our cash budget now okay? Is our cash budget now okay? Is our cash budget okay, or we still have a problem? I think we have corrected that. I think we have corrected that. We have corrected that. We have corrected that. Okay, that is the summation of this. Yes, I think now it should be correct. It should be correct now. It should be correct. It should be correct. Okay, so basically that is it. That what was required as far as that particular question is concerned. A very, very good question regarding the preparation of what? Of the cash budget. So what you just need to remember is, first of all, the format of preparation of the cash budget. Once you remember that particular format, then you should be able to determine the cash to be received in each of the month and also the cash to be paid in each of the month. But I think I'll say that the only tricky part as far as this question was concerned is in relation to the computation of the school fees. The school fees specifically from who? From the parents. From the parents. So once you're able to do that, then basically the questions becomes quite what? Quite simple. Yes. So basically that is it. That's what is required in that particular question. And for today, equally, we wind up a little bit earlier. So once we meet in our next class, we will be able to look on a question regarding the preparation of preparation of the flexible budget. How do you prepare a flexible budget? First of all, what is a flexible budget? And basically, how do we prepare the same? How do we prepare the same? So that is what we will be able to discuss in our next class. And equally, we look on some few questions in relation to that. So I don't know whether there is any question before we wind up. Any question before we wind up? Any question before we wind up? Yes, what is the question? Oh, I'll be sharing the Excel before the class. It is okay, Faith? It is okay. It is okay. So how do we compute present value interest factor? I hope you're not referring to PVIVA. So to compute the present value interest factor. So maybe at the rate of 10%. Is this what you're asking, Ron? Maybe for 3 years. Is this what you're asking, Ronnie? Is this what you're asking? Yes, yes. So basically to compute this one, we said is quite simple. We said just go to an empty cell. This one, we don't have a formula for computing this. We said we only have a formula for computing the 𝐕𝐵. Sasa, that is basically the formula we have embedded within Excel for computing this one, 𝐕𝐵. Sasa, so but to compute this one, you go to an empty cell and you say this one will be equal to 1. Remember the formula for this, the formula you're using in FM is basically 1 plus small r, close the bracket, and then we raise that to negative n. So what you just need to know, which function we use to raise or to have an index. We said you shift number 6. I hope you can be able to see number 6 within your keyboard. Can you be able to see number 6 where we have number 6 within your keyboard? Within your keyboard, you go to number 6, but first of all you shift, you have that, and then minus n like that. Minus n, what are we told here? We have a problem here. Okay, so basically this one is recognized like an operation. So, but basically to compute this, what we do, you say that this one will be equal to 1, assuming our R is 10%. So this will be equal to 1 plus 0.1, which is basically 1.1. And then we shift, press number 6, then raise to that to negative 3, like that. So that is basically how we compute the present value interest factor to the rate of 10% for 3 years. For 3 years. But you see now you can see like the answer we are getting here is basically 1. So this figure is given to the nearest whole number. So we said to get the actual present value interest factor, you come up here and basically you can introduce a comma like that. And then you increase these to 4 decimal places. Increase these to 4 decimal places. This is basically what we use to increase this to 4 decimal places. It should be that. Should be that. That's basically how we were computing that. So you're asking about 𝐕𝐵. 𝐕𝐵, basically we said that assuming you want to discount a certain cash flow, like maybe you want to discount what, 5 million. 5 million. 5 million. Maybe it's an annuity. Is an annuity basically is a cash to be received by the company in the next 3 years. In the next 3 years, assuming we have, we want to multiply that with the 𝐕𝐵 at the rate of 10%, and basically this is a cash flow to be earned, annual cash flow to be earned in the next 3 years. So basically to discount this, and this being an annuity, which has to be multiplied with 𝐕𝐵, we said you go to an empty cell and you say this will be equal to, here we want to compute the present value of this. So you say this, or the present value for this, you type PV. Can you see that? I don't know what you're doing. Just go to an empty cell. To an empty cell here, you say we want to get the present value of this PV. Open the bracket. Once you open the bracket, you can see you are guided on what to input. You should input the rate. The rate is 10%. Is 10%, and then NPAR. NPAR is the period, which is basically 3 years. And then the payment, or basically the amount. So now this amount here, which is 5 million, then we said you need to ask yourself, is this 5 million, which is basically to be received in future, we say that these are future cash flows. So you can see what you're told here. If it is a future cash flows, which you want to get its present value, you record it here as a negative. That's what you're told. If it is a future cash flows, you record it as a negative. So when recording that here, you record it as a negative 5 million like that. Negative 5 million. Are we together? Record it as negative 5 million. And then you do what? You cross the bracket like that. Has that understood what you have done? Yes. So and then you do what? You enter. Huh? Well, that is not working. You enter. Yes. So you can see basically the present value for this will be 12, 434 to what? 260. But you said if you record that here as or basically you fail to include the negative sign, then the answer which you'll get will be a negative. Like maybe let's do away with the negative signs there. You can see you're getting the same answer, but as a negative. So we said these 5 million, these are future cash flows. You want to get the present value for that. So these future cash flows must always be incorporated within our formula as what? As negatives like that. Sasa? Yes, yes. So I hope now you'll be able to discount those particular cash flows there. You'll be able to do that. I hope that is okay. Yes. So any other question before we wind up? And I hope you're trying to do some more revision on this, because we said more revision, more exercise. We said you can only be able to perfect on whatever we are doing here through practicing. So this paper requires a lot of practice, especially trying to work with Excel. You'll be able to learn so many new things. So Excel, we said that its main objective is basically to make your work easier, So you can see like that question. If, for example, this question, we're doing it manually, this is a question we can take even 2 hours or even more than 2 hours to do it. But by using Excel, we're able to make to be more fast, and also be able to simplify our work to make our work more easy. Yes, yes. So let's just stop at that point for today. We continue from there in our next class as we look on how we prepare the flexible budget. So have a good night. See you on Saturday. Yes, so I want us to start with a question from the topic of share-based payment. Specifically, I want us to look on a question which was examined in November of 2016. So let's go to that question, November 2016. Remember, this is our revision for AFR. So November 2016, this was a question on share-based payment. Share-based payment. So once you get the question, please confirm so that we start. November 2016. November 2016. This is question number 4. Question number 4, C. Question 4C. Question 4C. Question 4C. Yes. So do you have the question with you? Do you have that question with you? If yes, please confirm. If yes, please confirm. Okay. So what are we told? What are we told here? So the question is, as part of its staff motivation program, Beta Limited decided to grant each of its 600 employees 100 options to purchase the company shares effective from 1st April of 2016. The option were conditional upon one still being in employment as at 31st of March 2020. And then we are told the following additional details. The following additional details were provided with respect to the scheme. So we are given years, basically the years which ended 31st of March 2017, 2018, 2019, 2020. We are given the number of employees who are expected to terminate or to leave employment, and then the fair value of each option. Then from there, in the last paragraph, we are told the fair value of the option was shillings 25 on 1st of April 2016, and then you're told that the exercise price of the option will be shillings 12, and the par value of the company shares is shillings 6. So we are told the average market price of the share over the 4 years to 31st of March 2020 is expected to be 25. So what are we required to do? We're required to show how Beta Limited should report the transaction of the above scheme as per the requirement of IFRS 2, share-based payment over the 4 years which ended 31st of March 2020. And then we are told assume that all the eligible employees will exercise their right on 31st of March 2020. So basically, this is a question coming from that topic of the share-based payment transactions. And here we are given information about the employee share option. Remember, in this case, we said an employee share option. This basically whereby the employees of the company are basically given the privilege or basically the right to buy the shares of the company in the future, but upon fulfilling certain conditions, or the company can promise to pay a cash or even a bonus to the employees in future once the employees fulfill a certain condition. So we say that once you come across this particular question for employees share option, the first thing you need to identify is whether that employee share option is a cash settled, whether the employees will be paid a cash or basically a bonus in future, or whether the employees have been given a privilege or a right to buy the shares of the company in the future at a price below the market price. Now, if you go back to the information which are given in this question, specifically in the first paragraph, the first sentence, we are told, as part of its staff motivation program, Beta Limited decided to grant each of its 600 employees 100 option to purchase the company shares. So it automatically means that this employee share option is basically a share based. So the employees here will not be paid a bonus, will not be paid a cash in future, but rather they have been given a privilege to buy the company shares in the future. And therefore, even before you proceed to compute what is required, we say you can say that this is a share based, is not a share based, rather it is an equity settled, employees share option, share option. So if it is an equity settled, it basically means that the employees of this company have been given a privilege or basically a right to buy the shares of the company in future once they fulfill certain conditions. Now, still in that particular first point, that sentence number 2, we are told this share option was granted to the employees on 1st of April 2016. Now, 1st of April 2016, we refer to that particular date as the grant date. As the grant date, 1st of April of 2016, we refer to this as the grant date. Basically, it is the date when the employees were given this particular privilege or basically that particular right? And then you're told this option are conditional upon one still being in employment until 31st of March 2020. So 31st of March 2020. Now, this particular date here is the date the employees will be able to do what? To exercise this right. To exercise the right means that those employees will be working with the company on this date and the ones who will be able to buy the shares of the company at a price below the market price. Now, what we said is that this basically privilege which is given to the employees to buy the shares of the company in the future at a price below the market price is basically a form of an employee's benefit. Is a benefit which is given to the employees. So the employees is a benefit, to the company basically is what? Is an expense. And therefore what we say is that because now the benefits will be given to the employees on this date, because that is the date they will be able to buy the shares, we say that those benefits given to the employees here relate to this particular period here, relate to this period from 1st of April 2016 to 31st of March 2020. That's why we say what we need to do is basically to determine the amount which will be recognized as an expense by the company here, by the employer, over the vesting period. Remember, this period we refer to it as what? The vesting period. And how many years do we have here? So in our case, the first year will end 31st of March 2017, the other one 31st of March 2018, the other one 31st of March 2019, and the other 31st of March 2020. How many years are those? 1, 2, 3, 4. So in our case, we have a period of, we have 4 years here. So what we need to do, we need to determine the amount to be expensed in year 1, in year 2, that is year 3, and also year 4. And actually we said, for us to be able to do that, for example, in year 1, to determine the amount which will be recognized here as an expense, we can only compute that based on the employees who are expected to be working with the company at the end of the 4th year. Remember, we said at the end of year 1, we cannot be able to tell the employees who will exit this company in year 2, year 3, year 4. We can only be able to use estimated numbers. So for us to be able to compute the amount to be recognized as an expense, I gave you a certain formula here, which we said is very, very important, which will help you to compute the cumulative expense. The cumulative expense to be the cumulative expense at the end of each year. So the cumulative expense at the end of each year, we said is computed based on this expected number of employees, or in other terms, you can just say employees expected to remain. In very simple terms, employees who are expected to remain, employees expected to do what? To remain. So employees are expected to remain are those employees who are expected to be working with the company at the end of the vesting period. How many employees will be working with the company at the end of the 4th year? And then we multiply this with the number of options. The number of options which are granted to each employee. Each employee has been given the right to buy how many shares? And then we said we multiply that with the fair value of each of each option. And actually, in this case, what we said, here, if now the employee share option is an equity settled, the employees have been given a privilege to buy the shares. So if an employee's share option is an equity settled, here we said that we use the fair value. We use the fair value of each option, at grant date. At grant date. So if the employees have been given a privilege to buy shares, but if it's a cash settled, the employees will be paid a bonus or basically a cash. We use the fair value of each option, at the end of each year. at end of each what? At the end of each year. At the end of each what? Year. Actually, we say that is very, very important. And basically, we multiply this with what? With the proportion of what? Of time. So we say this formula, make sure you remember that. Make sure you remember that particular formula. So I think having this now, we can be able to proceed and basically we answer our question. If you check on what you're required to do, we're required to show how Better Limited should report the transaction of the above scheme. To report basically is what will be recorded in the income statement, what will be recorded in the statement for financial position. So the first thing we need to do here is to compute the amount which will be recognized as an expense in each year. And then from there, we proceed, we prepare the financial statement extra. Now, for us to be able to compute the amount to be recognized as an expense, we have all this. We have the proportion of time. We have the fair value of each option at the at basically the grant date. We have this one, but basically we said one item which the examiner will not give you is this one. So the examiner will not give you the expected employees to do what? To remain. So that one has to be computed. That one has to be what? To be computed. So what I want us to do, I want us to compute the employees expected to do what? Expected to remain. Expected to remain. Number of employees who are expected to remain. Purchase is saying my Modimus board is not clear. Is that the position? Is my board clear? Is my board clear? Is my video clear from your side? Okay. So purchase, check what is happening with the internet. Yes. Okay. So let's compute this. The number of employees who are expected to remain. How many employees will be working with the company at the end of the 4th year? So we start with year 1. Remember, year 1 ended on 31st of March 2016. So that is when the first year ended. So we will take the original number of employees who are there, which is given within paragraph 1, sentence 1. So the number of employees who are there are 600. And then we go to the information we have below paragraph 2, where we've given 4 years and also the number of employees who are expected to terminate or to leave. Now, as per year 1, we are told the employees who are expected to terminate or to leave will be 25. So in that case, we take 600 minus what? Minus 25. And basically, this will give us what? This will give us 575 what? Employees. 575 what? Employees. So we go to the to year 28. Basically, this should be 2017. Sorry. We go to the next year which ended 31st of March, July. That is okay. This should be March. This should be March of 2018. So in this case, we said we take the employees who remained here, or in other terms, we can take the original number of employees, 600, minus the employees who are expected to leave as by year 1, who are 25, minus, if we go to the year 2018, we are given 15 employees. So we say those 15 employees are the additional. Other than 25 employees who are expected to leave as by year 1, the company now expects additional 15 employees to do what? We leave. That's yes. And then we get the final figure here, which will be what? Which will be 560. Which will be 60. So we move to year 3, which ended 31st of March 2019. So we take 600 employees minus the employees who are expected to leave as by year 1, minus additional employees expected to leave as by year 2, minus additional employees expected to leave as by year 3. And basically that will give us what? That will give us 550. And finally, the year which ended 31st of March 2020. So we take 600 minus 25, this one, minus 15, minus 10, minus the additional employees expected to leave as by year 4. And those are 10 what? 10 employees. So that now will give us what? That will give us 540. So having that now, we can be able to move and we compute the cumulative expense at the end of each year, and equally the amount of expense to be recognized in the income statement. And actually, for us to be able to do that, we are going to use this particular formula here. So we need to have our computation here. We will have our 4 years. So the first year basically ended on 31st of March 2017. Year 2 ended on 31st of March 2018, 31st of March 2019, and 31st of March 2020. So then from there, we will have the other column here, which we said is for the cumulative expense. Cumulative expense. And finally, we have a column for the expense in the income statement. Expense in the income statement. The amount to be recognized as an expense in the income statement. So let's compute this. So remember, we are using this particular formula here. We are using this particular formula here. Yes, this is asking, are we supposed to? It is, remember what we said is here. In terms of how we compute this, it's all depend with the information which you are given. It all depends with the information which you are given. There is, I think, a different question which we did, whereby we were given the actual number of employees who left here, and then from there we were given the employees who are expected to leave in year, maybe in year 2, year 3, and maybe in year 4. So what do you do? We said in such a case, you take 600 minus the actual employees who left here, minus now the employees expected to leave in year 2, year 3, and year 4. So in terms of how you compute this, it all depends with the information which you are given. Sasa? Yes, and actually we say that this whereby the examiner will try to twist these particular questions. This is the area which is twisted by the examiner as far as the questions coming from this topic is what is concerned. So you need to do more questions on this so that you understand how do we compute this. Maybe we are going to look on such a question here. So having that now, let's move and compute this one. So we are using this formula here. This is the formula we are using. This is the formula we are using here. Yes, so first of all, we will take the number of employees who are expected to remain, basically for our 4 years. In the first year is 575. 575. So here is 560, 550, and basically 540. We then multiply that with what? We then multiply that with the number of options. So the number of options basically are the number of shares each employee was entitled to buy. So that information, we have it in paragraph 1, sentence 2. We are told Beta Limited decided to grant each of its 600 employees 100 share option. So those are the number of options granted to each employee. And then from there, we multiply that with the fair value of each option. Which fair value do we use here? Take into account it is an equity settled. So if it is an equity settled, we use the fair value of each option at the grant date, not at the end of each year, at the grant date. And that information, we have it in the last paragraph. In the last paragraph, we are told the fair value of option was 25 on 1st of April 2016. 1st of April 2016, remember, is the grant date. So we use the fair value of each option at the grant date. And basically that is 25. 25, 25, 25, 25. But remember, in this case, we said that if, for example, this one was what? This one was a cash settled. The employees were to be paid a bonus or basically a cash at the end of the vesting period. Then we use the fair value of each option at the reporting date. And the fair value of each option at the reporting date, we say, is equivalent to the market price of each share at the end of each year. Basically what we have below paragraph 2. Sasa? Yes, and finally we multiply this with the proportion of time. The proportion of time here will be 1. How many years do we have in total? Here we have 4 years. So the proportion of time will be 1 over 4. Here will be 2 over 4. Here will be 3 over 4. Here will be 4 over 4. 4 out of 4. Sasa? Yes. So let's compute the cumulative expense in year 1. In year one, I'm given what here by Gilbert, 359, 375. Can you confirm whether that is what you're getting in year one? Are you getting that value? 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 359, 375. Yes. So then we say that this is basically the same amount to be expensed in year one, the same amount to be treated as an expense in year one. Then we move to year two. Year two, we take 560 times 100 times what? Times 100 times 100. Janet, I think I've explained why I'm using 25. Have I not explained, Janet? I've explained, I've said that this is an equity settled. So if it is an equity settled, I think I've given those notes here. If it's an equity settled, you use the fair value of each option at the grant date from year one to year four. But if it is a cash settled, the employees have been promised to be paid a bonus or a cash. We use the values under paragraph 2. Use the values under paragraph 2. In fact, that's what I mentioned even before we started our computation here. Once you come across these questions for employee share option, you need to identify, are the employees buying shares? They've been given the right to buy shares? If they have been given the right to buy shares, is an equity settled? So when computing now the amount to be expensed, use the fair value of each option at the grant date from year one up to the last year. But if the employees will be paid a cash or a bonus, it is a cash settled. Use the fair value of each option at the end of each year. If, for example, the employees here were to be paid a cash, then we would have used the fair values in note number below paragraph 2, 20, 16, 16, and 12. Sasa? Yes. Okay, so this now here will give us, I think, 700. Are you getting 700 here? 700? 700, yes. Then the amount to be recognized as an expense here will be the difference between these two values there. The difference between cumulative expense in year one and year two. Year one and year two. So that will give us what? That will give us 340, 625, 625. So what about cumulative expense in year three? Cumulative expense in year three. You're getting what? 1031 to 50. Yes, so the amount to be recognized as an expense here will be the difference between those two values. So which is 331, 250. And basically the last year, what do we get here? We have 540 times 100 times 25, which will give us 1,350,000. So the amount to be recognized as an expense here will be the difference between these two values there. Which is 318, 7 what? 750. So that is the amount to be recognized as an expense in year 3, or actually in year 4, not year 3. So basically what you require to do here, we require to show how this company was supposed to account for the transaction. Was supposed to, is it to account or to report? Not to account, to report. To report means we need to prepare financial statement extract. We need to prepare financial statements extract. And basically we show what was supposed to be recognized in the income statement and equally what was supposed to be recognized in what? The statement of financial position. So let's start with the income statement extract. And actually we said here, we just need to remember that this is the amount to be which was supposed to be recognized by our company as an expense in the income statement over the period of 4 years. So we need to have our 4 years here. 31st of March 2017. 31st of March 2017, 2018, 2019, and 2020. So this amount was supposed to be recognized as an expense. So at the expenses, our company was supposed to recognize something called the employees. What we said, you can just refer to that as employees remuneration. Employees remuneration. This is basically a benefit the employees are entitled to. So the first one, or the first year, was 359, 375. Year 2, 340, 625. Year 3 is 331, 250. And then year 4 is 318, 7 what? 750. So this is what our company was supposed to recognize here as what? As an expense. As an expense. As an expense. And finally, we prepare the statement of financial position. Statement of financial position extract. Statement of financial position extract. So in the statement of financial position extract, basically we need to show what was supposed to be recognized here over a period of 4 years. The first year ended 31st of March 2017, 31st of March 2018, 31st of March 2019, and 31st of March 2020. So we said here, what the company was supposed to recognize here is basically this amount here, these cumulative figures, of which we say, by the company basically accounting for this as an expense, the company is setting aside money from its profit to pay for those particular shares which will be issued to the employees at the end of the 4th year. So therefore, we say that this cumulative amount should be recognized here as what? Should be recognized here as a reserve, as a reserve. So being a reserve, it should be recognized as a component of equity. And actually, we say you can just refer to that as employees. Employees what? Employees share option reserve. Reserve. Or you can just come here and you refer to that as simply as what? As an equity. As what? As an equity. So the balance or the total or the amount to be recognized in year 1 here will be 359, 375. Year 2, not this one, but the cumulative amount. The cumulative amount of 700,000. Year 3, we have 1031, 250. And year 4, we have 1350,000. So this is what the company was supposed to recognize in the statement of financial position. Basically, as what? As what? As a component of equity. Now, there is something we also need to. Do we need to note that here? We need to note that there. I think no, because in our case, we are required to do what? Just to show how the company was supposed to report this, to report basically to account for this, Yes, so that is it, that what was required there. I don't know whether you can get another question which is tested differently. Because we say this particular question, they keep on twisting them, especially when it comes to computation of this. The number of employees are expected to remain. That is the area whereby the examiner will try to catch you. The examiner will try to catch you. The examiner will try to catch you. Yes, I think in class we're able to do, I think, a number of questions. I think maybe you can try and see whether you have a different question here. So it will not get basically we move to the other topic. Mike is asking about what? The time basis. Time basis. I think we said here, you just need to This is not time basis, but basically the proportion of time. Proportion of time. How many years do we have here? We have 4 years. We have 4 years. So whatever you compute here in year one, whatever you get here, this is the amount to be recognized in the next 4 years. But now, as per year one, you want to know the amount to be recognized in year one out of 4 years. So first of all, know how many years do we have? If you check on the other questions we did in class, I think most of them we had 3 years. So the proportion of time here, for example, was 1 all over 3, 2 all over 3, and 3 all over 3. But in this case, we have 4 years. We have 4 years. Yes, I think maybe you can just yes. So there is a question which I'm trying to look for here, and I think I've seen it. I don't know whether we did that question in class. Did we handle this question in class for November 2018? November 2018? Okay, sawa. So let's do this one as the last one. We try to hurry up so that we look on something else. November 2018 1C. November 2018 1C. November 2018. Question 1C. Yes, I hope you're there. I hope you have the question with you. Yes, are you there? Are you there? Okay, so what are we told here? We are told on 1st January 2015, G Limited granted each of its 200 employees a 500 share option. This share option were to vest if the employee still worked for the entity as at 31st of December 2017, and if the share prices on the date exceeded 45. So in that case, you can see we have two conditions which are set by the employer that for an employee to be entitled to this privilege, so an employee must work with the company for the next, or actually up to 31st of December 2017, and basically the share price on that date exceeded 45. The market price per share on 31st of December 2017 would be more than 45. So in this case, what we consider is whether one condition, just one condition has been fulfilled. So mean that those employees will be there at the end of 2017, will be entitled to buy the shares, even if the market price per share will be less than 45. So provided one condition is fulfilled out of the two. And then you're told that on the grant date, the fair value of each option was 15. And then you're told the share price on 31st of December 2015 was 27. And it was considered unlikely that the share price would rise above 45 by 31st of December 2017. It basically means that one of the conditions set by the employer there in paragraph 1 will not be fulfilled. So the share price at the end of 2017 would be less than 45. So then you are told 20 employees left the company during the year, which ended 31st of December 2015. And a further 20 employees are expected to leave in the next 2 years to 31st of December 2016 and 31st December 2017. So and then you're told during the year which ended 31st of December 2016 and 31st of December 2017, 15 employees and 25 employees left the company respectively. So what are we required to do? We are required to prepare extract from the financial statements of G Limited for the year which ended 31st of December 2015, 2016, 2017, 2018. How many marks were allocated there? 6. And I think this is a very good question in relation to what Reese was asking. So what if we are given the actual employees who left? So because if you check on the information which you're given in the other question, it was totally different from this. But basically what you have said is that even before you proceed to answer what the examiner requires here, can you first of all identify whether this is an equity settled or a cash settled employee share option? Will the employees be paid a bonus? Will the employees or have the employees been granted the option to buy the shares at a price below the market price? So if you check on the information we have within paragraph 1, the employees were granted 500 share option. So if they have been granted 500 share option, they have been granted the right to buy the shares. So if that is the case, then this is what? This is an equity settled. This is an equity settled employee share what? Employees share option. Employee share what? Option. So if it is an equity settled, we have said when computing now the amount to be expensed, when computing the expense to be recognized in the income statement, then we use the fair value of each option at which date? At the grant date. At the grant what date? That's why it is important for you to determine whether it is an equity settled or a cash settled. If it was a cash settled, whereby the employees have been promised to be paid a bonus or a cash, we use the fair value of each option at the end of each year. At the end of each what? Year. Now, having that, and then from there we can have our general formula. How do we compute the cumulative expense? Because I've said this is a formula to guide you. So we take the employees who are expected to remain. Employees expected to remain. How many employees will be working in the company at the end of the vesting period? You multiply that with the number of options granted to each employee times the fair value of each option, in which case here we have said, because these are an equity settled, we are going to use the fair value of each option at the grant date. And finally, we multiply that with the proportion of what? Of time. The proportion of time. Basically, in our case, we have said all these items are given. The proportion of time, the fair value, the number of options, which the examiner will not give you is that. And this, where the examiner tried to twist these particular questions. If you check these particular questions for share-based, this is the area whereby the examiner tried to catch you by twisting the information. So I want us to compute this. Number of employees who are expected to do what? Who are expected to remain. The number of employees who are expected to remain. And I hope you have noted that here we have how many years? I think we have a vesting period of 3 years. Basically, you can get that from the requirement. We are required to prepare extract of financial statement for 2015, 2016, 2017. So we have 3 years vesting period. So we will start by computing the number of employees who are expected to remain as at the end of 2015. That is the end of the first year. 31st of December 2015. How do we compute this one? We take the original number of employees. In the first paragraph, the employees who were originally there were 200. And then now, where are we given information about the employees who are expected to remain? Or basically not to remain, rather to leave. That information, we have it within from paragraph 3. Can we go to paragraph 3? In paragraph 3, we are told 20 employees left the company during the year which ended 31st of December 2015, and 20 further employees are expected to leave in each of the 2 years, the year which ended 31st of December 2016 and 2017. So remember here we have 3 years, 2015, 2016, 2017. So we are told in the first year here, that is basically year 1, we are told that the employees who left here were 20. Well, how many employees? were 20. So automatically, it is important for you to note that at the end of 2015, the company cannot tell, we can't tell with certainty how many employees we leave in year 2 and also year 3. So in year 2, year 3, we can also only work with estimated figures. So for us to be able to determine the employees who are expected to remain as per year 1, we will deduct the employees who left in year 1, who are 20. And then in that case, we are told a further 20 employees are expected to leave in each of the 2 years. So in 2016, 2017, the company expects 20 employees will leave in each of those 2 years. In each of those 2 years. So therefore, the employees who are expected to be working in the company here will be 200 minus the one who left in year 1, minus the one who are expected to leave in year 2, minus the one who are expected to leave in year 3. Sasa, yes, and basically this will give us what? This will give us 140 employees. 140 employees. Is that clear? Is that clear? I think this is a question which was is it this was asking about this one? I hope that one is now clear. Can you understand now what you're doing here? Can you see there is a difference between this question and the other one which you have done? Yes. So let's move to year 2. The year which ended 31st of December 2016. So now, at the end of 2016, we know the employees who left here. We know the employees who left in year 1, they were 20. So automatically in year 2, we also know the employees who left here. So that information, we have it in the second sentence. Actually, in the last sentence, we are told during the year which ended 31st of December 2016, and 31st December 2017, 15. So the actual employees who left here were 15, and here were 25, left the company respectively. So now at the end of 2016, we know the employees who left here were 20. The employees who left in year 2 were 16. That is in the year 2016 were 15, sorry, were 15. In this case, at the end of 2016, do we know the actual employees who will leave the company in year 3? At the end of 2016, do we know the actual employees who will leave the company in the year 2017? Automatically no. Automatically no. What that means, here we can only work with the estimated figure. How many employees do we expect will leave the company in 2017? How many employees are expected to leave the company in year 2017? The employees expected to leave the company will remain as 20. As what? As 20. So I hope you can see what you are doing here. We have taken the original employees minus the employees who left in year 1. We know that is 20 minus the employees who left in year 2. We know they were 15. But at the end of 2016, we can't tell the actual employees to leave in year 2017. So this will give us what? This will give us 145. And then now, in the last year, that is 2017, we don't compute the actual employees to remain, but in the last year, we compute the number of employees who actually remained. So these are the actual employees who remained. Because at the end of 2017, we know 20 employees left, 15 employees left in year 2, and 25 employees left. So here we compute the actual employees to do what? The actual employees who remained. So this one, remember this at the end of 2017, this will be 200 minus the employees who left year 1, 20, minus the employees who left year 2, minus the employees who left year 3. So those are the actual figures. Those are the actual figures. That will give us what? This will give us 140 what? 140 employees. 140 employees. So you can see this question is basically different from the other one. So I think now we can move and we basically compute the cumulative expense and the amount of expense to be recognized in the income statement. Cumulative expense and also the expense in what? In the income statement. for the period of 3 years, for the period of 3 years. So this one is quite simple now. So our 3 years, the first year ended on 31st of December 2015, 31st of December 2016, 31st of December 2017. So we are using this formula here. Number of employees were expected to remain as per year 1, 140, year 2, 145, year 3, 140. So we multiply that with the options granted to each employee. The options granted to each employee, that information we have it within paragraph 1. Within paragraph 1, so each employee is granted 500 share option, 500, 500, 500, that will not change. And then we multiply that with the fair value of each option, the fair value of each option, fair value of each option. Take into account the employees have been given a privilege to buy shares, is an equity settled, is an equity settled. We need to use the fair value of each option at the grant date. The fair value of each option at the grant date. Where do we have that information? We have it within paragraph 2. On the grant date, the fair value of each option was 15. So that will not change. That will not change. Times the proportion of time. The proportion of time here will be 1/3. We have 3 years. Here will be 2/3. Here will be 3 out of 3. 3 out of 3. Then we get the cumulative expense. The cumulative expense. The cumulative expense in year 1. Cumulative expense in year 1. What are you getting here? So here we have what? We have 350. That should be the same amount to be expensed, to be treated, to be recognized as an expense in the income statement. Year 2, we have 145 times 500 times 15 times 2 divided by 3. 7 what? 25. I hope those are the figures you're getting. So how do we get the amount to be recognized as an expense in year 2? We get the difference between the cumulative expense for 2 years. The difference is what? Is 375,000. And then finally, the cumulative expense for year 3, 140 times 500 times 15. And basically that will give us what? Yes. And I'm only getting answers from Gilbert. I'm getting answers from Gilbert. Are you getting those figures? Please confirm. Are you getting those figures? 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 Yes. So then we get the cumulative expense here, which should be the difference between these two. And that is what? 325,000. 325,000. Yes. So we are done with that. Then finally, we can prepare the extract, financial statement extract. Financial statement extract. We start with the income statement or the statement of profit or loss. Statement of profit or loss. So we will prepare this for 3 years. The year which ended 31st of December of 2015, 31st of December 2016, 31st of December 2017. And we have said that this amount will be recognized as an expense here. As an expense. So, and the name of the expense will be employees remuneration, or basically employees benefits. Employees remuneration or employees what? Benefits. Remember, what is marked is not this one. What is marked are the figures. These are the figures which are marked. Yes, so the person who is marking your paper will basically be checking for these figures, not the description. 375 and 325. 325. What about the statement of financial position extract? Statement of financial position extract. So we have said whatever you have here, the cumulative amount will basically be recognized here as a component of equity. As a component of equity. As a component of equity. 31st of December 2015, 31st of December 2016, 31st of December 2017. Yes. So at the equity, we will have something called the employees share option reserve. Alternatively, I've said you can just refer to that as equity. If you can't remember that name, just come here and we say in the statement of financial position, the company will recognize equity, which is equivalent to the cumulative amount. The cumulative amount in year 1, 350,000. Year 2, 725,000. Year 3 is what? Is 50,000. 50,000. So that is basically what was required there. The what? The financial statements extract. The financial statements extract. Yes, yes. So that is it. That basically what was required as far as that question is concerned. A question on what? On the share base. So what you need to do, try to look on those two questions we have done, and also the other questions which we did in class. I think if you revise on those topics, so automatically once you come across a question from this, you should be able to comfortably handle that particular question. I want us to just take a short break, and then I want us to come back. We look on a question on deferred tax. There is a question I want us to do here. Let me get the question so that as we come back, you'll be having that question on deferred tax. You'll be having that question on deferred tax. Yes, so I think like there are two questions. I don't know whether time will allow us to be able to do those two questions, but I think we can only do one. Let's just do one. A question on deferred tax. Steve, the past papers are in the class WhatsApp group, but I think someone should reshare them. Yes, can someone reshare those past papers? Reshare those past papers in the class WhatsApp group. Someone to reshare those papers in the class WhatsApp group. So there is a question which is here. I don't know whether we did it in class. Maybe someone to confirm for me. The question for September 2021 on deferred tax. Did we handle that question in class? September 2021. The question on deferred tax. Okay. So I'm told, yes, so maybe you can get that one. This one, September 2021, question 3. Question 3. So ensure you have those that question. We take a short break, just a short break, and then we come back at 5:20. 5:20, we look on this question. It's basically a question on deferred tax. So let's just take that short break. We come back exactly at 5:20. Yes, we continue. I hope you have the question with you. We go straight to part A of the question number 1. And the question reads, with reference to deferred tax, differentiate between permanent difference and the temporary difference. Differentiate those two terms. So part A, Roman 1, we are required to differentiate between the permanent the permanent difference, and the temporary difference. The temporary difference. So this is something we discussed in the topic of this topic of deferred tax. And anytime you're required to differentiate, you differentiate by defining what is permanent difference, what is temporary difference. That's how you differentiate. So first of all, we said the temporary difference. Maybe we can just start with the temporary difference. Temporary difference, we said that this is the difference between the carrying amount and the tax base of an asset or liability. So temporary difference is the difference between tax base, the tax base that is TB, and carrying amount, so carrying amount abbreviated as CA, or asset or liability. Of asset or liability. And I hope also we can be able to recall, we have two types of temporary difference. We have the taxable temporary difference, and we have the deductible temporary difference. So what do we mean by the permanent difference? So permanent difference, we say that this is the difference between the accounting profit and taxable profit, which arises as a result of taking into account certain items of incomes or expenses only in the computation of accounting profit. So this difference is basically occasioned by items such as depreciation. When computing the accounting profit, depreciation is treated as an expense. But when in taxation, in computing the taxable profit, do we use depreciation as an expense? No. Depreciation is disallowable expense. So therefore, there is a difference between accounting profit and taxable profit, which arises as a result of taking certain items of incomes or expenses only in the computation of accounting profit. So is the difference between accounting profit, and remember in this case we said accounting profit is the profit before what? Tax. Accounting profit or the profit before tax, and the taxable profit, as a result of taking into account certain items of incomes and expenses in computation of accounting profit only. In computation of accounting profit only, e.g. depreciation, e.g. the fines, etc. So we said these are items of expenses, but they are only used in the computation of taxable profit. In the computation of accounting profit. We don't use those items in the computation of what? In computation of taxable profit. So that's basically how you differentiate that. Let's move to the other part of that question, that is Roman 2. Roman 2 of the question. So what are we told in Roman 2? Roman 2, we are told Huruma Limited is a public limited company. That is, Huruma Limited, a public limited company, has a portfolio of investment. Portfolio is a mixture of investment, including various subsidiaries, and also undertake various projects varying from debt financing to investing in property and commodities. The following information was extracted from the group financial statement relating to the deferred tax. Relating to the deferred tax provision for the year which ended 31st of March 2021. So that we have that information from note number 1 all the way to note number 6. What are we required to do here? We are required to compute or to determine the deferred tax asset or liability for Huruma Group as at 31st of March 2021 in conformity with IAS 12. Now, if you check on the information which are given in note number 1, note number 2, note number 3, note number 4, 5, basically we're given various items of assets and liabilities. And I think what we need to do is to compute the temporary difference in respect to each of those particular items. For example, in note number 1, you're told Huruma Limited, which is basically the parent company, acquired a controlling interest in a subsidiary, 𝐎𝐲𝐋𝐈𝐍𝐄 Limited, on 1st of July 2020. The fair value of the net assets, the assets and liabilities acquired were considered to be equal to the carrying amount, with an exception of a freehold property whose fair value was 256 million and tax base of 3, that is 248. So in other terms, what we need to do for us to be able to compute whether there was a deferred tax asset or a deferred tax liability at the end of the year, we must compute the net amount of temporary difference, and that is what we are going to use. Now, for us to compute the temporary differences, which you have said is the difference between carrying amount and the tax base of assets and liabilities, we must prepare the schedule of the temporary difference. So let's prepare the schedule of temporary difference. The schedule of temporary difference or temporary differences. So how do we prepare this schedule? We need to have basically a number of columns. So the first column here will be for the various items of assets, stroke liabilities, various items of assets and liabilities. The next column here will be forward. The next column here will be what? Forward. For the carrying amount. I hope you can remember how we were preparing this. The next column will be for the tax base. So this is carrying amount, the CA, and tax base, that is TB. And then we have what? We have the last column here, which will be the temporary difference, that is the TD. And then if you check on the figures which are given here, all our figures are in million of shillings. So equally, our figures here will be in million of shillings, will be in million of shillings, in million of shillings like that, in million of shillings. So I want us to proceed and basically we compute these temporary differences. We compute these temporary differences. So let's do that. So we go straight to point number 1. In point number 1, what are we told? We are told Huruma Limited. Remember, this is now the parent company. So remember what we said, that most of these particular questions will come across for deferred tax at this level. We say they have the aspect of group account. So we are told Huruma Limited acquired a controlling interest in a subsidiary, 𝐎𝐲𝐋𝐈𝐍𝐄 Limited, on 1st July 2020. And then we are told the fair value of assets and liabilities acquired were considered to be equal to their carrying amount, while with an exception of freehold property with a fair value of 256 and tax base of 248. Huruma Limited, or the directors of Huruma Limited, have no intention of selling the property. So in that point number 1, we are given a freehold property. Basically, what we need to do is to identify these two values, the carrying amount and the tax base. But I hope you can be able to see we are given the tax base, which is 248 million. So what is the carrying amount? Remember, once the parent company acquires a subsidiary, this subsidiary revalue the assets. Now, when we are preparing the consolidated statement of financial position, we should take into account the asset of this subsidiary at the revalued amount. So that subsidiary which was acquired, that is 𝐎𝐲𝐋𝐈𝐍𝐄, we are told it revalued this property at an amount of 256. So that property, freehold property, will be recorded in the consolidated statement of financial position at an amount of what? 256, the fair value, value. Then we get the difference here, this minus this, and that will give us what? 8. Is it 8? We try to hurry up because of time. I can see our time is moving very fast. Is that giving us 8? 8. And because it's positive, we say it is taxable temporary difference. We said once you get a positive figure, it's taxable temporary difference. If you get a negative figure, is the deductible temporary difference. Let's move to point number 2. And you are told during the year which ended 31st of March 2020, that is 31st of March 2021, Huruma Limited sold goods at a price of 48 million to another subsidiary, 𝐉𝐎𝐂𝐔𝐒 Limited, and made a profit of 16 million on the transaction. And then you're told 40% of these goods were held in the inventories of 𝐉𝐎𝐂 as at 31st of March 2021. Remember, there is still another question which we did in class, which we were given similar transaction. And basically what we said is that we are told the parent company sold some goods now to the subsidiary, and some of the goods remained unsold. Basically what we consider here for the purpose of computing the deferred tax are the unsold goods. Because the unsold goods, these were part of the inventory. These were part of what? Of the inventory. So what we consider here are those sold goods which were part of the inventory. We need to determine the carrying amount. We need to determine their what? Their tax base. So can we first of all compute the value of those particular goods not yet sold at the end of the year? The value of those goods which were not yet sold at the end of the year. So we are told that the parent sold goods with a selling price or at a selling price of 48. So the parent company sold goods to the subsidiary at an amount of 48. And we are told and made a profit. The profit which was made by this company here is what? Is 16 million. That is the profit which was made, 16 million. And then you're told 40% of these goods were held in the inventory of 𝐉𝐴 at the end of the year. So what we need to do is we compute the unsold goods. Unsold goods. So unsold goods we are told are 40%. 40% of what? 40% of this. 40% of the sales. 40% of the sales. 40% of the sales, which is 48. This will give us what? The unsold goods. 40%. Yes, this one will give us 19.2 million. Now, remember, we say that this one is basically what? This one, if you can be able to recall the question which we did, we say that this is the cost, or actually, yes, is it the cost? Yes, it is actually the cost of the goods now to the buying company. But we say when these goods, or when preparing the consolidated statement of financial position, we take this particular unsold inventory or unsold goods, and then we less something called the unrealized profit. The unrealized what? Profit. So in other terms, the carrying amount will be equal to the unsold goods, but we less the unrealized profit. That's basically what we know from the topic of group accounts. If the parent company sells some goods to the subsidiary, and some of the goods remain unsold, the unsold goods will be reflected in the balance, will be part of the closing inventory of the subsidiary. But now, when preparing the consolidated statement of financial position, we take the inventory of the parent plus that of the subsidiary, and then we less the unrealized profit. Now, in this case, can we be able to compute the amount of unrealized profit? Because we know the parent difference is at 6.4. No, it is not 6.4. This minus this. Yes, negative 6.4. And that is deductible temporary difference. Yes, so if you compare this with the other question which we did in class, you'll be able to see we are doing the same thing. So let's move to point number 3, and we are told Huruma Limited has a portfolio of financial assets. We are told Huruma Limited has a portfolio of financial assets comprising of readily marketable government securities, which are held as current assets for trading purpose. And then you're told these investments are stated at the fair value in the statement of financial position with any gain or loss taken to the profit or loss. So we are told the gain or losses are taxed when the investment are sold. Currently, the investment have a market value of 412 million and accumulated unrealized gain of 64. So basically what you're given here, number 3, are financial assets. And I hope you can see we are told these financial assets, they are held within the current asset. If they are held within the current asset, automatically these are short-term investment. These are short-term investment in shares. Now, such short-term investment in shares, if you can be able to recall from what we did in the topic of financial instrument, we refer to such investment as financial asset at fair value through profit and loss. This is basically investment in shares purely for speculation. So a company has invested. Now, there is a question still we did, and basically I say that as far as this financial asset is concerned, the carrying amount is always equal to the fair value. That is something I said. What about their tax base? Their tax base is always equal to the costs. That is basically what you need to remember as far as the financial assets are concerned. And I think you can see in the last sentence, we are told that currently investment have a market value of 412. Market value is the same with the fair value. So the carrying amount will be equal to the fair value or the market value, which is 412. What about the tax base? The tax base will be equal to the cost. And remember, in our case, we are told that these financial assets, they have accumulated gains over 64. So it basically means that from the date they were acquired, they have their value has increased with 64 million. So if they were acquired, for example, at 300, and we are told there is accumulated gain of 64, their value has increased with what? With 64. With 64. Can we be able, therefore, to get the cost? Can we be able to get the cost? Yes, we can be able to get the cost. The cost will be equal to the current market value, which is 412, minus the increase in the fair value. The increase in the fair value is the revaluation gain. So once we less this the current market price, or actually we less the gain from this current market price, that will give us the cost. That will give us the cost. They were acquired at a cost of what? They were acquired at a cost of 348. 348. So as far as the financial assets are concerned, just remember this. Carrying amount, fair value or market price, tax-based cost. So we get the difference, which will be 64, and that is taxable temporary difference. So we move to point number 4, and we are told, point number 4, we are told, 𝐻𝐶 Limited loan asset has a carrying amount of 168 million after an allowance for credit losses. Credit losses, basically nowadays we don't talk of bad debt written off. We talk of credit losses. If you have a business, your customers have failed to pay, we don't talk of bad debt nowadays. We talk of credit losses. That is a credit loss. You give losses, you give credit to your customers, but because they have failed to pay, you have incurred a loss. You have incurred a loss. So that is called a credit loss. But now, if equally you expect that some of your debtors will not pay the amount they owe you, you create a provision for credit losses. Currently, we don't talk of the allowance for doubtful debts. We talk of allowance for credit losses. So we are told 𝐻𝐶 Limited loan asset. Loan asset is basically whereby the company has given loans. So if you have given loan to your customers, that is a loan asset. You expect your customers to pay you back. You recognize that in your books of account, in your financial statement as a loan what? Asset. So we are told this company has a loan asset with a carrying amount of 168 after making allowance for credit losses of 32 million based on 12 months expected credit loss. And then you're told the tax relief is only available when the specific loan is written off. That one is also very simple. In fact, this is basically similar to receivables. Receivables. So here we have loan asset. Loan asset. Loan asset. These are the loans given to the customers of this company. Once a company has given a loan, there's something you also need to remember from what we did in the topic of financial statements of a bank. Once the bank has given loan to customers, to the bank, that is an asset. To the bank, that is what? Is an asset. So We are given the carrying amount. Carrying amount, no problem with that, 168. But we are told this figure is arrived after the company had created a provision or allowance for credit losses of 132. So now the concept which we use here to determine the tax base is the concept we were using in receivables. In receivables, remember, this is equivalent to receivables. These are loans given to customers, just like where the business will sell some goods to the customers on credit. If you can be able to recall what I said in relation to the receivables, I said carrying amount is always equal to the net. For example, in our case, this one is the net. What about the tax base? Tax base, I said, is equal to the gross. So how do we get the gross? The gross is quite simple. We will take 168, we add back the amount which has already been deducted of 32. So that will give us the gross amount of the loan asset. The gross amount of the loan what? Asset, which will be 200. This minus that, which will give us negative 32, deductible temporary difference. Deductible temporary difference. Deductible temporary difference. So the concept we have used here is equivalent to the concept we were using for receivables. And then number 5, we are told Huruma Limited has an reduced trading losses of 20 million as at 31st of March 2021. These unused tax losses arose from one of restructuring exercise carried out during the financial year, and it is highly expected that taxable profit will be available in the future. So basically here we have something called the unused tax what? Losses. Unused tax losses. So what do you mean by unused tax losses? This is something you, basically for you to be able to understand this, we have to borrow the knowledge you covered in tax. Now, let me ask, if for example, a company make a loss, assuming we have 2024, during this year, the company make a loss of like 20 million. What basically happens to this loss in taxation? Who can tell us? This loss, when it comes to the year 2025, assuming in the year 2025, the company make a profit, how do we treat this loss now in the year 2025? Who can tell us? When it comes to the computation of tax in the year 2025, how do we deal with this particular loss, which was reported in 2024? Reduce the loss, or yes, basically this loss we carried forward and basically we deducted from the profit for the next year before we compute the tax. Before we compute what? The tax. That's basically the concept you covered in what? In taxation. Now, in our case, having that knowledge, we need to ask ourselves two things here. Now, these unused tax losses, will it be taken to the income statement? Will it be recognized in the income statement as either an asset or liability? Do we recognize it in the income statement as an asset or liability? These unused tax losses, do we recognize it as an asset or liability? Because if yes, we will be able to determine its carrying amount. Do we recognize it in the income statement as an asset or liability? Yes or no? Yes or no? Do we recognize it as an asset or liability? In the not in the income statement, in the balance sheet, in the statement of financial position. Do we recognize it there as an asset or liability? No. The tax asset, remember we have a difference between tax asset. Tax asset is what? A tax asset is basically a tax refund you are expecting from the government. But these are losses. These are losses. So if you report losses, that is not recognized as an asset or liability. In fact, it only affects a component of equity. So this one, we don't recognize it in the statement of financial position as either asset or what? Liability. It is not an asset or liability. What that means is that The carrying amount for that item is what? Is 0. Is what? Is 0. Are we together? But now, when computing, for example, the taxable profit of this year, we are saying this loss, which was reported during this year, will be taken into account and deducted from the profit for this year. So tax base is the amount which will be deducted from the profit of the next financial year. So, and the tax base in our case is the losses which were reported. The losses which were reported in our case is 20. Now, this one will have to be carried forward and it will be deducted from the profit of the following financial year in case the company reports what? A profit. So therefore, the amount which will be taken into account in computation of tax for the following financial year will be 20. So carrying amount 0 because this one will not be recognized as an asset or liability, but it will be carried forward. It will have to be offset against future profits. And this such an amount should be carried forward for a maximum of how many years? If you report a loss in your company, you should carry forward that loss for how many years? A maximum of 5 years. A maximum of 5 years. So therefore, we get the difference, this minus this, which will give us negative 20, which is basically deductible temporary difference. Yes. So finally, I think in number 6, we are given the deferred tax at the start. So we are done. We are basically done. We are done. So what we need to do is we get the net amount down here. Can you give me the net amount? Net amount. Net amount. Net amount. We have 8 minus 6.4 plus 64 minus 32 minus 20. Okay. Yes, so here I'm given 13.6, which is basically a net taxable temporary difference. A net taxable temporary difference. So having this, what we are required to do is we are required to compute the amount of deferred tax asset or liability for this company at the end of the year. So we need to compute. Remember, we said a taxable temporary difference. This will give rise to something called a deferred. Sorry, it will give rise to something called a deferred tax. How do we compute this one? We take the net taxable temporary difference. Net taxable temporary difference, what you have computed here, we multiply this with the tax rate. We multiply that with the tax rate. So 13.6 million. Are we given the tax rate? If the tax rate, yes, tax rate is in note number 6, which is 30%. Which is 30%. That will give us what? That will give us what? That will give us 4.08 million. Is that what you're getting? 4.08 million, which is basically a deferred tax what? Liability. A deferred tax liability. Yes. So that basically what was required as far as that question is concerned. Automatically, there'll be some marks for this, and the marks may be for the final answer there. Yes. So that is it. That what was required as far as that question is concerned. And basically, that is it on that question. So I think for today, we stop at that point. So what do we revise once we meet in the next class? I think we have not managed to revise on financial instrument. Financial instrument, maybe I'll get a question on this. Financial instrument. What else from our prediction? What else from our prediction? What else? What else? Have we not revised? Impairment loss? Okay. Okay. So I'll see impairment of assets. Impairment of assets. Risks. Okay, so then you can prepare on those 3 areas. Okay, first of all, prepare on those 3 areas. I think that's what we will revise once we meet on Tuesday. Sasa, financial instrument, impairment, and also recess. Yes. So we stop at that point for today. Have a nice evening and also a nice weekend. We continue from there next week on Tuesday. See you then. call. Here. Yes, welcome to our today's class, and I want us to discuss on this last concept as far as this topic is concerned. And the topic is, well, actually the topic is preparation of group accounts, specifically whereby the parent company has invested in an associate, or basically the parent company has invested in a joint venture. So the first thing we need to ask ourselves here is what is an associate? And also what is a joint venture. So maybe you can start by defining what is an associate. What is an associate? And basically in this case, an associate, we say that this is an entity in which the parent company exercises something called the significant influence. So this is an entity, where the parent company, I hope you can also be able to recall that the parent company is called the investor company. The parent company or the investor company exercises something called significant influence. So when we talk about the parent company exercising significant influence, this basically means that the parent company is not in a position to control the operating and financial decisions made by the associate, or even to control its composition of the board of directors, but the parent company is able to influence the operating and financial decisions which will be made by the associate company. Now, a parent company, or basically an investor company, is said to exercise significant influence over the associate if the parent company has acquired shares which lies between 20% to 49%. If, for example, in this case, we are told 𝐻 Limited acquired shares which lies between 20% to 49% of the shares issued by B Limited, it basically means that this company here will be able to influence the operating and financial decisions made by B Limited. So this company is not able to control the operating and financial decisions of this, but it is purely able to influence. It is able to influence. So therefore, anytime you're given a question and you're told the investor company or the parent company acquired shares which lies between 20% to 49%, it automatically means that the investee company, this company here, is an associate. Is what? An associate. So that is basically the definition of an associate. And then from there we have the other entities here, and basically that is a joint venture. Joint venture. So when we talk about a joint venture, this is an entity in which the parent company and another entity acquire something called a joint control. So this is an entity where the parent company, and another entity acquires joint control. Acquires joint control. So in this case, when we talk about the parent company and the other entity acquiring a joint control, it basically means that assuming we have two companies, A Limited and basically B Limited, so this company may enter into an agreement to acquire equal shareholding or to acquire equal shares in maybe a company which is called C Limited. So this company acquired 50% of the shares, the remaining 50% of the shares are acquired by B Limited. So in this case, we say that these two companies have acquired a joint control in C. Joint control means that the operating and financial decisions of this company here, that is C, will be jointly controlled by A and B. So A and B will be jointly controlling the operating and financial decisions which are made by C. And therefore, this company here, we refer to this company as a joint venture. We refer to this particular company as what? As a joint venture. Now, having known what is an associate and basically what is a joint venture, the other thing we need to ask ourselves here, how does the parent company prepare the group account whereby the parent company has invested in an associate or invested in a joint venture? Now, the preparation of group account in this case is governed by this particular standard, which is International Accounting Standard number 28. And this particular standard requires that whenever the parent company has invested in an associate or basically invested in a joint venture, the group account, the consolidated financial statement should be prepared using the equity method. So the group account in this case, we can say a group account, all the consolidated financial statements should be prepared using the equity method. So equity method basically is a method of accounting, and this particular method, how is it applicable in preparation of the consolidated income statement? How is it applicable in the preparation of the consolidated statement of profit or loss? So first of all, I want us we look on how this method is applicable when it comes to the preparation of the consolidated statement of a profit or loss. So how do we apply this method? Now, number one, when the parent company has invested in an associate or basically a joint venture, and we are preparing this, we are saying we should be able to do that in accordance with the equity method. Now, this method requires one, when preparing this, similar items of revenue and expenses, those of the parent company and those of the associate, or those of the joint venture should not be consolidated, should not be combined. Should not be what? Should not be combined. So if the parent company has invested in an associate, has invested in a joint venture, you are preparing this, the consolidated statement of profit or loss, we are saying use equity method. And actually, according to the equity method, we are saying don't consolidate. Don't consolidate similar items of revenue and expenses, those of the parent and those of the joint venture. Like what we are doing in case of an investment in a subsidiary. We said in our previous discussion, once the parent company has invested in a subsidiary and you are preparing this, you should combine similar items of revenue and expenses, those of the parent and those of the subsidiary. But in this case, we are saying we don't do that. So instead, what we include here, as far as the associate or joint venture is concerned, is the group share. The group share, low associate, or basically joint venture, profit after tax, and other comprehensive incomes. Another comprehensive income. So what we need to do basically is to determine what is the parent company share of the profit after tax, and also the other comprehensive incomes, which were reported by the associate and also the joint venture, and then we include them within the consolidated statement of profit or loss. But in this case, we are saying never make a mistake of consolidating revenue and expenses, those of the parent, those of the associate, or those of the joint venture. Instead, what we include here is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Then from there, let's look on how this method is applicable when it comes to the preparation of the consolidated statement of financial position, statement of financial position. Now, first of all, recall previous class. Anytime the parent company has acquired a subsidiary and you're required to prepare this one, consolidated statement of financial position, we said you combine, you add together similar items of assets and liabilities, those of the parent, those of the subsidiary. Is that what we do here? No. So according to the equity method, when preparing the consolidated statement of financial position and the parent company has invested in an associate or basically a joint venture, we don't combine similar items of assets and liabilities, those of the parent and those of the associate or those of the joint venture. So in this case, we can say similar items of assets and liabilities, those of the parent company and those of the associate or those of the joint venture, they are not consolidated. Not consolidated means that they should not be combined. They should not be combined. Like what we are doing in case of an investment in a subsidiary. Here we don't combine. Instead, what do we include here? What do we include in the consolidated statement of financial position as far as the associate or the joint venture is concerned? We include something called the investment in associate, or basically investment in what? In the joint venture. So we have to compute something called the investment in associate, or basically investment in what? Joint venture. And actually we include that, we recognize that as a component of non-current asset in the consolidated statement of financial position. So how do we compute this one? To compute the investment in associate or the investment in joint venture, we start with the cost of investment. So the cost of investment, basically, this is a purchase consideration which was paid by the parent company in acquiring the shares of the associate or basically acquiring the shares of the joint venture. So how much purchase consideration was paid? And then to this we add the group share. The group share of talk about the post-acquisition retained earnings, post-acquisition reserve. This refers to any reserve of the of the associate or basically the joint venture after it was acquired. So the retained earnings of the associate of the joint venture after it was acquired, or any other reserve of the associate or joint venture after it was acquired, or which must be a post-acquisition. So compute the group share of that. And then to this, you less impairment loss. In most of these particular questions, will be told that the investment in associate or the investment in joint venture had impaired with a certain value. When talk about impairment of investment, this whereby you can invest your money in the company, but that investment loses value. You invested maybe by buying shares having a value of 200,000, but because the company where you invested has been making losses, it has not been able to pay dividends, your investment has reduced in value. The value of the shares you bought has lost some value. So that loss of value of the investment which you made in a company is called an impairment loss. The same case, the parent company may have invested in an associate or joint venture which has been making losses. And therefore, you can be told the amount invested in the associate or the joint venture has lost some value. That is called an impairment loss, and basically we should deduct it here. Whatever you get here is basically what is known as the investment in what? In associate, or basically investment in joint venture, and basically this is the only item which is basically recognized, the only item which is recognized in the consolidated statement of financial what? Position, as far as the associate or the joint venture is what? Is concerned. We don't combine similar items of assets and liabilities, those of the parent and those of who? Of the associate, or basically those of the joint what? Venture. Sasa? Yes. So therefore, basically that's what you need to know. But if you can be able to recall what I said, is that most of the questions you'll come across in the past papers, you'll be given three companies. You'll be given the parent company. You're told the parent company acquired a subsidiary, and also the parent company acquired an associate, or basically a joint venture. So you have three companies. Now you have to remember what we have discussed here. We have said in case the parent company has already acquired a subsidiary, so whenever we are preparing this consolidated statement of profit or loss, we combine similar items of revenue and expenses, those of the parent plus those of the subsidiary, those of the parent plus those of the subsidiary. In this case, I've said we don't include the revenue and expenses of the associate here, So we don't consolidate the revenue and expenses, those of the parent and those of the associate, or those of the joint venture. So you only combine for these two companies. So the same case, when preparing this consolidated statement of financial position, you are not supposed to combine to consolidate similar items of assets and liabilities, those of the parent, those of the associate, or those of the joint venture. So you should only combine similar items of assets and liabilities, those of the parent and those of the subsidiary. So we have said what you include here, as far as this associate or joint venture is concerned, is this item. You have to compute this item: investment in associate, investment in joint venture. That's what you recognize here. So here, what you recognize as far as this company is concerned is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Other comprehensive what? Income. So basically, that is it. That's what you need to know as far as this is basically concerned. And I think with that, we can look on a question. I want us to look on a question on this. We look on a question on this, and basically from there, we should be done. So what will be remaining is for us to be able to do more questions on this. I want us to start with basically a simple question here. We can start with a simple question. So let's look on this question for August of 2023. Let's go to the question for August 2023. August 2023. So once you get the question, please confirm. August of 2023. And this is question number 3. That should be question number 3. 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 Yes, I hope you are there. I hope you have that question with you. Are you there? Yes, yes. So what are we told? What are we told here? So we are told that PICA Limited, a public limited entity, intend to expand its operation by acquiring investment in other entities. On 1st of November 2022, PICA Limited secured 75% equity interest in Shiba Limited under the following terms. Number one, you're told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. Number two, an issue of 3 ordinary shares of shillings 10 per value in PICA Limited for every 5 shares acquired in Shiba. The fair value of PICA Limited shares was shillings 13 at the date of acquisition. The share issue has not been recorded by PICA Limited. So, and then you're told on the same date, PICA Limited also acquired 30% equity shareholding in Amua, paying shillings 24 million in cash. So then we are told the following draft statement of financial position as at 30th of April 2023 relates to PICA Limited and Shiba Limited. So we're given the statement of financial position for the two companies, PICA and Shiba. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information, number 1 all the way to note number 6. And then what are we required to do here? We are required to prepare number 1 or part A to calculate the value of goodwill arising on acquisition of Shiba. Part B, determine the value of investment in Amua Limited as at 30th of April 2023. And part C, we are required to prepare the consolidated statement of financial position of PICA Group as at 30th of April 2023. So before we do that, before we answer our question here, the first thing we need to do, number 1, is basically to come up with a group structure. We said anytime you come up, you come across a question for group account, the first thing you need to do is to come up with a group structure. Then from there, we will go through the additional information. We see, are there some workings which are required? So therefore, let's first of all, we come up with a group structure. So basically working 1 here will be the group structure. The group structure. So which information do we have about this? We are given information about the group structure within paragraph 1. We go back to paragraph 1, you're told, PICA Limited, which is a public limited company, intend to expand its operation by entering intend to expand its operation by acquiring investment in other entities. So we are told on 1st of November 2022, PICA Limited secured 75% equity interest in the company which is called what? Shiba. So we are told this company which is called PICA Limited, we are told secured 75% equity interest in the company which is called Shiba Limited, and we are given the date of acquisition, which is 1st November 2022. Remember, this is now the date of acquisition, the DOA. So we are given the terms of acquisition. Those terms, these are the payments which were made. We are going to compute that when answering part A of our question. And then in there is the last paragraph down there where we are told on the same date. I hope you can see that paragraph. We are told on the same date, that is basically this date, we are told PICA Limited also acquired 30%. This company on the same date, 1st November 2022, it also acquired 30% equity shareholding in a company which is called Amua Limited. Amua what? Limited are paying shillings 24 million cash. It basically means that this company here, Amua, this will be an associate because you can see the shares acquired lies between 20% to 49%. This is basically an associate. So, but in this one, Shiba, this one is automatically a subsidiary company, whereas now PICA Limited will be our parent. So the company which should prepare the group account, we said is always the parent. The group account should be prepared by which company? The parent company. And basically now we have the dates of acquisition. Even before you move to prepare to computing maybe what is required, we said it's also important for you to be able to identify two dates. The two dates, the date of acquisition, which is abbreviated as DOA, and the date of consolidation, the DOC. The DOC is the date we require to prepare the group account. So we can only be able to get this date in our requirement. When are we required to prepare the group account? Can we go to part C of that question? In part C of the question, we are required to prepare the consolidated statement of financial position on 30th of April 2023. So the date of 2022. So what we need to determine here is, were these companies acquired in course of the current financial year? If you can be able to remember the question we did in our previous class, the question for 𝐎𝐍𝐋 and 𝐻𝐶, I hope you can be able to remember our subsidiary was acquired 5 years back. So, but in this case, you can see this subsidiary or these two companies look like they were acquired during the current year, because even year is ending April, the next year will start 1st May, that is 1st May. So it means that this year started on 1st of May, but 2022. So therefore, you can see this date of acquisition, it falls within the current year. So these two companies were acquired in course of the current year. So how many months do we have here? So we can literally count. We have November, December, January, February, March, April, because that year is ending on April. How many months are those? 1, 2, 3, 4, 5, 6. So it basically means that these two companies, that is Sheba and Pika, they were basically acquired 6 months to the end of the year. And we say this is very, very important, specifically when preparing the consolidated statement of profit or loss. If, for example, in our question, though that is not a requirement, if you are preparing, we are required to prepare the consolidated statement of profit or loss. In this case, we said we take the revenue and expenses of this company, that is Sheba, basically for 6 months from the date it was acquired. So we take the revenue and expenses of Sheba for just 6 months by basically apportioning its revenue and expenses on time basis, and then we combine with that of the parent. But in our case, we are not required to prepare the consolidated statement of profit or loss. So therefore, it is important to note that these two companies were acquired 6 months to the end of the year. Now, having that, I want us to go straight to the additional information we see. There are some workings we need to do before we even answer our question. So in Roman 1, let's go to Roman 1, we see what you're told. So in Roman 1, you're told at the date of acquisition, the fair value of Sheba Limited, which is basically our subsidiary here, of Sheba Limited net asset, approximated their carrying amount with an exemption of plant, whose fair value exceeded its carrying amount by 10 million. So we said, if you see this, and we say this is something will come across in all questions for group account, the fair value adjustment, the fair value exercise, which we said is the devaluation of asset by the subsidiary company on the date of acquisition. So we said because the subsidiary company devalued the asset but never accounted for that, we said in preparation of group account, we make two adjustments, the devaluation adjustment and the depreciation adjustment. So we are told that the plant was valued and basically its fair value exceeded its carrying amount by 10 million. Then in the other paragraph, we are told the plant had a remaining useful life of 10 years at the date of acquisition, and then you're told the plant is being depreciated on straight-line basis. The plant is still carried at its carrying value in Sheba Limited financial statement. In other terms, it means that this company devalued the plant but never accounted for that. That's why it is still carried at carrying amount. In the last point of note 1, we are told no fair value adjustment was necessary on the acquisition of Amua. This company didn't devalue the asset. So in that case, what you're given in note 1 is something called the fair value adjustment or the fair value exercise, specifically by which company? By Sheba Limited. So in this case, we said we have to make two adjustments as far as this is concerned. The first adjustment, and this is exactly the same thing we did in the other question. The first adjustment is called revaluation adjustment. And actually, we said this is an adjustment which is made in relation to the revaluation gain or loss. So if you check on the information which are given in paragraph 1, this company Shiba did fair value adjustment. The net asset, the fair value of the net asset approximated the carrying amount with an exception of an item of plant whose fair value, that is what is important, whose fair value exceeded, the fair value was exceeded or was more than carrying amount. The carrying amount we said is also known as the net book value with 10 million. But if you check our figures up there, in our statement of financial position, our figures will be able to see them in thousands of shillings. We must also be consistent. We are going to work with all our figures in thousands of shillings. So this of the fair value of the plant was more than the carrying amount with 10,000 or with 10 million. So this one automatically is a revaluation gain. We said anytime the fair value exceeds the carrying amount is the revaluation gain. And because this revaluation gain was not accounted for by this company, we said this one will be added to the group PPE. This one should be added to the group PPE. And number 2, we said that this 10,000 is a pre-acquisition revaluation reserve. When computing the goodwill on acquisition of Shiba, this will be one of the pre-acquisition reserve we are going to use. So number 2, we make the other adjustment, which is called the depreciation adjustment. Depreciation adjustment. In this case, we said we compute something called the depreciation other charge. The depreciation other charge, and that is depreciation other charge specifically by Shiba Limited. We compute depreciation other charge by who? By Shiba Limited. I hope you can be able to recall the formula which we use here. We said we take what? The revaluation gain, the exact thing we did in our question, in the other question, the revaluation gain. We divide that with the remaining UC price, and then in this case, we multiply that with the proportion of time. Proportion of time, of which we said proportion of time is basically the time we have from the date of acquisition to the date of consolidation. And I hope you can be able to recall here, that from the date of acquisition to the date of consolidation, I hope you can be able to recall we have how many months? 6 months. So these 2 companies, or actually Shiba was acquired 6 months to the end of what? To the end of the year. So this formula is what you need to remember always, is what we use in computation of what? The depreciation other charge. So therefore, to compute this depreciation other charge, we take the revaluation gain, which is this one, 10,000. 10,000. We divide that with the remaining UC price. So what is the remaining UC price of this plant as per the information we have in note number 1? As per the information we have in note number 1, we are told paragraph 2, the plant had a remaining UC price of how many years? Of 10 years. Of 10 years. I hope you can be able to see that. Of 10 years. So that is the remaining useful life. And then we multiply that with the proportion of time. The proportion of time here will be 6 all over 12. 6 all over 12. That's basically how we compute the depreciation other charge. If you take on what you have done in this question, whatever we did in the other question is just the same. It's just the same. And basically I've said that this is an adjustment you'll come across in all questions for group account. In all questions for group account, you'll be told the subsidiary company on the date it was acquired, it revalued the asset. You must be able to recall the adjustment which you make as far as that is concerned. So this will give us what? This will give us 1,000. A half of that is 5 what? 500. 500. I hope you're getting 500. So this 500 will be adjusted in which 2 items? One, this one will be deducted from the group PP in preparing a consolidated balance sheet. And then we also deduct it from the retained earnings of this company. The retained earnings of this what? Company. Now, if in this question also we were preparing the consolidated statement of profit or loss, this one we said we added to the group cost of sales. But automatically this adjustment is not necessary simply because we are not preparing the consolidated statement of a profit or loss. So we will just add that, less that from the group PP, we less it from the retained earnings of who? Of Shiba. Of who? Shiba. So let's move to point number 2. In point number 2, we are told that on 28th April 2023, 28th April of 2023, this is basically some few days to the end of the year. So we are told 𝐉𝐎 Limited, which is this one, sent goods at an invoice price of 7 million to 𝐻𝐶a Limited, which 𝐻𝐶a Limited neither received nor recorded until 5th of May 2023. I hope you can be able to remember what is that. Automatically, that is now what refers the goods in transit. The goods in what? In transit. These are the goods which were sent by this company, but when the year was coming to an end, this company had not received nor recorded those goods. So we refer to them as goods in transit. The goods in transit. The goods in what? The goods in transit. Goods in transit, the GIT, the goods in what? In transit. Now, we said as far as these goods in transit are concerned, we make 3 adjustments. There are 3 adjustments which are made here. That is basically what you need to remember from our discussion. We said we make 3 adjustments. The first adjustment is basically to recognize the goods. To recognize what? The goods. That's the first thing you need to do. To recognize the goods. So these goods which were sent by this company, but when the year was coming to an end, this company had not received and accounted for them. So those particular goods, they had a value of 7 million. Even before we go to the last paragraph, to the next information which is given here, the goods had a value of 7,000,000. So how do we recognize these goods in the books of account of the parent? So if the parent company had received these goods, the parent company or these goods were supposed to be part of the inventory of the parent and part of the payables because the parent company had not paid for them. So therefore, these ones, we will add them to the group inventory. That is first adjustment. And then number 2, we add them to the group payables. So those are the 2 adjustments which will be made to recognize those goods. So if this company had received those goods, they were supposed to be part of the inventory and still part of the payables. Part of the payables. So then the other adjustment which we need to make is the adjustment for unreleased profit, because automatically this company made some profit, but automatically the entire profit was not yet realized. This company had not received those goods, so mean that the goods were not yet to be sold to the third parties. We make adjustment for unreleased, we compute the unreleased profit, and also these goods will give rise to amount of intercompany debt. But before we do that, we can go through the other information which are given in note number 2. Specifically, the last sentence of paragraph 1, we are told 𝐉𝐎 Limited, which is basically the company which sold the goods, had marked up these goods at 25% on cost. And then you are told the last paragraph, the agreed trade payables record in the books of 𝐻𝐶a, the agreed trade payables recorded in the books of 𝐻𝐶a Limited before the above transaction of 6 million. Okay, so before we do that, let's first of all, we compute the unreleased profit on these goods, unreleased profit on the inventory. So the unreleased profit on the inventory. So because we say that these goods were not yet received by this company, so mean that the profit which was made by 𝐉𝐎, this profit was not yet realized. So this unreleased profit is by the selling company, which is 𝐉𝐎. So how do we compute this one? We take the goods in transit, we multiply that with the gross profit margin. So the goods in transit had a value of 7,000. That is the value of the goods in transit, this one, times the gross profit margin. Are we given the gross profit margin in that question? Are we given the gross profit margin? No. Whatever we are given is the gross profit markup. We are given gross profit markup as 25%. 25% as a fraction is 25% all over 100, which is basically a quarter. So if we have that as our markup, How do we compute the gross profit margin? The final figure here, which is 7,000 divided by 5. So that will give us an unrealized profit of 1,400. So this unrealized profit one will basically be deducted from the group inventory. And number two, we also deduct this from the retained earnings of Sheba. The retained earnings of Sheba. So the other adjustments which we need to make as far as these goods are concerned is an adjustment for amount of intercompany debt. Remember, this company sold some goods, sent them to the parent, but basically, because this company had not received those goods, automatically it had not paid for them. So that gives rise to amount of intercompany debt. So the amount of intercompany debt automatically would be equal to 7 million. But now there is also another information which is given in note number 2, the last sentence. Can we go to note number 2, the last paragraph? We are told the agreed trade payables recorded in the books of PICA before the above transaction was 6 million. What does that mean? It basically means that before this transaction here, before this transaction of the goods in transit, there was another amount of intercompany debt of how much? Of 6 million. So by the end of the day, the amount of intercompany debt between Sheba and PICA will be equal to the 6 million plus this other amount of 7 million. So the total amount of intercompany debt by the end of the day will be what? Will be 6 million plus now this one, 7 million. This is the total amount of intercompany debt. So this total amount of intercompany debt, this one, 13 million. This one, recall the adjustment. This one will be deducted from the group receivables and also from the group what? Payables. And remember, this amount of intercompany debt is the same. So it will be deducted from the group receivables and also deducted from the group what? From the group payables. The amount of 13 million. The amount of 13 million. So having said, we need to move to the other point. So therefore, if you come across that adjustment or that item, the goods in transit, you have to recall those 3 adjustments. Recognize the goods, compute the amount of the nearest profit, also they give rise to amount of intercompany debt. So number 3, we are told, a PICA limited policy is to measure the non-controlling interest at fair value on the date of acquisition. We say this information is to help you compute the goodwill. NCI is to be measured at fair value. When computing the goodwill on acquisition of the subsidiary, we use the full goodwill method. We are told for this purpose, the directors of PICA Limited consider Sheba Limited shares Sheba Limited share price of shillings 12 per share to be appropriate. In this case, we are not specifically given the NCI at fair value, but I'll be able to show you how we compute that specifically when answering part A of the question. So, but when computing the goodwill on acquisition of Sheba, we are going to use the full goodwill method. Then number 4, we are told impairment test performed on 30th of April 2024 at the end of the current year revealed that the goodwill on acquisition of Sheba Limited had not impaired. The goodwill on acquisition of Sheba had not impaired. We don't have any impairment loss. And then we are told, but due to the declining sales of Amua, which is the associate, the value of investment in Amua had been impaired to an extent of 2 million. So this is an impairment loss in relation to the investment made in Amua. So we are going to use that in answering part B. And then number 5, we are told Amua Limited reported profit after tax of 4 million during the current year. Also, that one will be used in answering part B. And then we are told number 6, assume all the profit and losses of the 3 companies accrued evenly throughout the year. So I think no workings which are required there. So what we need to do, we can go straight to answering part A of the question, basically whereby you are required to compute the goodwill on acquisition. The goodwill on acquisition of what? The goodwill on acquisition of Sheba Limited. Remember, in this case, I've said, as per the information which are given in note number 3, we are going to use the full goodwill method. We will use the full goodwill method because we are told the policy of the group is to measure NCI at fair value. We said if you come across that information, then compute the goodwill using the full goodwill method. So in this case, we need to have two columns here. So what do we start with here? We always start with the purchase consideration. The purchase consideration which was paid by the parent, company. And then to this, we will add the purchase consideration paid by the NCI. So the purchase consideration paid by the parent company, this information, we have it below paragraph 1. So let's go back to paragraph 1 of our question here. Paragraph 1. In paragraph 1, we are told Pika Limited, which is our parent, a public limited entity, intends to expand its operation by acquiring investment in other entities. In the last sentence, we are told, on 1st April 2022, Pika Limited acquired or secured 75% equity interest in Shiba under the following terms. We are given the terms of acquisition. We are told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. So in this case, we are told when the parent company acquired 75% of Shiba, there was a cash consideration. The cash consideration, that immediate cash payment. Immediate cash payment, if you can be able to recall, we refer to that as what? As cash payment. And in this case, we are told the amount which was paid here is 13 shillings per share. 13 shillings per share. Now, you may decide to compute this. So basically, to compute that, we should take 13 shillings. 13 shillings, you multiply that with the shares acquired in Shiba. The shares acquired. The shares which were acquired. But there is no need of computing this because this value is given in the statement of financial position of Pika. Can we go to the statement of financial position of Pika? Specifically where we have the non-current assets. In the statement of financial position of Pika, under the non-current assets, we have PPE, property, plant, and equipment. And then from there, we have investment in Shiba. Investment in Shiba, you can see we are given 6 million shares at shilling 16, at shilling 13. So meaning that the shares which Pika Limited acquired in Shiba was 6 million. So 6 million times the amount which was to be paid per share, which will give us what? Which will give us 48 million. 48 what? Million. So, and why are we told that the shares acquired were 6 million? So we can first of all determine how many shares are issued by this company. The shares issued by Shiba, you get that from the balance sheet of Shiba at the equity. At the equity, the share capital of this is 80,000. So for us to be able to know the shares issued by Shiba, we will divide that with the par value. And I hope you can see the par value where we have the word ordinary shares in the balance sheet. The ordinary shares of this company, they have a par value of 10. So the shares issued by this company are 8,000. So the shares Pika Limited acquired in Shiba were 75%. So if you get 75% of this, that basically will give you 6,000. Alan, what are you referring to, 78 or 48? Okay, so the price is okay. This one should be 78, not 48. Yes, so that one is okay. It should be 78. Yes. So therefore, the cash consideration here is 78. 78. So 13 shillings times the shares acquired. Then I want us to go back to the information we have below paragraph 1, because other than this cash consideration, in point number 2, we are told there was an issue of 3 ordinary shares of shillings 10 per value in Pika Limited for every 5 shares which were acquired in Shiba. If you can be able to recall, we refer to that as the share exchange consideration. The share exchange consideration. So for the share exchange consideration, you need first of all to remember the formula. How do we compute the share exchange consideration. The share exchange consideration. In this case, we say compute the number of shares which were issued by the parent. Issued by who? The parent company. So this one we said the examiner will not give you this one, and then you multiply these shares with their fair value or market price on the date of acquisition. So this is something we are already given. In that point. In that point, we are told the last sentence of that point 2, we are told the share issue. Okay, not that point, but point number 2. There is one somewhere we are told the fair value of Pika Limited shares was shillings 13 per share on the date of acquisition. So the shares of the parent company on the date of acquisition, they had a market price or a fair value of shillings 13. That one is already given. So what we need to do is to determine this. How many shares were issued by the parent company to pay the purchase consideration? We are going to use that information we have in point 2, where we are told an issue of 3 ordinary shares of shillings 10 in Pika. So Pika here was to issue, Pika Limited was to issue 3 shares for every 5 shares which were acquired, for every 5 shares which were acquired. So in our case, do we know how many shares were acquired by Pika in Shiba? Do we know how many shares Shiba Limited acquired in Pika? Sorry, how many shares Pika Limited acquired in Shiba? Do we know how many shares were acquired by our parent company, the subsidiary? Do we know how many shares were acquired by the parent company in the subsidiary? Do we know how many shares were acquired? Do we know how many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? We have already dealt with that somewhere here. Just now. Yes, we have said the shares which were acquired were 6 million. We have computed that here. We have said that this one was also computed based on 6,000 shares which were acquired. The shares which were acquired were 6,000. So what we just need to do is to cross multiply, then we divide. So therefore, the shares which were issued here will be, because we need to cross multiply, then we divide 3 times 6,000 divided by 5. So this will give us 12, and basically that will give us what? That is 600. That is 600 shares. So these are the shares which were issued by the parent company. The parent company issued these shares. It issued, that is 600 shares, and then we need to multiply those shares with their fair value, which is shillings 13. So therefore, let's compute the share exchange consideration. That is 6 times 13. So I'm getting a figure of 46,800. Are you getting that figure? 46,800. 46,800, yes. So now, this is the purchase consideration paid by the parent. Then to this we say, when using the full goodwill method, we add something called the NCI at fair value. In other terms, if you can be able to recall, we said NCI at fair value. This refers to the purchase consideration paid by NCI. So when the minority shareholders acquired their shares, how much amount did they pay? Now, if you go back to the information we have in note number 3, we are not given this NCI at fair value. If you can remember the other question we did for Kuja 20, this value was given, the NCI at fair value. But if that NCI at fair value is not given, to compute that is quite simple, because we are saying when minority shareholders acquired their shares here, how much amount did they pay? So automatically you need to determine how many shares were acquired by the minority shareholders here. We know the parent company acquired 75% of the shares. The remaining 25% of the shares are the ones which were acquired by who? The minority shareholders. The minority shareholders acquired the remaining 25% of the shares. So therefore, we need to compute how many shares were acquired by the minority shareholders. 25% of the shares issued by this company. Hope you can remember, we have said that the shares issued by Sheba are 8,000. Its share capital divided by the par value. The shares issued by Sheba are 8,000. So these are the shares acquired by minority shareholders. So for us to be able to know the amount they paid for those shares, we have to multiply that with the market price of the shares on the date the shares were acquired. So automatically the shares were acquired on this date, the date of this date of acquisition. Now, if you go back to point number 3, the last sentence, we are told for this purpose, the directors of Pika Limited considered Sheba Limited share price of shillings 12 per share to be appropriate. So it basically means that when the parent company acquired 75% of the shares, when the minority shareholders acquired 25% of the shares of these, each share had a market price of shillings what? Each share had a market price of shillings 12. So meaning that the amount of purchase consideration paid by minority shareholders was what? Was the shares they acquired, 25% of these times the market price per share. They paid shillings 12. They paid shillings what? 12. So therefore, in case you come across a question and you're not given the NCI fair value, what you do, compute the shares acquired by minority shareholders by NCI, multiply those shares with their market price on the date of acquisition. That will give you what? The purchase consideration which was paid. So this will give us 0.25 times 8,000, which basically 2,000. 2,000 times 12, which will give us what? 24,000. Yes. So in this case, we need to add all this, which is the purchase consideration paid by the parent and who? NCI. So we have 78 plus 46.8 plus 24. And this will give us 148,800. So that is the purchase consideration paid by both the parent and also who? NCI. And then to this, we proceed with less the fair value of net assets acquired. Fair value of net assets acquired. Fair value of net assets acquired. This is basically something we said the examiner will not have given you. So, but you have to compute this. We said in this case we need to determine at the date this company was acquired, what was the fair value of its net asset. And actually we said we compute that by adding its ordinary share capital plus the pre-acquisition reserves. So therefore what we need to do here is basically to take the ordinary share capital of this company, that is of Sheba. Where do we get that? We get that at the equity section in the balance sheet of Sheba. So the ordinary share capital of this company is what? From its statement of financial position, it is 80,000. So below that, we don't have anything else, but basically what we have is the retained profit. So retained profit, or basically the retained earnings, this one we need to compute the retained earnings of the date of it was acquired. Now, if you check on this question, there is nowhere we are told we are given the retained earnings of this company on the date it was acquired. So generally, this is something you need to know moving forward. Anytime a subsidiary company was acquired during the current year, there is no single time the examiner will give you its retained earnings on the date of acquisition. But if you can remember the other question which we did for Kuja Twende, which was acquired, a subsidiary was acquired 5 years back, we were given its retained earnings on the date of acquisition. So, but a subsidiary acquired during the current year, the examiner will not give you its retained earnings. In very rare cases, the examiner will give you that. So you have to compute. Basically, what we know, I hope you can be able to remember that this subsidiary was acquired 6 months to the end of the year. That's what we said. It was acquired 6 months to the end of the year and automatically 6 months from the start. So what we do for us to be able to compute, because what you're interested with is the retained earnings of Sheba on this date. It was acquired 6 months from the start of the year, 6 months to the end of the year. So if you go back to the information we have in the balance sheet, when you go to the balance sheet of Sheba, specifically at the equity, you can see we are given the retained earnings of Sheba at the start of the year. That is on 1st May 2022. 1st May 2022 is at the start. We are given the retained earnings of that company at the start of the year. The retained earnings of Sheba. Remember, you're interested with Sheba at the start of the year here, which was 12,800. That is the retained earnings of Sheba at the start. And then we also given the profit for this year, the retained profit for this year for Sheba, which is 10,800. So the reason why you're given that information is for you to be able to compute the retained earnings of Sheba on this date here, this date. How do we compute the retained earnings on the date of acquisition? Very, very simple. We take the retained earnings at the start of the year, this one, which is 12,800. And then to this, we add the profit, which was the retained profit for this period, for these 6 months, because we're interested with the retained earnings of Sheba on that date. So how do we get the retained earnings for the first 6 months? So we will take the retained profit for the whole year, which we also given as 10,800, and then we apportion this on time basis. We multiply that with 6/12 so that we know the retained earnings for the first 6 months. So once we take this as the retained profit for 6 months, we will be able to get the retained earnings of Sheba on the date it was acquired, that date there. So this will give us 12,800 plus basically half of this, which is 5,400. And this will give us what? This will give us 18,200. 18,200. Are you getting 18,200? 18,200. Yes, that will give us 18,200. And basically that is the retained earnings of Sheba on the date it was acquired. So therefore, anytime a subsidiary was acquired during the current year, the examiner will not give you its retained earnings on the date of acquisition. You must compute that. So that is basically the only reserve which we have within the balance sheet of Sheba. Then from there is something we said you must always remember to check whether the subsidiary company revalued assets on the date of acquisition. If yes, was there a revaluation gain? And I hope you can be able to remember on the date Sheba Limited was acquired, it revalued an item of asset, and there was a revaluation gain of 10,000, this one. So that one, we recognize it here. We recognize that there as a pre-acquisition what? Reserve. And basically in our case, we don't have anything else. So what we need to do is basically to get this total. To get this total, so let's add all those figures. We have 18,200 plus 10 plus 80. This will give us 108, 200, 108, 200, 108, 200. And in this case, remember, we're interested with the goodwill of the parent and the goodwill of the NCI. So what we do here, we take the net asset acquired by the parent and the NCI. The net asset acquired by the parent and the NCI should be 100% of this. So 100% of this is 108, 200, which basically will be less from the figure we have up here. We take 100% of that. So we less that from 148, 800. And this will give us a figure of 46 what? 600. 4,600. So this is what? This is the goodwill on acquisition. The goodwill on acquisition. And remember, the information which are given in note number 4, we are told that this goodwill is not impaired. The goodwill has not lost any what? Any value. So that is basically the amount you are going to take to, you are going to recognize in the statement of financial position as a non-current, asset. So this is what was required in part A of that question. And basically by doing this, the marks are located here. Basically were 4 marks. So let's move to part B of that question. Part B. So in part B, what are we required to do? We are required to compute the value of investment in 𝐉𝐻𝐶 Limited. So this is part B, value of investment in 𝐉𝐻𝐂𝐔𝐒 Limited. In 𝐉𝐻𝐂𝐔𝐒 Limited. In other terms, what you're required to compute here is something called the investment in associate. Remember, 𝐉𝐻𝐂𝐔𝐒 Limited is an associate. We are required to compute the investment in associate. So, and what you just need to recall is the format which I've just given you. How do we compute the investment in an associate? I've said we take the cost of investment, or the purchase consideration, and then to this we have said we add the group share of post-acquisition retained earnings, and any other reserve. And I think in this case, this associate do not have any other reserve other than the retained earnings. And then to this we less what? Any impairment loss. Any impairment what? Loss. This one is quite simple because everything is provided here. I think we can start with the impairment loss, this one, which is given in note number 4. In note number 4, we are told that impairment test performed at the end of the year revealed that the goodwill on acquisition of Sheba was not impaired. This one had not impaired, but due to declining sales of 𝐉𝐻𝐂𝐔𝐒, the value of investment in 𝐉𝐻𝐂𝐔𝐒 was impaired by 2 million. So we have an impairment loss here of 2 million, which basically we less here. So what about this one? So we know that this associate was acquired 6 months to the end of the year. So if you go to note number 5, we are told 𝐉𝐻𝐂𝐔𝐒 Limited reported a profit after tax, which is the same with the retained profit of 4 million for the year. During the current year, this company reported a profit of 4 million. And taking into account it was acquired 6 months to the end of the year, we want to know how much profit will the parent company be entitled to share. We will take the profit for the whole year, 4 million, but in our case, we're interested with the profit from the date 𝐉𝐻𝐂𝐔𝐒 was acquired. 𝐉𝐻𝐂𝐔𝐒 was acquired 6 months to the end of the year. So we compute the profit after 𝐉𝐻𝐂𝐔𝐒 was acquired, and that is what we refer as the post-acquisition retained earnings, which will be 6 months to the end of the year. We multiply that with 6 over 12. We get the profit for the last 6 months, and then we get the parent company share of that. The parent company share of that will be equal to 30%. So let's work out that, which is basically quite simple. Half, which is 2,000, we multiply that times 0.3. And that will give us what? That will give us 600. Then this one is given. So we go to the balance sheet of the parent, and the assets. How much amount did the parent company invested in 𝐉𝐻𝐂𝐔𝐒? So that is given in the balance sheet of PICA under the non-current assets. The amount invested in 𝐉𝐻𝐂𝐔𝐒 is 24,000. So you can see this one was quite simple because almost everything was given. So we compute now the investment plus 600 minus 2,000. So that will give us 22,600. I hope that is what you're getting. Yes. And basically by doing that, equally the marks allocated there are 4. So let's move to the last part of the question, whereby we are required to prepare the consolidated statement of financial position, basically for the year, which ended 30th of April 2023. 30th of April 2023. So Aaron, you're asking about what? How did you get 20,000 revaluation gain on part? Where do you have revaluation gain? Aaron? Do you have a revaluation gain somewhere of 20,000? I can't see that. I can't see any revaluation gain of 20,000. I can't see a revaluation gain of 20,000. So maybe retype your question again. Retype your question again of 10,000. This is what we dealt with here, Aaron. Take what we did in working one. And basically, can you try to see what we did in the other question? If you can be able to recall what we did in the other question, we are doing the same thing here. We are doing the same thing. So try to understand those concepts which are in all questions, especially this one. This one, you must understand this. This is in all questions for group account, fair value adjustment. So let's prepare this one. And basically, how do we prepare this? I want us to do this in the next 20 minutes. How do we prepare this one? We prepare this basically by combining similar items of assets and liabilities, those of the parent, those of the subsidiary. And that's why in this case, for example, you can see even the examiner has not given you the asset and liabilities of who? Of associate, because we don't consolidate an associate. What we include here as far as the associate is concerned is what we have computed here. Yes, so we only add assets and liabilities of the parent, those of the subsidiary. The other thing which is also important for you to note is that even if this subsidiary was acquired 6 months to the end of the year, we don't do what? We don't apportion asset and liabilities on time basis. So apportionment only applies to revenue and expenses. So we have to take the full amount of asset and liabilities of the subsidiary, even if it was acquired 6 months to the end of what? Of the year. So let's do that. So here, we will start with the non-current assets. So I will take the PPE and basically take the PPE of the parent, 135, plus the PPE of the subsidiary, 100, 400. And then to this, we need to check, do we have any adjustment affecting the PPE? Yes, this working one, this revaluation gain, we said we added to the PPE. And then number 2, we have this depreciation under charge of 500, which we said we less from the PPE. So 2 adjustments here. We add 10,000, the revaluation gain, and then we less what? We less 500. No any other adjustments. No any other adjustment. We get the final figure. We have 135 plus 100, 400 plus 10 minus 500. And I'm getting 244, 900. 244, 900. So below that, please confirm whether you're getting the same figure. So below that, we have investment in Shiba, investment in Amua. Do we include those items here? The purchase consideration paid in acquiring shares of Shiba and Amua? No. Instead, the investment in Shiba has been used in the computation of this goodwill. So what we include here in relation to Shiba is the goodwill on acquisition of Shiba Limited. How much is that? 4,600. That is basically what we include here. In relation to Amua, we include what we have computed here. The investment in Amua. The investment in Amua, what we have computed here, 22,600. That's basically what we include here. And I think in our case, we are done with the non-current assets. So we need to proceed and basically record the current assets. So for the current asset, I will start with the inventory. So for the inventory, I will take for the 2 companies, I combine them, and then I make the necessary consolidation adjustment. 28,400 plus 12,100. And we say we have a number of adjustments affecting that. One, we have this goods in transit. We said this 7,000 will be added to the group inventory. And then we have this unreleased profit over 14, which we said we also left from the group inventory. So 2 adjustments to be made here. So we add 7,000, the goods in transit, this one, And then we do what? We less this unreleased profit of 14. We less that unreleased profit, we get the final figure, the final figure. So we have 28,400 plus 12,100 plus 7 minus 14. So which will give us 46,100. Okay. So below that we have what we have the trade receivables. We have the trade receivables. The trade receivables, I'll do the same. I'll take the trade receivables of the two companies, I combine them, 27,500 plus 19,900. And then I check, do we have any adjustment here? Yes. We have this adjustment for amount of intercompany debt, 13, which will be deducted from this group receivables. I only have this adjustment here. That you know any other adjustments. So we get the final figure, 27,500 plus 19,900 minus 13. So which will give us 34,400. So then finally we have the cash and cash equivalents. So we add for those two, for the two companies, that is basically 10,600 plus 68 plus 68. Do we have any adjustment affecting this? No, because we don't have any cash in transit. We just need to get the total. We just need to get the total. So that will give us 17,400. 17,400. And then what do we need to do? We need to get the total assets. So the total assets, we add all this. We have 17,400 plus 34,400 plus 46,100 plus 22,600 plus 46 plus 244.9. So in this case, I'm getting 406. I'm getting 406, 406, 406, 406,000, 46,000, 46,000. I don't know whether you're getting the same. So I can do away with this to create space here. Yes, someone to confirm whether you're getting the same. Yes, that is confirmed by Juliet. Okay, so then from there we proceed and record equity. So that is share capital and reserves. So at the equity, we will start with the ordinary share capital. Ordinary share capital. In this case, we said for the ordinary share capital, we record that of the parent company only. The ordinary share capital of the parent, in this case, will be 160,000. But in this question, the ordinary share capital of the parent will be having an adjustment. We said whenever the parent company has paid some purchase consideration by issuing shares, those shares which were issued by the parent company, they were not accounted for. And basically, we said the shares issued will affect the ordinary share capital and the share premium. So, and how many shares were issued by the parent company, the payment of purchase consideration? We computed those shares. In our computation of the purchase consideration, did we say the parent company issued, was it that 600? Because the parent company was to issue 3 shares for every 5 shares acquired. The shares acquired was 6,000. I think we multiplied this. So this was the 3 times 6,000 divided by 5. And I think this was coming to 36. Yes. The shares issued by the parent were 36. Now, what do we add here to the share capital? The amount we add to the share capital is an amount equal to the par value. So the par value of these shares, would be 36 times the par value per share, which is 10, So that will increase this. So this will be 36,000 times this, which will give us 196. And when the parent company issued these shares, what was the market price per share? Ile market price tumetumia ku compute purchase consideration. Was it, it was 13, Was it 13 shillings? 13. So the amount which is above 10, and basically that is 3 shillings, that is a share premium. So belonging to the parent. So in relation to these shares which were issued by the parent, tutakuwa na share premium ya 36 times what? Times 3 shillings. Times 3 shillings. Times 3 shillings. That will give us what? That will give us what? That will give us then 800. That will give us then what? 10,800 is the share premium of the parent. Yes. So then from there, there is something we said which must be computed here, which we said this is one of the items which is quite demanding, and that is the retained earnings. And I think moving forward, there are those items. In fact, because we said even in an exam setup, these are items you don't need to compute. Like this one, the retained earnings, because we said by doing this, it's not a must you have to get everything correct. Sasa? Yes. So maybe first of all, you can skip this. If you're going to have some time, we will compute. But this is an item I'll not advise you, even in an exam, never bother yourself computing this. The other item we also need to compute and we include here is basically something called the non-controlling interest. Also, we will compute that if time will allow. But let's first of all, we proceed and record the liabilities. We will be able to compute that. So these are two items which are quite demanding. So the non-current liabilities, I will start with there are actually two. We have 10% bank loan, 10% bank loan. No adjustment for this. We just add that of the parent and that of the subsidiary. This will give us 35,000. No adjustments there. Below that, we have deferred tax. We said anytime you come across a component for tax, also this is a free mark. No adjustment. We just add 37 plus what? Plus 31, which will give us 68. No adjustments here. Then we go to the current liabilities. For the current liabilities, we will start with the trade payables. Trade payables, we add that of the parent, 28,800, plus that of the subsidiary, which is 21,200. And then now to this, we have, I think, two adjustments affecting the payables. One, we have these goods in transit. This amount of 7,000, we said we added to the payables. So to the payables, we add 7,000. And then I hope you can also be able to recall we have this amount of intercompany debt, 13. So to be deducted from payables. So we also less 13,000. So those are the only items, the two items to be adjusted to the payables, So let's get the final figure here, which is 28,800 plus 21,200 plus 7,000 minus 13. So I'm getting 44,000. 44,000 like that. 44,000 like that. And then finally, I have current tax. Current tax, we said, being a component of tax, this is also another free mark. So you have 19 plus what? Plus 13. Plus 13. This is also a free mark. And basically, this will give us what? This will give us 32. This will give us what? 32. This will give us 32. Then we will get the total equity and what? The total equity and liabilities. The total equity and what? And liabilities. The total equity and liabilities. Do we need to compute these two items or we can just leave them? Do we need to compute them or we can just leave them? Because like this question, by doing that, we'll be able to get all the marks, even without necessarily coming back to compute these two items. I hope you can be able to recall the other question which we did, the computation of these two items. We said we were able to see that it is basically quite demanding. But basically, once we're able to do this, you'll be in a position to score all the marks. You'll be in a position to score all what? The marks. You can see the marks are allocated there are 12. In most of the cases, this is how the marks are allocated. For every 6 correct entries, you are given 2 marks. You're given 2 what? 2 marks. For every correct entry here, you get how many marks? You get 2. You get 2. It basically means that it's not a must. You have to get everything correct. Everything good. Correct. Sasa? Yes. So easy 2 items. I think we can just leave them. No need of computing them. You'll be able to see that even during our revision, kuna zile vitu tutakuwa tuna compute. Tunaambia hii kwa mtihani na this one, you don't need to compute that. It will basically consume a lot of your time, and you don't have to compute some of those items for you to be able to get all what? All the marks. All what? The marks. Now, I want us to stop at that point for today. I want you to have a short break before you start the other class. We stopped at that point for today. There are so many questions from the past papers. I want us to do another one question in our next class. Then after doing that, we will wind up with this topic, but we will be able to come back to this topic during our revision because there are like two topic, not big topic. We have a topic on borrowing cost. Will just take us one class, and a topic on conversion of partnership into a limited liability company. I think majorly those are like the computation topics which are remaining. Before now, we start our revision and we look on some theory topics which are remaining. So right now, I said we are almost 90% done with the syllabus, 90% done. I'm hoping that actually by next week, because on Tuesday we will be able to do one question on this. We will be able to see whether we can be able to do 2. If we can be able to do 2, that will be very good for us. We see whether we can be able to do 2 questions. We wind up with this, and then from there, our next class on Thursday, God willing, we should be able to do borrowing costs, and then we start on. I think let's start with the conversion of partnership on Thursday, which we should be able to finish on Saturday, and it basically means that by the other week we will be having, I think, one computation topic, which will be remaining. Though there are other theory topics which will be remaining, which I think we will be able to create time and basically go through them. So therefore, I'm saying right now, I think we are over 90% done with the syllabus. Remember what we agreed by 21st, we should be able to embark on revision. We should be able to embark on what? On revision. Sasa? Yes. So maybe you can check on the question of consolidated statement of financial position so that we finish on this work, on this topic. So let's stop at that point for today. We continue from there in our next class. So have a nice weekend. See you next week.
It's a long time. On question. Which question did you? But for the sake, those who will miss, we choose one day. Either Tuesday or Wednesday, we meet early morning. Those who miss, they'll get the video. Kindly. Which question did I leave? Where did I leave? Which question did I particularly say? Yes, let me pick that question. So that was August 2024. August 2024. We have it as August 2024. We have it as question 5. Tafadhali. So August question 5C. So we have to do 2 questions is when you introduce VAT and then we introduce VAT. So we are being told that smart boot, the examiner tells us the smart boot, limited commenced manufacturing of leather shoes, commenced manufacturing of the leather shoes, commenced manufacturing of what they call the leather shoes, commenced manufacturing of the leather shoes on 2nd January 2022. On 2nd January 2022. Incurring the following expenditure. Incurring the following expenditure. So number 1 is the factory building. What does it qualify for? Factory building. Factory building. Factory building. So that is ID at 50%. So the next is the processing machine. Processing machine. Processing machine. The next is processing machine, 50%. That should also be ID. Then we have computers. We have the computers. Computers. What happens to the computer? That's 25%. Then the next is conveyor belt. Conveyor belt. Conveyor belt, 50%. Conveyor belt is machines that are used to support manufacturing. Then we have the next, we have what we call staff canteen. Staff canteen. Staff canteen. Staff canteen. That is 10% IBT. Then we have the next, what we call sewerage system. We call it the sewerage system. Sewerage system. That is 50% for the sewerage system. Then we move to the generator. Generator is ID because this is manufacturing. That should be 50%. Generator should be 50%. Then we have the go down. Go down. That is 10% for the go down. That should be 10%. Go down is basically 10%. We say that go down is 10%. Go down is 10%. Heating plant. Heating plant. Heating plant. Heating plant. That should be 50%. That is manufacturing. Then you have the next, that is lorry. Lorry should be. Lorry should be. Lorry should be 25%. Then we have the next, that is sports pavilion. Sports pavilion. Sports pavilion. Sports pavilion. That should be 10%. Those are structures for the welfare of employees. Then finally, we have the loose tools. Where does loose tools go to? Loose tools. Where does the loose tool go to? It goes to wear and tear 10%. Those items that used to be under JV, we take them to 10%. We take them to 10%. So that's okay. Are we together on that analysis? If you're together, we respond with a yes. Tuko sawa. If we are together, we respond with a yes. Kindly, we respond with a yes. Perfect. I need all of you. I cannot move minus you. So look at those items. Those items particularly touches on 2020, 2022. Then the examiner tells us that the company purchased the following. That the company basically purchased the following. The company purchased the following on 1st January 2023. We have furniture. Furniture will be 2023, remember that is 2023, 10%. Then we have saloon car. What happens to that saloon car? What happens to that saloon car? And at what rate do we use? Saloon car is wear and tear 25%. What do you do to it, Joy? We are going to restrict. The value is more than 3 million, so we restrict. We restrict. The next is boiler. Where does the boiler go to? What is the rate of investment allowance for the boiler? The rate of investment allowance for the boilers. The rate of investment allowance for the boiler. The rate for the investment, 50%, 50%, 50%. Then we have the next what you call scanners. 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 That should be 25%. Then you have the packaging machine. Packaging machine. Packaging machine. Packaging machine. That should be 50%. Thank you so much. Then you have the staff clinic. The staff clinic was constructed at a cost of 2,080,000 and utilized with effect from 1st October 2023. So where does the staff clinic go to? Staff clinic, where does it go to? Staff clinic, Joy, think again. Staff clinic, that is IBD, 10%. 10%. But you don't apportion. Don't apportion. Don't apportion. You claim the whole amount. Then you're being told that a borehole was drilled at a cost of shillings 800,000 and utilized. The examiner tells us utilized from July. Where does the borehole go to? Where does the borehole basically go to? 50%. So then you're being told a delivery van was involved in an accident that is on 1st March 2023 and was written off. A delivery van was involved in an insurance and was written off. The insurance compensation was 1.4 as full compensation. The insurance compensation was 1.4 as a full compensation on 1st December 2023. How do you treat that compensation? That compensation, how do we basically treat it? How do we treat it? How do we treat that compensation? So that's the disposal value. That is a disposal value together. That is a disposal value together. That is a disposal value. So then we're being told a perimeter wall was constructed at a cost of 1.2 million and put to use from 1st July 2023 and put to use from 1st July 2023 and put to use in July and put to use on July 2023. How do you treat the perimeter wall? We claim investment allowance at what rate? At what rate? Tuchangamke kidogo. We cheer, that is 50%. So the examiner tells us compute investment allowance due to smart boot manufacturing for the year ended 31st December 2022 and 2023. So this one runs for 2 years. This one runs for 2 years. So I start with the smart boot. I call it the smart boot. Smart boot limited. We call it investment allowance. We call it for 2020, for 2023 together. Investment allowance for 2023. So I'm not going to separate it. This method, I want to summarize everything. So we start with the nature of item. We call it nature for 2022, sorry. We start with 2022. Nature of what we call of item. Nature of the item. We have qualifying amount, investment, allowance, investment allowance rate, investment allowance rate. Then you have the investment allowance. Then we have the investment allowance. Then we have down here as residual. So together. So 2022, the first item that you have is a factory building. So the qualifying amount is 14,640. That's a Kuera Fadali. The rate is 50% for the first year. So what is the investment allowance? 50% for the first year. What is the investment allowance? If that is 50% for the first year. So what is the investment allowance? What is the investment allowance? What is the investment allowance? So that should be 7. So that should be 73. So the balance is that. So then we get to the next processing machine. Machinery. So processing machinery, we have it having a figure of 4712. The rate is 50%. So what is the rate? The rate is 50%. So what is 50% of that? 50% of that. So give me 50% of that. That is 2356. 2356. So the residual is also 2356. So then the next we have computers. For those who wanted to know, this is ID, this is ID, this is wear and tear, 25%. So computers, we have 384. The rate is 25%. So what is 25% of that? 25% of that. 25% of that. What is 25% of that? So that is 96. So what is the residual? Residual is how much? That is 288. So then the next we have what we call conveyor belt. We have the conveyor belt that should be ID. So conveyor belt is the 1240. The rate is 50%. So what is 50% of that? Molimo can try, that should be 620. Is it 620? Is Molimo correct? That should be 620. Is that correct? That's perfect. Then we have the staff canteen. So that should be IBT. That's 2 million. So that should be 10%. So 10% in this, that should be 244. So what is the balance? 244, what is the balance? What should be the balance? What should be the balance? Or the residual? When you less that, when Limo is waiting for you, that's 2196. So we have 2196. So the next on that item, that is basically delivery van. Delivery van, that should be 125, that is 160. So the rate is 25%. So what is 25% of that? 25% of that. $10,040. So what is the balance? What is the balance? What is the balance? What is the balance? So that's 31. Perfect. So then we go to the next, we have sewerage system. That's 1280. 1280. That should be 50%. So 50% is the 640. Is Molemo correct? That should be 640. Together, team. So then we move to the next. We have generator, because this is manufacturing. Generator. That should be 400. So then we have 50%. So what is 50%? 50%. That should be 200. 200. Perfect. So then we have the next. We have the next, that is what we call a go down. Go down. That should be 2.6. So that is 10%. That should be 260. So what is the balance? What is the figure for the balance? What is the balance? Is that the figure? Perfect. Then you proceed to the next, we have the eating plant. Eating plant. So for the eating plant, that should be 1.4. 50%. This is 700,000. Balance should be 700,000. So we proceed to the next, we have lorry. So lorry. 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 That's 29.48. And we understand that that should be 25%. What is 25% of that? 25%, that what should that be the figure? 737. So what is the balance when you get 737? What is the balance? Give me the balance. Give me the balance. So what is the balance? 22, 1100. Perfect. So then we have what we call the sports pavilion. Sports pavilion. That is IBD. That is 1.8. 10% that should be 180. 10% should be 180. That should be 1620 together. Then the last item is loose tools. So loose tools, that should be 144. So 10%, that should be 14,400. What is the balance? What is the balance? What is the balance on that? What is the balance? What is the balance? So that is 129,600. 129,600. So we have the total investment allowance for 2022. So add for me that very fast, kindly. Add for me that very fast, kindly. Add for me that, kindly. So add for me those investment allowance for 2022. Very fast, kindly. So get for me 72, 73, 20, 23, 56, 96, 620, 244, 10, 40, 640, 200, 260, 700, 737, 180, 14,400. What do you have? What do we have? Very fast. To 𝐎𝐍𝐋𝐈𝐍𝐄. Who will give me that? What will make a tap? So Mwalimu has already gotten it for 407,400. So this is the total investment allowance for 2022. Give me a yes if you together. Yes, thank you for supporting that. So then what is the marking point? 1, 2, 3, 5, 6, 7, 8, 9, 10, 11, 12, 13. So tumemaliza 22. And these are the marking points for that. That is the as solution for 22. We have the total figure 14,407,400. Together, team, we respond with a yes. That is the investment allowance for 2020, for 2022. Understood. Which method is easier? Doing them separately or doing them the same? Having just one sheet and doing them as they are. Which method is much better? Is it the first method that we separated ID separate, IBD, and wear and tear separate? This should be much easier. You just have everything and you sort it under one sheet. Perfect. So then 2023, I want to use the same. What do I need? I don't need this information. I will remove it because I don't need this information. Those rates are okay. So I'll change this to 2020, 2023. Together, team. Are we together? So I'm done with 2022, 2023 now. Team, Tukosawa, I need that yes kindly. So if you look at items, that is the ID, we are told that 50%, we are told that 50% in the first year and 25% per annum on the straight line on the remaining balance. So for the factory building, under this part now, we're going to have what? The remaining balance. What is the remaining balance? That is 73.20. The second year, we get 25% on the straight line. So what is the investment allowance for the factory building? Investment allowance for the factory building for the second year. For the second year, what is the figure for that? So the second year, we say that 25% per annum on a straight line on the remaining balance. What is the remaining balance? The remaining balance is now 73.20. We get 25%. What is that 25% of that? So we have investment allowance for that on the second year to be 18. So what is the balance? You less that. So that is 73.20 minus, so this should be 54.90 together. Are we together on that first one? When you're quiet, we cannot do anything. When you don't participate, we cannot make it. You have to participate. When you're quiet, when you're not responding, we cannot do anything. So I'm saying that when you talk about for the ID, for the farmwork deduction, and for the mining, the first year we granted 50%. However, for the second year, we granted 25% per annum on a straight line on the remaining balance. That's why I picked the remaining balance of 73.20. I grant at 25%. Again, processing machine is also ID. So the remaining balance is 23.56. The second year now we grant it at 25%. So what is 25% of that? What is 25% of that? That is 589. So 589 minus 23.56. Thank you so much. 1769. Perfect. Thank you so much. So the next we have what we call computer. Computer is a straight line. If it's a straight line, the qualifying amount is still the same? The same. So how much was 25? That should be 96. 96. Because it's 25% on a straight line. If it stays a straight line, it basically means that the investment allowance will be the same for the 4 years. The only thing that is going to change is that from 288, we less 96. We less the figure of 96. So this should be 190, 192. Understood? When you say on a straight line, it means for the wear and tear, if there's no disposal, then the rate should be the same on a yearly basis. Then we come to this. We come to the conveyor belt. Conveyor belt is now the ID. So we pick the balance. That is now what we use. So 620, we get 25% now. So what is 25% of 620? 25%. If you don't participate, it is very hard to move. If you don't participate, if you don't ask questions, it is extremely hard to learn. So that should be 155, 155. So 155 minus 620, what is the balance? $465 together. So for the staff canteen is the same thing because it's 10 staff is 10% on the straight line. 10% on the straight line, that should also be 240. So the only thing we less that from that. So 2196 minus 244. So this should be 1952. So that should be okay. So the next is delivery van. Hold on this. There was a disposal. For the delivery van, hold on it. Together, hold it there for the delivery van. Delivery van, you can hold it there. Are we together for the delivery van? Delivery van, we can hold it there. Are we there for the delivery van? Or we can just get it. But then we have the disposal down there. So again, that should be 10. That should also be 10. The two methods of doing this, 10, 10, 040, 10, 040. So what is the balance when you less that? 10, 040, 10, 040. Times 040. These figures I'm getting, are we together? Are we together on those figures? I need a yes. Are we together on those figures that I'm getting? Mpaka hapa tuko sawa. Alan, tuko sawa. Dennis, tuko sawa. Davis, tuko sawa. Edith, are we together? Galma, are we together? Ida, are we together? Abia, are we together? Joy, are we together? Zipporah, are we together? Kindly, by the mercies of God, participate. So then I move to the next, we have the sewerage. Sewerage is ID. So we use the remaining balance. So that should be 640. So 640 for the second year, that is going to be 25%. So 25%, that should be 160. So 160. What is the balance here? Abia, balance ni ngapi hapo? Abia, what is the balance there? That is 480. So I proceed to generator. This now should be still ID because this is manufacturing. So we use the bar, the balance. The balance is 200,000. For the second year now we use 25%. So that should be 50. So 50, what is the balance, Zipporah? Zipporah, what balance do you have there? Zipporah, what is the balance? Zipporah, that should be 150. 150. So for the go down, what is the investment allowance and why? Abia, Ama Matsura. Matsura. What is the investment allowance for the go down now for the second year, that is 2023? For the second year, Abia. What is the investment allowance for the go down? Matsura and Abia. Joy, I have an issue. Joy. Now I'm getting new people. Yes. Matsura, what is the investment allowance for the go down now on the second year? On the second year. What is the investment allowance? That was the remaining balance. But how do you get investment allowance for the building? That is the IPT. Davis, can you give me that? What is the investment allowance now for 260? Why 260, Joy? Because it's granted on a straight line. If depreciation is on a straight line, the asset value is 10,000 and depreciation is provided at the straight line. So that should be 240. Again, 240. That should remain the same. The same. When you less 260 minus 23, what is the remaining? Minus 260 on this. What is remaining? What is the figure? So you say 2080. So the next is eating plant. That was eating plant. That was basically eating plant. So we use 700. So second year, that should be 25%. So what is 25% of 700? Is it 175? That should definitely be 175. So 175 minus that should be 525. 525. 525. 525. Together, that should be 525. What is the rolling? Our lorry. It should just be the same for the lorry. The lorry should be the same. Again, this should be 737. Then this one less 737. So 22, 11. So we have this as 14, 1474. Perfect. Then you have the next, that is sports pavilion. Again, it's on a straight line, the figure should be 180. So 1620 minus 180. This should be 14. Together. Then this is also on a straight line. That is 14,400. Then you less 129. 129, 600 minus the 14,400. So this should be 115. Up to this point, kuna mtu ana swali? Is there anybody with a question up to this point? Is there anybody with a question? Nani ana swali? Is there anybody with a question? So that is for 2023. We are not done. Is everybody okay? Is everybody okay? Is everybody okay? Lorry should be. Is the rate of investment allowance. So together. So 2022, the first item that you have is the factory building. Factory building. So the qualifying amount is 14,640.
Yes, and I hope you're there. I hope you're there. So what are we told? What are we told here? So the question is, the following financial statements were extracted from the books of 𝐅𝐎𝐂𝐔𝐒 Group. So we are given the consolidated statement for financial position as at 31st of December 2022 and 2023. We have the non-current assets, which include PP, goodwill, other intangible assets, and investment in associates. We are given current assets, which include inventory, accounts receivable, cash, and cash equivalents. And then we have the equity, which comprises of ordinary share capital, revaluation, surplus, retained earnings. And then we have the non-controlling interest. We have long-term or the non-current liabilities, which include long-term loan, deferred tax, the current liabilities, which include account payable and current tax. Then we have the consolidated statement of profit or loss. We are given additional information number 1, 2, 3, 4, 5. What are we required to do? We are required to prepare the statement of cash flows for 𝐼𝐍 group for the year which ended 31st of December 2023 using the indirect method and also in accordance with IS 7. So basically, once you come across this particular question in an exam, never use the approach which you have used in the other question. You do the workings because remember, you don't have all the time with you. So such a question, you must complete it within what? 40 minutes. So how should you approach such a question? How should you do this particular question in an exam? So we always advise the student, always start with the title. So the title here will be 𝐼𝐍 group. This is the consolidated statement of cash flows. Consolidated statement of cash flows, basically which is for the year which ended 31st of December 2023. 31st of December 2023. Then after having that title, you also need to remember that we need to compute cash flows from how many activities? Cash flows from 3 activities. The cash flow from operating activities, the cash flow from what? Investing activities, and finally cash flow from the financing activities. So have those subheadings. You have those subheadings, and remember here, we always start by computing the cash flow from operating activities. Operating activities, we need to have 2 columns here, and our figures are in million of shillings and in million of shillings. Because basically by doing this, there are so many free marks you should be able to get. And remember, I've said that most of these particular questions for cash flow, for any correct entry which you have here, you are given 2 marks. So like you can see, this is a question for 20 marks. It basically means that you need to get 10 items correct. For each item you get correct, you get how many marks? You get 2. By the end of the day, you have 20. So therefore, this question, even if you don't compute all the items, you just record the obvious items, the obvious entries, is a question you should be able to get almost all the marks, almost all of the marks. So once you have this, leave enough space here because you have so many items which are recorded here. Then you have the other subheading for computing the cash flow from investing activities. We don't have so many items which we record here. And then from there we proceed, and we have the other subheading for computing the cash flow from the financing activities. Equally, remember we say that all the items which we record here, we get them from equity, non-current liability section. And then down here, come and record the cash and cash equivalent, balance brought down, the cash and cash equivalent, balance carried what? Balance carried down. And in this case, I always advise the student, can you start by recording these 2 items? Because these are just for free marks. So cash and cash equivalent at the start and also at the end. So in most of the questions for cash flow, the examiner will have given you this, cash and cash equivalent at the start and also at the end. But if you're not given this, you have to record, we say that cash comprises of the cash in hand, the cash in hand. It also comprises of the cash at bank, It also comprises of a bank overdraft. But in this case, a bank overdraft, you take it as a negative. You take it as what? as a negative. And also in this case, we said at the current asset, check whether you're given short-term investment. Short-term investment or something called the financial asset at fair value through profit and loss. So in case you're not given cash and cash equivalent, at the start and also at the end, these are the items which you use in computing this. But if you check on this particular question here, are we given the cash and cash equivalent at the start and also at the end? You go to where we have the current asset. Where we have the current asset in the consolidated statement of financial position. Do we have the cash and cash equivalent at the start and also at the end? Yes. So those are basically free money. So they call the cash and cash equivalent at the start. And I hope you can see in our consolidated statement of financial position, we are given the consolidated statement of financial position for 2022, 2023. It's important for you to note that these values we have here are opening balances. These are the closing balances. Sasa, yes, you have to be very, very keen there. So the opening balance are the values we have here in 2022, and the cash and cash equivalent at the start was 340. The cash and cash equivalent at the end is what? Is 450. So if, for example, this is how the question is marked, so basically you already have 4 marks there. You already have 4 marks. If for every correct entry you record here is 2 marks, you already have what? 4 marks. And then from there you come back here. Here, remember we said we start with what? Under the indirect method, we start with the profit before tax. So the profit before tax, this one we get it from the consolidated statement of profit or loss. Can we go to the consolidated statement of profit or loss? We take the profit before tax. Profit before tax, how much is that? You can be able to see that figure for the profit before tax. Profit before tax, I can see that as a figure of what? Of 380. I can see that as a figure of 380. And then basically to this, we make a number of adjustments. We make a number of adjustments. So the first adjustment we said is to add back the finance cost. That's what we said. So we add back the finance cost such that by the end of the day, we will have the profit before interest and tax. And the finance cost is just above that, which is basically a figure of 140. So I add it there such that we have now the profit before interest and tax. And now, even before we go to the additional information, there are some other items which we also adjust to this profit. Like above this profit before tax, I can see the share of a profit of associate. We say this is a non-cash item. Because it is added in arriving at that, we less it. The share of a profit of who? Of associate. Which is how much? Which is 180. So take into account it is added here. It is basically a non-cash item. We do what? We less it. And then in this case, above that we have finance cost, we have operating profit, administrative distribution. Those are operating expenses. Yes. So we said maybe the other item which you may check, like the other question which we did yesterday, we were given the gain on disposal of the subsidiary, which we said, in case you have that, let's start from here. Yes. So those are obvious entries. Those are obvious items which you can be able to record here without any working. Without any what? Working. Then from there, we go to the additional information. We basically record what we can be able to record directly here without a lot of work, a lot of working. So let's go to note number 1. In note number 1, you're told during the year, which ended 31st of December 2023, that is the current year, 𝐅𝐎𝐂 Group acquired 60% of the ordinary shares of 𝐒𝐍 Limited for a cash consideration of 720. So we have a subsidiary which is acquired. A subsidiary acquired, remember, we say is an investing activity. So come here and you say there was a subsidiary which was acquired. So we said for the subsidiary which is acquired, we consider the net cash outflow. The net cash outflow, we take the cash which was paid, which basically is 720, and that is a cash outflow. And then to this, we less the cash balance, which this subsidiary was having. So how much is the cash balance? This subsidiary which was acquired. In note number 1, paragraph 2, we are told the fair value of the identifiable net asset of 𝐻𝐶𝐒, the subsidiary acquired, were as follows. So that subsidiary which was acquired had PP, inventory, receivable, cash, payable, current tax. So this subsidiary which was acquired was having a cash of 80. So basically the parent company paid 720 and it acquired a subsidiary which had a cash balance of 80. So what is the net cash outflow? The net cash outflow should be the difference here. The net cash outflow will be negative 640. That's basically what we record there. That's what we record there. So from there, let's move to the other point, and we are told 𝐅𝐎𝐂𝐔𝐒 group measures non-controlling interest at the fair value at the date of acquisition. LCA is measured at fair value. And then you're told the fair value of the non-controlling interest in 𝐻𝐻𝐒 at the date of acquisition was 22. So basically that can help us in terms of computing the goodwill on acquisition of this subsidiary. But is that supposed to be recorded here? No, we can first of all ignore that. And then note number 2, we are told the group property, plant and equipment comprised of the following. So in this case, we are given a breakdown of how the value for PP at the start and also at the end was arrived at. So this is like the working we did yesterday, basically to compute the PP which were acquired. So, and I hope you can see we have the value of 34. That is the value for PP at the start. And down here we have the carrying amount at the end, 4570. So if you go to the consolidated statement of financial position, you should be able to see those values. The PP at the start, 34, the PP at the end, 4570. Are those the values we have in the consolidated statement of financial position? Yes, 34 and 4570. So what do we capture in our cash flow? So what we capture here, one, are the additions. The additions at cost, including asset of PP which were acquired. So what we are going to consider here are the PP which were acquired. The PP which were acquired in cash. The PP which were acquired in cash, we will take the additions. I hope you can see the additions, but you're told those additions automatically are PP which were acquired. They include the PP of the subsidiary acquired. The subsidiary acquired, remember, not one. So what we will do here, we will only consider the PP which were acquired in cash. So this includes the PP acquired in cash, and this also includes the PP of the subsidiary acquired. So we have to exclude the PP of the subsidiary acquired. The PP of the subsidiary acquired as per note number 1 is 280. So the difference basically represents the PP which were acquired in cash. The PP which were acquired in cash after eliminating the PP of the subsidiary acquired. So that will give us what? That will give us 1360. So that is the PP. Those are the PP which were acquired in what? In cash. Still in note number 2, we are given the gain on property revaluation. Do we consider that within our cash flow? No. Revaluation gain on PP is a non-cash item. We don't consider that here. Then from there we have disposal. Disposal automatically, that one should be the net book value. So that is the net book value of the PP which were disposed. Basically, what we consider here in respect to the disposal of PP, if you can be able to recall, we said we consider the proceeds. Are we given the proceeds there? No, but we must be given that somewhere down there. So we don't consider the carrying amount, we consider the proceeds. And then from there also remember, in case there was an item of PP which was acquired, we will have to compute the gain or loss on disposal, which we adjust to our profit. So we said anytime you come across a transaction regarding the disposal of asset, 2 entries here, the gain or loss on disposal and the sales proceeds here. So then down here we have depreciation. Depreciation, remember, is one of the items which we consider here because these are non-cash items. The depreciation on what? On PP. The depreciation on PP, that one is an amount of how much? 210. Because this one was deducted in arriving at that profit and is a non-cash item, we do what? We add it back. We are done with that. And then in the last paragraph of note 2, we are told the disposal proceeds of the property, plant and equipment amounted to 540. So this item of PP which was disposed, it was disposed at 540. That is the sales proceeds, and that is a cash inflow. And then you are told in the same paragraph, and the gain on disposal has been netted off against the administrative expenses. So there was a gain. So what we need to do is to compute the gain on disposal, which has already been adjusted in this profit. We do what? We less it, the gain on disposal. The gain on disposal will automatically be equal to the profit, the sales profit. I hope you can remember the formula which I gave you, the sales profit minus the net book value or the carrying amount. The net book value of the asset which was disposed in note number 2, I hope you can remember, we are given the carrying amount of the item which was disposed. How much is that? This item which was disposed, its carrying amount is how much? Is it the one which is 330? In that working, for that working which we have in note number 2, yes, it is 330. So this item of PP which was disposed, it was disposed at a gain of 210. Is it 210? 210. So this gain, in arriving at this profit, it has been added, but basically that is a non-cash what item. What do we do? Basically we less it. It's a non-cash item. So we, okay, in the last sentence of note number 2, we are told it is the group policy to make inter-reserve transfer of excess depreciation upon the devaluation of asset. So now, anytime you come across that there is inter-reserve transfer, that will affect the retained earnings. That will affect the retained what? Earnings. And once you're given that, always the examiner will give you the dividends which were paid by the parent. Because the dividends which were paid by the parent, we can't compute that using the approach which I gave you yesterday, because there was an amount of excess depreciation which was transferred to that account. So we will see whether we're given the dividends which were paid by the parent. In note number 3, we are told during the year which ended 31st of December 2023, 𝐅𝐎𝐂𝐔𝐒 Group acquired 30% interest in an associate for a cash consideration. For a cash what? Consideration. So basically, anytime as the parent company acquire an associate, that is also an investing activity. That is also an investing what? Is also an investing activity. Is also an investing activity. So here you consider 2 items as far as the associate is concerned. One, the associate which was acquired, you determine how much cash was paid. But I hope you can see in that case we are not given the consideration. We will compute that. Then also in respect to this associate, we said we compute the dividends which were received from the associate. So let's see what we are told. We are told the associate reported a profit of 600 and paid dividends of 200 out of that profit. So the associate which was acquired paid dividends of how much? 200. So in this case, what we are interested with are the dividends which the parent company received from that associate. The associate paid dividends of 200. How much dividends were received by the parent company here? Take into account the parent company acquired 30% shareholding. So the parent company acquired an associate. This associate paid dividends of 200 million. So remember the parent company acquired 30% shareholding here. So out of this, the dividends which were paid to the parent were 30%. 30% of these 200. So that will give us what? That will give us 60. So 30% of this. These dividends were paid to the parent, which will be a cash inflow, which is a cash inflow. That is basically what we consider here. What we consider there. Now, before we move to point number 4, I think also we can compute this. Can we compute this amount which was paid in acquiring that associate? And remember, you said, or how do we compute this one? How do we compute this one? Which approach are we going to use here? We are going to use the approach of computing the investment in associate. I hope you can be able to recall how we compute the investment in associate. But remember, in this case, I've said, if, for example, whenever you're doing this question, you feel a working is a little bit demanding, you can just ignore it, because you can see this question, even without a lot of working, the kind of entries we have. If you feel a working is a little bit complex, just leave it. It's not a must you get everything correct. But in this case, how do we compute the investment in associate? I hope you can be able to remember this. We said we take the cost of investment. The cost of investment is now what we are not given here. The purchase consideration, the cost of investment. The cost of investment. And then to this, we said we add the group share. The group share of what? Of associate post acquisition retained earnings. And then to this, we also less what? Any impairment loss. I think in our case, we don't have any impairment loss. We are not told the investment in associate had impaired. So basically what I want us to do here is we take the profit which was reported by the associate in note number 3. We are told the associate reported a profit of 600 million and paid 200 million out of the profit. Paid 200 million out of the profit. Paid 200 million out of the profit. So what do we consider here? We consider the retained earnings. The retained earnings of that associate will basically be the profit after the profit for the year minus dividend. So which is 600 minus the dividend. So that will give us the retained earnings of that associate. And then we get the group share of this. The group share of this should be what? Should be 30%. It should be 30%. Should be 30%. So this one will give us 120. Remember, you don't have any impairment loss. So we will get the investment in associate at the end. We are given the investment in associate at the end of the year. If we go to the consolidated statement of financial position at the non-current asset. At the non-current asset, can you see the investment in associate at the end? Is what? Is 770. Can you see that? 770. So the purchase consideration which was paid will automatically be the difference between these two values. The difference between those values. Is it coming to 550? How many 650? 650. Yes, 650. But in this case, remember I've said, if you feel our working is a little bit complex, unaiacha. Sasa, si lazima ucompute kila kitu. It's not a must, you have to compute everything. So let's move now to the other point. And you're told number 4, an impairment review carried out at the end of the year revealed that the goodwill and other intangible assets were impaired. So basically what that means is that here we will have the impairment loss on goodwill, and also we are going to have amortization for what? For intangible assets. For intangible what? Assets. I think we can start with this one. Because for goodwill, we have to compute the goodwill for the subsidiary which was acquired. So intangible assets, we have this as one of the non-current assets. And the non-current asset, can you go to where we have non-current assets? I hope you can see PP, have dealt with that. We have goodwill, we will come back to that. And then we have other intangible assets. Other intangible assets, the value at the start was 1630. And then that reduced to 1440. So basically, there are two reasons why the value for intangible asset can reduce, either due to disposal or due to amortization. And if you check on the information which are given in the additional information, there is nowhere we are told in the intangible asset were disposed. Were disposed. So basically, what that means is that decrease in the value for intangible assets is due to amortization. So how much is the amortization that decreased? From 1630 to 1440. That is a decrease of 180. And amortization taking into account, it was deducted in arriving at that. We do what? We add it back. Then for impairment loss on goodwill, we must prepare the goodwill account. Though that this one is not complex because I think we only have a subsidiary which was acquired. So we just need to compute its goodwill. So we said here we take the value for the goodwill at the start, and then the value for the goodwill at the end, In case there was a subsidiary which was disposed, you less its goodwill. In our case, no subsidiary which was disposed, but we have a subsidiary which was acquired. We compute its goodwill, and basically we include it here. So to compute this goodwill is quite simple. We know there was a subsidiary which was acquired as per note number 1. And as per the information which we have in the last paragraph of note 1, we are going to compute the goodwill of that subsidiary using the full goodwill method because you're given the NCI fair value. We will compute that goodwill using the full goodwill method. So how do we compute the goodwill using the full goodwill method? Just like what we did in the other question, we will take the purchase consideration which was paid by the parent. That is in note number 1, the first paragraph. 𝐼𝐍 Group acquired 60% of the ordinary share capital of 𝐒𝐿, paying 720. So to this we add the NCI fair value, which is within the last paragraph of note 1. The NCI fair value was 220. So that is the purchase consideration paid by the parent, purchase consideration paid by NCI, and then we less 100% of the net asset of that subsidiary. So that subsidiary net asset was 480. Or forward 480. That will give us the goodwill of the subsidiary which was acquired. So this 940 minus 480. This will give us what? Is it 460?